The committee will come to order. Without objection, the chair is authorized to declare a recess of the committee at any time. Without objection, all members shall have 5 legislative days within which to submit additional materials to the chair for inclusion in the record. Quorum being present, we'll now proceed to today's business. The chair will recognize himself for an opening statement. Just days ago, the nation received the most recent monthly jobs report, and to say the report is a disaster is a huge understatement. It was the weakest jobs report in nearly 6 years and adds to the litany of facts and figures showing that the American people continue to hurt. Incomes are falling, wage growth is stagnating, the number of Americans living in poverty has increased by nearly 7 million during the current administration. The percentage of Americans working or actively work is at its lowest level since the malaise of the Carter era. The national debt has grown by 80%, and we remain stuck in the slowest, weakest recovery in our history. The economy clearly is not working for working Americans. I'm confident that all of us on both sides of the aisle want that to change, but if we are to truly ignite strong and lasting growth, we must help create more jobs, build a healthy economy. The answer is not more debt, it is not more spending, and it is not more burdensome regulations from Washington that hinder capital formation. Instead, we need more entrepreneurs and more small businesses on Main Street. Considering that new businesses account for nearly all of the net new job creation and almost 20% of gross job creation, the importance of freeing up new capital for new and small businesses has perhaps never been greater. Yet small businesses are not getting the capital they need to grow, to hire, and succeed. Since the adoption of the Dodd-Frank Act, it is more difficult for small businesses to obtain crucial capital, especially at the early stages. As we heard in testimony before our Capital Markets Subcommittee just 2 months ago, there has been a serious decline in loans from banks to small businesses over the past several years, and we have gone a decade with no growth in the value of small business loans. Therefore, it is not surprising that during the first quarter of this year, nearly 40% of small business owners had to transfer personal assets to help keep their businesses running, according to the Pepperdine University Private Capital Access Index. 61% of small business owners feel their growth opportunities are restricted by the current business environment, an increase of 7% from a year ago. As a small business owner named Christopher in my hometown of Dallas recently wrote me, quote, "We have seen wave after wave of federal regulations affect our ability to grow," unquote. Our Richard, a small business owner from Chandler, Texas, in my district, summed up the economic harm caused by Washington's regulatory burden when he said, quote, "No one can keep up." Today, our committee will focus on solutions that will more appropriately balance rules with the urgent need to provide small business entrepreneurs with more options to access capital so they can start up, hire workers, and grow their companies. We will remove duplicative burdens, reduce cost, and support smart regulation that protects investors and maintains orderly and efficient markets, because this is key to economic growth. We'll also consider legislation to promote and improve accountability at the Securities and Exchange Commission, improve congressional oversight over international standards for insurance, and help stop financial abuse of senior citizens. Finally, we will also consider much-needed legislation to require the Treasury Department to list the known assets of senior Iranian officials. Iran and its senior military leaders are known sponsors of terrorist acts and organizations. Developing and keeping a current estimate of the funds held by Iran's political and military leaders will help combat terror financing and money laundering. I want to thank all members on both sides of the aisle who are sponsoring and co-sponsoring the 12 bills before us today. I thank them for their hard work, and I urge all members to support their bills. I now yield 5 minutes to the ranking member for an opening statement.
Thank you, Mr. Chairman. The legislative proposals we have before us today are wide-ranging and far-reaching. I appreciate the opportunity to work with my colleagues on both sides of the aisle to implement common-sense changes to our securities laws in some of these bills. For example, one bill is long overdue and much needed and will provide critical protections to investors in Puerto Rico. Another will help ease the reporting of suspected financial abuse of seniors, and two others, if amended today, would make it easier to invest in promising startups. However, there are several bills up for consideration today that would be harmful to our capital markets, to our oversight of insurance activities, and to implementation of the Iran nuclear deal. This includes proposals that would hamstring the SEC's ability to properly enforce much-needed investor protections. It includes efforts that would weaken the SEC's ability to oversee private equity funds and reduce transparency to those funds' investors. It includes legislation that would stifle investors' access to impartial research and recommendations used to inform their shareholder voting decisions. And it includes legislation that would significantly undermine our efforts to implement Dodd-Frank, including enhanced supervision of the insurance industry. The balance between capital formation and investor protection is a tenuous one, and we need to be vigilant about tipping the rules too far toward the side of capital raising over concerns of savers. Unfortunately, these small yet harmful changes are part of a larger, concerted attack on consumer protection and financial stability, which the chairman announced to widespread denunciation last week. Mr. Chairman, how can we sit here today with these one-off bills as you're putting the finishing touches on your grand plan to deregulate Wall Street? Your proposal would severely undermine all the progress we have made since the depths of financial crisis. I cannot stress enough how detrimental this new world order would be, allowing banks to opt out of Dodd-Frank while gutting its most important mechanisms to ensure safety and soundness in our economy, implementing half measures on new capital requirements without the necessary protections against risky activity, repealing the only method to safely wind down a failing megabank, tying the hands of our regulators from conducting proper oversight, especially the CFPB, and upending monetary policymaking at the Federal Reserve. Mr. Chairman, the contours of the plan that have been outlined so far are alarming. And let's be clear, we know that this plan is nothing more than a partisan messaging tool in an election year where too much is at stake. Democrats have not forgotten why we enacted Wall Street reform and how devastating the crisis was to millions of families and businesses across the country. Considering where we were 8 years ago, our recovery indeed has been remarkable thanks to the strong protections we put in place. This is why it is astounding that Republicans have no problem dismantling our robust regulatory framework and gutting the Fed's ability to conduct monetary policy. And what's more, I truly cannot repeat this enough. Of the 20 hearings our committee has held this year alone, only 3 have been devoted to housing. This is despite the formidable housing challenges millions of Americans face, and despite the 600,000 Americans who are homeless in this country. Instead, my Republican colleagues have rolled out a so-called anti-poverty program that blames the poor for their own poverty instead of investing in the resources that they deserve. I have to make sure that we all understand that this markup is simply a distraction from the more pressing issues we have at stake in this committee, whether it's the future of Wall Street reform or the crushing poverty faced by too many of our fellow Americans. So I thank you, Mr. Chairman, and I yield back the balance of my time.
Now pursuant to notice, I call up H.R. 4538. The clerk will report the bill which was distributed in advance.
H.R. 4538, to provide immunity from suit for certain individuals who disclose potential examples.
Without objection, the bill is considered read and open to amendment at any point. The chair recognizes the gentlelady from Arizona, Ms. Sinema, to offer an amendment in the nature of a substitute. Does the gentlelady have an amendment at the desk?
Yes.
Copies of the amendment, the chair has been informed, have already been distributed. They are on the dais. The clerk will report.
Amendment in the nature of a substitute offered by Ms. Sinema. Strike all after the enacting clause. Insert the following. Section
Without
1.
objection, the amendment is considered read and will serve as base text for purposes of amendment. The gentlelady is recognized for 5 minutes.
Thank you, Chairman Hensterling and Ranking Member Waters, and thank you to Congressman Poliquin, Murphy, and Mulvaney for working with me on this bipartisan legislation to help law enforcement combat senior financial exploitation. Recent studies estimate nearly 1 in 5 American seniors may be a target of financial fraud or abuse, and seniors lose at least $2.9 billion annually to financial exploitation. Even when financial institutions suspect abuse, the abuse may go unpunished, because current laws lack the necessary flexibility to allow financial institutions to report suspected abuse to authorities. Our bill, the Senior Safe Act, helps individuals and financial institutions communicate with appropriate agencies when they suspect financial exploitation of seniors. It also encourages firms to train employees to identify and stop financial fraud targeting seniors. Seniors deserve to retire with dignity, and they shouldn't have to worry that their hard-earned savings are at risk of fraud. Our legislation protects firms and advisors who report suspected financial exploitation of a senior citizen from liability. It's a common-sense solution to help ensure financial institutions can identify fraud, report it, and stop financial abuse of the elderly. Thank you again to my colleagues on both sides of the aisle for their work to protect seniors and end financial exploitation. Mr. Chair, I yield back.
Gentlelady yields back. For what purposes, gentleman from South Carolina seek recognition?
Strike the last word.
Gentleman is recognized for 5 minutes.
I want to thank the chairman for bringing up the bill. Thank Ms. Sinema for bringing it. Thank to the ranking member for the kind words about the bill. This is one of those rare bills in this committee that actually grew out of contacts from ordinary folks back home. We've all heard the stories about our parents and grandparents possibly having been the victims of elder abuse, and you get a phone call in your office and says, look, can you do something to help? And in a rare occasion, on a bipartisan basis, the answer is actually yes. So we have a chance here, I think, to strike that balance between the privacy of the people involved, but the need to make sure that if there is some type of abuse going on, that law enforcement at the local and state level can find out about it. I'm very excited about the idea of working with Ms. Sinema on a bill that has such bipartisan support and actually can pass and come into law. It's too often when folks call us from back home and say, can you help us with this? And we sort of hem and haw when we all know the answer is no. This is one of those rare occasions where we actually have the chance to say, you know what, yes, we probably can help you in this particular circumstance without making too much mess of the financial services industry, without limiting the ability of advisors to give advice, and without putting them in fear of having somebody looking over the shoulder the whole time. But it does give us the opportunity to sort of weed out the bad actors. And I appreciate Ms. Sinema's work, not only in the bill, but on the amendment that is in the nature of a substitute, which I think makes some important changes. And that brings some well-needed but reasonable reform to this particular area of financial services. So I hope everybody will join me in supporting the bill today, and with that, I'll yield back.
Would the gentleman yield to the chairman?
Always yield to the chairman.
I thank the gentleman for yielding. I just want to thank both members, our members on both sides of the aisle, for their work on this piece of legislation. I suspect for many members, this hits rather close to home. In my own case, I have an 84-year-old mother, and my father, who is now deceased, typically handled a lot of the finances for my parents, and already it is obvious that some have perhaps attempted to take advantage of my mother. So again, my guess is every member of this committee, this hits close to home. So I want to thank the gentlelady from Arizona for her leadership, the gentleman from South Carolina for his leadership as well, because it is simply critical that we do more to protect our seniors. I thank the gentleman for yielding. The gentleman yields back, who seeks recognition. For what purpose does the gentleman from Maine seek recognition?
Strike the last word, Mr. Chair, please.
The gentleman is recognized for 5 minutes.
I want to thank and congratulate Mr. Mulvaney, Ms. Sinema, and also Mr. Murphy for their great work on this issue, and I support the chairman's comments with respect to our seniors in this country. Maine, Mr. Chairman, has the oldest average age in the country, and our 2nd District of Maine, which is highly rural, also experiences that same demographic. I am very concerned about our seniors in this country. My parents are 86 and 88, and they're still with us and healthy, and we love them to death. But boy, I'll tell you, it is so easy to prey upon our seniors when it comes to various scams that are offered throughout the country. I also, Mr. Chairman, want to salute Senator Susan Collins, our senior senator from the great state of Maine, who's done some terrific work on this issue, and also Judy Shaw, who is our Maine Securities Administrator. I'm very proud that the state of Maine leads in many regards, and in this case, we have our own program to help our seniors up there avoid being preyed upon by fraudulent behavior in the financial sector. And a lot of this issue that we're dealing with today at the national level is a takeoff on that work. I'm very concerned, and I hear these stories, Mr. Chairman, about a senior member of our community showing up at his or her financial advisor or bank, local bank, with someone that maybe the teller or the FA doesn't know, and asking to withdraw essentially the entire amount of an account and maybe wire the proceeds to a place that is unknown to many folks in this room and beyond. So this gives our financial advisors and folks involved in our local banks and our insurance companies an opportunity to speak up and stand up on behalf of our seniors to make sure they are not preyed upon and these individuals are not penalized for so doing. So again, I congratulate Mr. Mulvaney, Mr. Murphy, and Ms. Sinema, and for all those who worked on this. I am very proud to be a co-sponsor of this bill, and I encourage everybody on both sides of the aisle, Mr. Chair, to so vote in favor of this bill. Thank you. I yield back.
Gentleman yields back. For what purpose does the ranking member seek recognition? Gentlelady is recognized for 5 minutes.
First, I'd like to thank the gentlelady from Arizona for her willingness to offer this amendment today. The amendment responds in part to concerns that the Treasury's Financial Crimes Enforcement Network and the Consumer Financial Protection Bureau brought to our attention. It also responds to concerns I've raised to ensure that the legislation is consistent with the efforts I've undertaken with regard to sharing terrorist money laundering and other financial crimes to the appropriate authorities without incurring the risk of liability for simply complying with federal law. And second, there are a few other last-minute suggestions that have come in from FinCEN and the CFPB and others. It is my hope that you would be willing to work with my staff and the relevant administration stakeholders to incorporate some of their feedback before the bill gets to the floor. With that, I would reiterate that I believe the manager's amendment improves the bill, and I urge members to adopt it. I yield back the balance of my time.
Gentlelady yields back. Who seeks recognition? For what purpose does the gentleman from Arkansas seek recognition?
Move to strike the last word.
Gentleman is recognized for 5 minutes.
Thank the chair. Thanks the authors of this bill. I just think it's an excellent step forward, and I want to be on record and compliment the FINRA for the work they've done over the past 15 years in this arena. Many years ago, they sponsored a sweep, educational sweep across the broker-dealers of the country with particular care for senior training and senior issues for financial advisors. But the commercial banking industry has not done that in an organized way to the same extent, and I think that this is a nice way to unify the oversight and care of dealing with specialty issues that relate to seniors and their investments and their banking assets. And I commend the authors and urge my colleagues to support this proposed bill. Yield back, Mr. Chairman.
Gentleman yields back. Is there any other member seeking recognition? There being no further discussion. I'm sorry. For what purpose does the gentleman from Texas seek recognition?
Thank you, Mr. Chairman.
The gentleman is recognized for 5 minutes.
I move to strike the last word.
The gentleman is recognized for 5 minutes.
Unfortunately, too many of our senior citizens are victims of financial exploitation. The CFPB estimates that older Americans are swindled to the tune of $2.9 billion to $36.5 billion per year. This is simply unacceptable, and we should be giving our financial institutions and regulators and law enforcement officials every means available to be able to identify and prosecute these fraudulent scams. I wholeheartedly support H.R. 4538, the Senior Safe Act, and I thank my colleagues, including Representative Sinema from Arizona, for introducing this necessary piece of legislation. The Senior SAFE Act will clarify ambiguity in the current state of the law and remove any doubt about the ability of financial institutions and their employees to report suspected fraud against our nation's senior citizens. Moreover, the bill's training requirements will provide the employees on the front lines with us resources and knowledge necessary to be able to better identify instances of elder financial fraud and act to prevent such fraud in the future. For these reasons, I will be voting in favor of the Senior SAFE Act and urge my friends on both sides of the aisle to do the same. Thank you, and I yield back.
Gentleman yields back. Are there any other members who wish to be heard? There being no further discussion or amendments to the bill, the question now occurs on adoption of the substitute amendment offered by the gentlelady from Arizona. All those in favor shall signify by saying aye. Aye. All those opposed shall signify by saying nay. In the opinion of the chair, the ayes appear to have it. The ayes have it, and the amendment is adopted. The question now occurs on ordering the bill as amended reported to the House with a favorable recommendation. Those in favor shall signify by saying aye. Aye. All those opposed shall signify by saying nay. In the opinion of the chair, the ayes appear to have it. For what purposes, the gentleman from New Jersey seek recognition?
Thank you, Mr. Chairman. Would seek a recorded vote on this bill, please.
Recorded vote has been requested. All those in favor of a recorded vote shall raise their hand and be counted. A sufficient number having raised their hands, a recorded vote is so ordered, and pursuant to subsection C5 of Rule 3 of the committee rules, the vote on this question is postponed. Now, pursuant to notice, I call up H.R. 5424. The clerk will report the bill which was distributed in advance. 5424.
H.R. 5424, to amend the Investment Advisors Act of 1940 and to direct the Securities and Exchange Commission
Without objection,
to
the
amend.
bill is considered read and open to amendment at any point. The chair recognizes the gentleman from Virginia, Mr. Hurt, the sponsor of the legislation, for 5 minutes.
Thank you, Mr. Chairman. Thank you for including this bill in the markup today. As many of you know, I represent a rural district in Virginia, Virginia's 5th district. It stretches from northern Virginia to the North Carolina border. As I travel across this district, I continue to hear hardworking Americans express concern about the current state of our economy and the economic uncertainty facing our children and grandchildren. I think every member of this committee can agree that with millions of Americans out of work, our top focus in Congress must be enacting policies to help spur job creation throughout the country. Today, we will discuss several legislative efforts that, if enacted, will enable economic growth and job creation by reducing unnecessary regulatory burdens. One of those measures is a bipartisan piece of legislation that I've been working on with Representative Vargas, as well as Representative Stivers and Foster. This measure, the Investment Advisors Modernization Act, is an effort to modernize a 76-year-old law to reflect the current industry needs and standards. Moreover, this legislation does not compromise investor protections in any way, nor would it limit the SEC's ability to pursue enforcement actions. In fact, the legislation directs the SEC to write rules on discrete provisions within the Investment Advisors Act, and it gives the SEC sufficient discretion to craft these rules in a fashion consistent with existing law and the SEC's three-pronged mission. In my district, the investment of private capital is responsible for literally thousands of jobs. These critical investments allow our small businesses to innovate, expand their operations, and create jobs that our communities need. Over the last 3 Congresses, there has been growing concern about the burden that Dodd-Frank unnecessarily places on advisors to private equity funds, while at the same time exempting advisors to similar investment funds. Over recent years, many of us have worked together in a bipartisan effort to eliminate the registration requirement of Dodd-Frank. But to be clear, this bill does not change and would not change the registration that Dodd-Frank mandated, but rather would update the Investment Advisors Act. As you may recall, during the last Congress, H.R. 1105 sought to eliminate this registration requirement and received a bipartisan vote of 38-18 in the same committee. But again, this bill does not seek to eliminate the requirement. It simply seeks to streamline the current regulatory regime as we find it. I believe that it is incumbent upon Congress to look for common-sense solutions to problems caused by our regulatory structure, and I believe that this legislation is a pragmatic approach to addressing some of the concerns with the Investment Advisors Act. If you believe that Dodd-Frank placed an unnecessary burden on private investment funds, supported H.R. 1105, And if you believe that Congress should always look for avenues to address outdated laws in an effort to minimize regulatory burdens that hinder job creation, then I encourage you to support this narrowly tailored bipartisan measure. I ask my colleagues on both sides to support this bill, the Investment Advisors Modernization Act. I thank the chairman for including this bill in today's markup, and I yield back the balance of my time.
Gentleman yields back. For what purpose does the ranking member seek recognition?
I move to strike the last word.
Gentlelady is recognized for 5 minutes.
Mr. Chairman, in Dodd-Frank, we sought to bring oversight over the shadow banking system, particularly for private equity funds and hedge funds. We did this by requiring advisors to these funds with more than $150 million in assets to register with the SEC and comply with new record-keeping, reporting, and audit requirements, recognizing that we had insufficient information on the risk private funds could pose to our economy. We also required these newly registered advisors to file systemic risk reports with FSOC. Thanks to this new oversight and information, the SEC has been able to examine and, where appropriate, bring enforcement actions against private fund advisors. I'd like to remind everyone of the SEC's work so far. In 2013, the SEC found that cases where it had examined how fees and expenses were handled by advisors, it identified violations of law or material weaknesses in controls over 50% of the time. In 2014 and 2015, the SEC brought numerous enforcement actions against private equity fund managers for misallocating expenses to funds, failing to disclose loans from clients, using funds to pay their operating expenses without authorization and disclosure, and failing to disclose fees and discounts from service providers. And just last month, the SEC Director of Enforcement highlighted a need for greater transparency into fees and expenses, stating that the agency will continue to aggressively bring impactful cases in this space. H.R. 5424 ignores these recent developments and does nothing to help ensure that investors in private funds have the information and protections they need. Rather, the bill provides overly broad regulatory relief for private fund advisors by, among other things, removing the requirements to notify clients of a change in ownership or control of the advisor, to deliver a plain language narrative brochure to clients each year, and to disclose to FSOC certain information on large private equity funds, making it harder for it to monitor and detect systemic risk in this sector and disadvantaging investors who currently benefit from the SEC's use of this data to alert them of concerning trends. Worse, H.R. 5424 would create a Madoff loophole by providing a broad exemption from the audit requirement for funds owned by investors who may have a tangential relationship with the advisors, such as caterer or building manager. For years, Bernie Madoff duped his friends and family, promising them consistently high returns from assets he swore he invested in, and having nothing else to rely on, they believed him, and in the end, they lost millions. In the wake of that scandal, the SEC strengthened its rules so that investors now have the assurances of an annual independent audit that confirms that an advisor said he bought and sold, what he bought and sold was actually what he bought and sold. Considering that 1/4 of the equity in private equity funds come from private pension funds who invest on behalf of our nation's teachers, police officers, and firefighters, we should not be repealing important protections such as these. CalPERS, the largest public pension fund in the U.S., agrees, stating that H.R. 5424 would undermine the significant gains achieved under Dodd-Frank by diminishing transparency into private funds and restricting the SEC's ability to protect investors. Similarly, CalSTRS, which provides retirement benefits to California's public school teachers, opposes the bill, stating that it would actually roll back important investor protections and enable private fund advisors to retreat back into the shadows. The Institutional Limited Partners Association, which represents a large swath of investors and private equity funds, also opposes the bill. So I would urge my colleagues to join me in standing up for investors and private funds and oppose H.R. 5424. I yield back the balance of my time.
Gentlelady yields back before proceeding. As a reminder to our guest, an overflow room is available in room 2220. If there are no seats currently available, you are welcome and invited to use the overflow room until seats open up in the hearing room. For what purpose does the gentleman from New Jersey seek recognition?
Thanks. To strike the last word.
Gentleman is recognized for 5 minutes.
And I'll be briefer than that. Let me just begin by thanking the sponsor of this legislation and to offering my support for the bill. Commend him, Mr. Hurt, for your diligent work over the past several years, 4 years, to help modernize and relieve burdens upon private pools of capital, which you all know play an essential role, a critical role in our economy. And I've lost count, but I know we've had a number of witnesses, multiple amount of witnesses come before this committee over the last several years who have told us that private equity had absolutely nothing to do with the financial crisis. And yet, like so many other industries that did not cause the crisis, private equity was targeted by the Dodd-Frank Act, which then has made it more costly and more prohibitive for many of these firms to deploy capital throughout the economy and pick things up and create jobs. So the focus on private funds also makes the SEC's prioritize oversight of markets which are made up solely of sophisticated investors at the expense of less sophisticated investors who are perhaps, not perhaps, or are more deserving of efforts by the SEC to oversee markets. So what is needed? It's a modernization of the regulatory regime that oversees private funds, which would free up capital to invest in businesses and allow the SEC and other regulators to properly prioritize their finite resources. And that is what we have right here. Mr. Hurt's bill does that by removing the old, removing the outdated, removing the duplicative requirements placed on advisors to private funds, and this is important. It also modernizes the books and records requirements so that the SEC isn't probing for materials related to the advisor's due diligence on prospective investments. If you put it all together, these are common sense and they are, importantly, bipartisan reforms that I am pleased today, Mr. Chairman, to support, and I urge all members on both sides to do so as well. And with that, I yield back.
Would the gentleman yield to the chairman?
I yield to the chairman.
I thank the gentleman for yielding. I, too, wanted to add my voice and congratulate the gentleman from Virginia for his leadership, not just on this bill, but lo these many years in trying to help spur capital formation within our economy. Again, this bill is, in many respects, modest, common sense, helping modernize the act to better reflect today's current market environment. And I would remind all members that as they debate this bill and frankly many other bills that will come up during this markup, that we have 14 million people in America who remain either unemployed or underemployed 7 years after the financial crisis. Our economy has just grown at a dismal 0.8% in the first quarter of this year, a drop of over 40% from the already lethargic 1.4% reading for the fourth quarter of 2015. According to the Census Bureau, almost 15% of Americans, 47 million, remain in poverty. And we know that we have an SEC that has traditionally, frankly, been quite negligent in its promotion of one of its three charters, and that is to promote capital formation. I would say today, if we are given any quandary, if there's any doubt in any member's mind, should we err on the side of accredited investors, sophisticated investors, millionaires, or should we side for those who are unemployed and underemployed, I know which side I will choose, and I hope all members will choose as well. And so again, I want to thank the gentleman from Virginia. I remind all members, too, that all of the anti-fraud provisions that remain in statute. I know the ranking member was talking about Ponzi schemes. They remain illegal after, should this bill be enacted and signed into law. But what will change is the ability for entrepreneurs to access funds, to have greater capital formation within our economy, and probably the most desperate need we have today, and that is to get this economy moving yet again. So I thank the gentleman from Virginia. I thank the gentleman from New Jersey for yielding time. The gentleman yields back the balance of his time. Who seeks recognition? For what purposes the gentleman from Illinois seek recognition?
Mr. Chairman, I have an amendment at the desk. What?
Would the gentleman from Illinois for Bear, I think the gentleman from Minnesota wanted to have
Yeah, I want to move
comments on general.
last word.
No objection.
If the gentleman from Illinois would await to have his amendment distributed, I'll go to the gentleman from Minnesota for debate on the general problem. The gentleman from Minnesota is recognized for
I
5
thank the
minutes.
chairman for recognizing me. I also thank the ranking member. You know, I'm not prepared to vote yes for this bill. I think I'll vote against it for now. And the reason why is that, as explained and as I read the materials, it seems clear to me that Section 4 of the bill would ban the SEC from applying anti-fraud protections to sales of literature distributed to the general public and by private funds under the new general solicitation provisions of the Jobs Act, and also relax a number of other important provisions. You know, I tend to be skeptical when I hear arguments that if we get rid of regulation that is designed to protect the public, to protect investors, then what's going to happen is that extra money that will be retained by not having to comply is going to be somehow put into investment, which will lead to jobs. We're always told this is about jobs. And yet, you know, I don't think there's any evidence to believe that cutting taxes for the rich and cutting regulations is led to more jobs. In fact, I think the opposite is true. And I think if you want to ask yourself, why is the economy not growing faster, it's because of inadequate demand. It's because people don't have any money, because we have cut so many taxes and cut so many regulations for the wealthy that ordinary citizens haven't benefited, yet we've seen the biggest income inequality in our nation's history since the Great Depression, and ordinary citizens don't have any money. We have wage stagnation. We have people who are not adequately employed. We've also seen, I think, a historic amount of obstruction, almost no fiscal investment, which is normally how we get the economy moving again. And so I don't think that the reduction of relaxing these safety and financial protections rules is going to do much more than help people at the very top accumulate more money. And
Will the gentleman yield on that?
no, I'll speak a little longer, then I might yield if I have more time.
Okay.
And I don't think there's any reason to believe that this money's going to trickle down to the average person looking for a job. And so I would need much more justification. If somebody showed me relaxing this regulation is going to lead to this many jobs, and here is exactly how, I might one day vote for one of these kind of bills. But until then, it just feels like trickle-down economics to me. And do I have any more time left? Oh, yeah.
2 minutes,
yeah,
17
I'll certainly
seconds.
let the gentleman, I'll yield for a moment.
Well, thanks. And I'll just use a moment. So there's 2 pieces to it, and you're addressing on one of them, and I'm not going to try to rebut that right now. But the other one is,
I don't blame you.
well, let me just go down another road with you, because this is significant, I think.
All right.
We know there's limited resources at the SEC. And you're nodding head, yes.
Well,
We want to make sure.
There's a reason, though.
Yeah. But we want to make sure that those limited resources go to where they need to go to. And this is not just me saying this. Back when Dodd-Frank was going through, and the chair at the time of the sub was Paul Kanjorski from Pennsylvania, he was making this point far better than I could when he said, our mission here is not to use SEC resources to protect the rich and to protect the millionaires. Let's make sure that the small guy, the individual investor, the little guy, that's where the SEC is focused on. But instead, they're not. They're over here representing these rich families out there, and that's what we're trying. One of the points that the sponsor of this bill is trying to do is to focus them in the other area, and I think this bill does that.
Okay, I'm going to reclaim my last minute, and I think you've made your point well, and I thank you for doing that. Well, see, here's the thing. Oftentimes, there's this when you want to make kind of a populist argument that we're trying to look out for the little guy here. The reality is that when you allow people who are the most wealthy and most connected in the economy to not have any regulation, to not have any requirements or accountability, they often make decisions that hurt everybody else. I would argue that that is exactly what happened in the 2008 financial crisis. In fact, for years before, people saying, oh, we're big investors, we're sophisticated, we're going to operate arm's length, we don't need this regulation. No, I let you get in there. And then what happened is when things went downhill, it was the average person who not only had to bail them out, but lost their jobs, lost their homes, and lost everything else. We act like the financial crisis of 2008 didn't ever happen around here. Dodd-Frank was here to stop it, and so I'm not persuaded, and I'm not going to vote for it.
Time of the gentleman has expired. For what purpose does the gentleman from Ohio seek recognition?
Mr. Chairman, I move to strike the last word.
Gentleman is recognized for 5 minutes.
Thank you, Mr. Chairman. I want to thank the sponsor of this bill because I think it makes sense. I want to get back to the basics of what this bill is about and what this bill does and doesn't do. And the gentleman from New Jersey was moving that direction. I want to expound on that a little bit. We have several kinds of investors in this country. We have, normal, less sophisticated mom and pop investors, and we have what's called accredited investors in this country. Accredited investors are accredited because of their alleged sophistication. And the money that the SEC has should be spent to protect ordinary investors and not wasted on accredited investors, and that might help us prevent a Bernie Madoff in the future. In fact, one of the problems on Bernie Madoff was the SEC examinations were only taking place every 10 years for firms like Bernie Madoff. And if we pass this bill today, more money can be focused where it needs to, and they can actually shorten their exam schedule, and they can make sure that they look into those type of firms more frequently and actually look after consumers that are potentially at risk. This bill is about growing the economy. It's the gentleman from Minnesota talked like it was some kind of tax bill. This is not a tax bill. This is about reducing the compliance burden and the regulatory expenditure of resources that go toward accredited investors so that it can focus on ordinary investors. And it is ironic that the gentleman from Minnesota would talk about obstruction and a historic level of obstruction while he's obstructing this very bill. But we can and should make streamline the Investment Advisors Act by removing duplicative burdens, addressing practical concerns, and helping facilitate capital formation, which will help jobs. One of the biggest things I hear from businesses in Ohio's 15th district is they're having trouble getting access to capital. Well, if we can streamline the Investment Advisors Act, I believe it will help ensure more formation of capital, get businesses access to capital. And what do businesses spend that capital on? They spend it on capital goods. Well, who makes capital goods? American workers. They spend it on employment and jobs. Who is that? That's American workers. They spend it on maybe purchasing another company, and who benefits from that? The workers that have jobs if that company maybe needed to get an influx of capital. So this is about jobs. It's a good bill. It's a common sense bill. This is a streamlining bill. It's ironic that anybody would say that this is some massive change. This is frankly, moving around the edges. It helps. It's It is a big help, but it's only a streamline. So this is not a massive change, and it's ironic that folks would try to make it sound like it's some big problem when actually it's going to help make sure that our precious regulatory capital at the Securities and Exchange Commission can be used to protect ordinary investors, and this bill will make sure more money goes toward jobs. That's a win-win if you ask me. And I would like to yield some time to the gentleman from New Jersey if he seeks any time. He does not. Then I yield back, Mr. Chairman.
Gentleman yields back. Are there other members who wish to be heard on general debate before proceeding to amendments? For what purposes the gentlelady from New York seek recognition?
Thank you, Mr. Chairman. I move to strike the last word.
Gentlelady is recognized for 5 minutes.
Thank you very much. First of all, I want to thank Mr. Hurt and Mr. Vargas for their really hard work on this issue. And the bill makes a series of changes to the Investment Advisors Act of 1940, which are intended to make it more compatible with the private equity business model. I think there is probably space to better tailor the Advisory Act to private equity advisors, and I don't disagree with everything in this bill. For example, I think that some of the assignment provisions are sensible changes. Sophisticated investors and private equity funds should be able to waive the right to consent to transfer of a minority interest if they want to. And I believe that the revisions to Form PF make sense too. Large private equity funds have been filing additional information on systemic risk factors like leverage and the use of derivatives for a few years. And if you look at the data, it's pretty clear that large private equity funds do not pose a huge systemic risk. Their leverage is a fraction of the leverage of hedge funds, and large private equity funds have less than 0.5% of the derivatives that hedge funds have. But I do have serious concerns about other provisions in the bill, which makes sweeping changes to core aspects of a regulatory regime that has been extremely successful. In particular, I'm concerned about the changes to the books and records rule, which requires advisors to retain the records that SEC examiners need to determine if the advisor broke the law or violated its fiduciary duty. What in the world is the point of subjecting private equity advisors to a fiduciary rule if you can't hold them accountable for breaching that fiduciary rule and that duty and have the evidence to prove it? My good friend and colleague from Ohio talked about Mr. Madoff. Well, if we didn't keep Mr. Madoff's records, he wouldn't be in jail now. There wouldn't be any record of what he had done. So I think that this is a core safety net, really, for investors and for honesty, basically. I'm also concerned about exempting certain funds from the annual audit requirements in the custody rule. The custody rule is a long-standing investor protection that guards against outright theft of clients' money. And I think there's a high burden of proof if you want to roll this back. So I'm deeply concerned about that aspect. Also, I have a problem with exempting private equity advisors from the proxy voting rule for private securities. The proxy voting rule requires advisors to have a policy in place to deal with conflicts of interest when the advisor is voting on shareholder resolutions on behalf of the advisor's clients. Private companies still hold shareholder meetings where shareholders vote on corporate policies, and conflicts of interest exist whether the company is public or private. So there's no reason why private securities should get an exemption here. I really do not understand that particular addition. And if anything, private equity advisors are even more likely to have a conflict of interest when they're voting on shareholder resolutions for private companies, because the entire business model of private equity funds is premised on the fund having some level of influence on a company's management. These are core aspects of the Advisors Act, and personally, I do not believe that they should be discarded lightly. So while I think that there are some good things in this bill that merit further discussion, which I would support. I think that too many of the provisions go too far, and I've outlined 4 of them here. So I'm going to oppose this bill, and I yield back the balance of my time.
Gentlelady yields back. For what purpose does the gentleman from Illinois seek recognition? Gentleman is recognized for 5 minutes.
Thank you, Mr. Chairman. I want to thank Chairman Hurt, or Congressman Hurt, for introducing the Investment Advisors Modernization Act of 2016 and for his leadership in responsibly harnessing private equity for economic growth. Private equity funds are an important source of capital in the economy, especially in Illinois. Businesses in my state have been struggling since the Great Recession, and job creators across my district need all the tools available to employ my constituents so they can support their families and communities. According to the Private Equity Growth Capital Council, there are 1,150 private equity-backed companies headquartered in Illinois. It comes as no surprise that these companies pursuing innovative products and services support more than 800,000 workers at their facilities, including some jobs in other states. As I look around the hearing room today, I'm confident each of your districts has jobs, creators, and workers that are funded by private equity-backed companies. While the immediate picture in your mind's eye may be of a wealthy, well-dressed individual, let's not forget that everyday Americans also depend on private equity for things like retirement security. For example, the teachers' retirement system of the state of Illinois has nearly $40 billion in assets under management, with about $4.7 billion invested in private equity, with 160,000 active and 230,000 retired and inactive members. The State University's retirement system of Illinois also relies on its private equity investments for its approximately 200,000 members. Despite its oftentimes negative connotation, private equity is just a form of financing that tends to be misunderstood. Private equity funds are an important source of capital in the economy. Investors who have significant personal wealth or expertise are considered to be sufficiently sophisticated that they do not require the same level of protection that the securities law affords to other ordinary investors. We should have a regulatory regime that recognizes this. I appreciate Congressman Hurt's work on streamlining the outdated regulations that will make it easier to harness capital. In short, this bill modernizes books and records requirements, removes overly broad restrictions on assignments, adjusts outdated and duplicative requirements regarding any change in membership, modifies an advertising rule, appropriately tailors brochure requirements in Form PF, adds flexibility on personal securities transaction reporting, updates the custody rule, adjusts proxy voting rules, and prevents regulatory mismatch in advertising of funds. These changes will make it easier to invest in our communities, and these administrative savings certainly can be passed on to investors. We've heard supportive testimony from former Commissioner Gallagher in the Capital Markets Subcommittee hearing just last month. He testified that the bill would, and I quote, preserve the registration regime for private fund advisors while at the same time removing or modernizing in rather modest ways some of the more unnecessary, outdated, and overly burdensome requirements of the now 76-year-old Advisors Act that drive up costs for funds and investors and hinder the efficient allocation of capital to help grow businesses and create jobs, end quote. In closing, it's no surprise that this is a bipartisan bill, and I want to commend my colleagues, Congressman Hurt, Vargas, Stivers, and Foster, for their efforts. I urge all members of the committee to support this practical, job-creating legislation and yield back the balance of my time.
Gentleman yields back. Do any other members wish to be heard in general debate? If not, for what purpose does the gentleman from Illinois seek recognition?
Mr. Chairman, I have an amendment at the desk.
We will pause while the amendment is distributed. Is there any member who has not received a copy of the amendment? Not, the clerk will report the amendment.
Amendment offered by Mr. Foster, page 2, strike line 3 through 18.
Without objection, the reading of the amendment is dispensed with. The gentleman is recognized for 5 minutes on his amendment.
Thank you, Mr. Chairman. And I'd like to thank the gentleman from Virginia, Mr. Hurt, for working with us to address some concerns from our side of the aisle to make this a bipartisan effort. Although I voted against last year's bill to completely eliminate registration requirements for private equity funds, I co-sponsored this bill because private equity makes considerable, private equity, when properly regulated, makes considerable positive impact on investment in Illinois and specifically in my district. I would also like to thank my colleague, Mr. Vargas, for taking the lead in negotiating these changes, and again, Mr. Hurt for working with us to obtain a broader consensus on this bill. I, like many of my colleagues, am pleased to see investors bring in capital into our districts and work to create an environment that will improve the turnaround and expansion capability of these companies while keeping and increasing the jobs that come with it. So I'm offering this amendment to address concerns from my side of the aisle with two provisions of this bill. First, my amendment would strike Section 2A2 of the bill that would remove two classes of records from the requirement that they be maintained. While I understand that funds may want to remove the requirement to keep documents related to due diligence on, for example, investments that they end up not making, and there may be some alternative protections that would meet some of the SEC's objectives, but due diligence on deals which ultimately do not go through can still have commercial and legal significance, and many of my colleagues on my side of the aisle were concerned that this exclusion would be overly broad and could impede the SEC's ability to perform examinations at funds. My amendment would also strike the provision that changes the reporting period for trades by access persons from quarterly to annually. While I believe that the compliance operations at most funds probably review this information quite frequently, a more frequent reporting period will provide the SEC with more timely information about activities of the employees of the funds. Striking this provision will address concerns that the SEC would have less timely information about the activities of insiders who may be abusing non-public information. Again, I thank my colleagues on both sides of the aisle for working to broaden the support for this bill through reasonable changes. And with that, I ask my colleagues to support my amendment and urge support of this bill. I yield back the balance of my time.
Gentleman yields back. For what purpose does the gentleman from Virginia seek recognition? Gentleman is recognized for 5 minutes.
Thank you, Mr. Chairman. I'd like to thank my colleague from Illinois, Mr. Foster, for offering this amendment. During the process of working on H.R. 5424, I, along with Representative Vargas and Stivers, have been attempting to craft a piece of legislation that will garner as much bipartisan support as possible. We found that a few provisions within the bill were causing concern and have decided jointly to remove those provisions, and I thank Mr. Foster again for his leadership on this. In particular, we are removing the books and records provision that would have narrowed one of 20-plus categories of the rule by stipulating that investment advisors are not required to maintain certain communications regarding prospective investments. This amendment would simply continue the current regime, but I do hope that Congress will continue to evaluate the merits and risks of having investment advisors retain information pertaining to these investments that are often not made. Secondly, we are striking a subsection related to the reporting of personal securities transactions. The current law mandates a quarterly reporting system, and the change we are making merely removed the reporting from a quarterly basis to an optional annual basis. Again, this amendment would simply result in continuing the current regime. With these additional changes and the support of Representative Vargas, Stivers, and Foster, it is my hope that this committee will unanimously accept these changes and continue to work its will with the aim of helping facilitate capital formation and job creation. I ask my colleagues to support this amendment and yield back the balance of my time. Thank you, Mr. Chairman.
For what purpose does the ranking member seek recognition?
I move to strike the last word.
Gentlelady is recognized for 5 minutes.
Thank you, Mr. Chairman. This amendment strikes two provisions in the underlying bill that would have allowed private equity funds to destroy valuable investment records. I don't know why anyone would want to do that. And make it harder for the SEC to quickly detect insider trading. I just don't get this. While I support the amendment, I do not believe it goes far enough, as the bill continues to be a windfall for private equity funds who, as I mentioned earlier, have been the subject of numerous recent enforcement actions by the SEC since we first required them to register under the Dodd-Frank Act. This bill would still provide for a broad exemption from the SEC's custody rule, a rule that we saw was necessary in the wake of the Madoff scandal. It would still, in the words of the Institutional Partners Association, I quote, reduce alignment and transparency between funds and their investors, end of quote. And it would still make it tougher for the SEC to do its job in overseeing the private funds market. So I support the amendment. However, I continue to oppose the underlying bill. And let me just, in response to the gentleman from New Jersey who talked about the SEC and how it was spending its limited resources, the question is answered quite well in a speech that was given by Andrew Seresny, Director of the Division of Enforcement, who said, now, why is the SEC spending its limited resources on the private equity industry given the sophistication of most investors? Because it is important to understand that retail investors are significantly invested in private equity. For example, public pension plans frequently invest the retirement savings of their plan beneficiaries, which includes teachers, police officers, and firefighters in private equity funds. Similarly, institutional investors have increased their investments in private equity funds, often on behalf of retail investors who themselves are saving for retirement. Further, university endowments, which fund scholarships and other important academic programs, invest in private equity funds. So, if an advisor defrauds a private equity fund, the underlying victims frequently include retail investors who in many cases are not in a position to protect themselves. In addition, while the managers of these pension funds and other institutional investors who invest in private equity can be sophisticated, even experienced investors can be defrauded if they lack transparency into the various fees, expenses, and practices, which has been the case in the past. There is thus little question that private equity is an appropriate focus for the SEC. I think that says it all. And so while I support the amendment, it's still not enough to have me support this bill. And I want you to include into the record, Mr. Chairman, opposition from CalPERS, California Public Employees Retirement System, CalSTRS, the Teachers Retirement System, the Americans for Financial Reform, also the Institutional Limited Partners Association. And I yield back the balance of my time. I yield to the gentlelady from New York.
Without objection, they'll be included in the record. Gentlelady from New York is recognized.
Okay, I just want to compliment Mr. Foster on his very thoughtful amendment. It improves the bill. I cannot understand why in the world we would be destroying these records, but I'm still concerned about the provision that exempts certain funds from the annual audit requirement in the custody rule, which protects investors, and exempting the private equity advisors from the proxy voting rule for private securities and other measures in it. So it's a step in the right direction, but I still have concerns on the bill. But I do want to support this amendment. I yield back to the gentlelady. And then you yield back.
I yield back to...
Gentlelady yields back. Is there any further debate on the amendment? For what purpose does the gentleman from Ohio seek recognition?
Move to strike the last word, Mr. Chairman.
Gentleman is recognized for 5 minutes.
I'll be very brief. I want to thank the gentleman from Illinois for his constructive approach. This is a great amendment. It makes the bill even better, and I hope we all vote for it. I yield back.
Gentleman yields back. For what purpose does the gentleman from California seek recognition?
Thank you, Mr. Chairman. I move to strike the last word.
Gentleman is recognized for 5 minutes.
Thank you again, Mr. Chairman. I want to thank my colleagues for their comments, both in favor and against today. I think that they were very constructive. I know that some of my colleagues have expressed concerns, as they did today, with this legislation. And just yesterday, I learned that CalPERS and CalSTRS have concerns. I want to continue to work with everyone on this bill. I particularly want to thank my colleague, Representative Hurt, for introducing this bill, and I want to thank your staff. Your staff has worked very, very closely with my staff. I know they've been negotiating back and forth, and appreciate that very much. I know that my staff has been here late at night, and I know yours has too, because they've been on the phone together. So I appreciate, again, the work that you've been doing. Today we've heard a lot of things about this bill being a lot larger than it is. The truth of the matter is that this is a small amendment to something I think has to be amended, and I appreciate the amendment that my colleague, Mr. Foster, has put forward today. But this is not trickle-down economics. It doesn't, I don't believe in trickle-down economics myself. So certainly this is not it. I wouldn't be voting for it. It doesn't lower any taxes. In some cases, I believe you should lower taxes, but in most cases for the wealthy, I think you ought to raise them significantly. So I wouldn't be associated with the bill like that. But I do think that this makes changes that are important. One of the things that we see is that private equity is involved in a lot of these small and medium-sized enterprises. And these small and medium-sized enterprises, they do employ about 2/3 of the global workforce. And certainly in my district, you see that they're very, very important because oftentimes they have a very difficult time accessing finance and capital. So I think that this is a good step in the right direction. I certainly support it. I would only say that I think that we have to continue to work on it to see if we can garner more support. I certainly will continue to try to do that in good faith. I don't know that we'll all at the end of the day be able to sing Kumbaya, but I do hope that we can get something that most of us, if not all of us, can agree to and get it signed into law, because I do think that there are reforms that are needed here. And again, I want to thank all of my colleagues for their comments here, both those that were critical and those that were supportive. And again, I want to thank my colleagues that have worked so hard on this bill. Thank you very much. I yield back.
Gentleman yields back. Is there further debate on the amendment? If not, the question now occurs on the amendment offered by the gentleman from Illinois. All those in favor shall signify by saying aye. Aye. All those opposed shall signify by saying nay. In the opinion of the chair, the ayes appear to have it, and the amendment is adopted. Is there further discussion or amendments to the bill? If not, the question now occurs on ordering the bill as amended reported to the House with a favorable recommendation. Those in favor shall signify by saying aye. Aye. All those opposed shall signify by saying nay. In the opinion of the chair, the ayes appear to have it, and the ayes have it.
Mr. Chairman.
The bill,
Mr. Chairman.
for what purpose is the gentleman from Virginia seeking?
Just ask that for a recorded vote.
A recorded vote has been requested. All those in favor of recorded vote shall raise their hand and be counted. A sufficient number having raised their hands, a recorded vote is so ordered, and pursuant to subsection C5 of Rule 3 of the committee rules, the vote on this question is postponed. Now, pursuant to notice, I call up H.R. 4854. The clerk will report the bill which was distributed in advance.
H.R. 4854, to amend the Investment Company Act of 1940 to expand the investor...
Without objection, the bill is considered read and open to amendment at any point. The chair recognizes the gentleman from North Carolina, Mr. McHenry, to offer an amendment in the nature of a substitute. Does the gentleman have an amendment at the desk?
I have an amendment at the desk.
I have been informed that copies of the amendment have already been distributed and are on the dais. The clerk will report.
Amendment in the nature of a substitute offered by Mr. McHenry. Strike all after the enacting clause and insert the following.
Without
Section
objection,
1.
the amendment is considered read and will serve as base text for purposes of amendment. The gentleman from North Carolina is recognized for 5 minutes.
I thank the chairman. Thank you. Today's early-stage companies are not simply innovating existing industries, but actually creating entirely new markets. Thanks to angel investing in particular, the advancement in American technology and entrepreneurship is thriving. But funding these early-stage companies is challenging, obviously. Investing in startup companies is inherently risky, which is why wealthy investors who qualify to become angels often shy away from it. This is a major hurdle facing small and early-stage businesses that are struggling to find capital, particularly in parts of the country like my district in western North Carolina. There are pockets of the country that really are capital deserts, and we're trying to make sure that they are able to access capital for to create new jobs. In fact, media reports indicate that small counties like I represent have actually lost more businesses than they have created in recent years. This is problematic for the larger economy as well. And we must do everything that we can here in Washington to reverse that trend. Addressing the challenges facing angel investing is a great first step. That can be accomplished by changing our mindset and creating a regulatory framework that encourages innovation and growth while also ensuring that shareholder and investor protections remain strong. While the Jobs Act lifted the shareholder limit to $2,000 for privately held firms, it left in place the $99 investor limit for angel investing funds. As a result, many investors who want to become angels are excluded from investing, and many early-stage companies fail to acquire the capital they need to get off the ground. To address this problem, Ranking Member Waters and I have joined together in offering a bill that amends the Investment Company Act of 1940 by increasing the investor limitation from 100 to 250 for qualified venture funds. Our proposed amendment would help with this problem, this 99 investor limit problem. This bill would increase the cap of investors from 100 to 250 for accredited investors, applying only to qualified venture funds narrowly tailored to early-stage investing. While my original legislation enhanced the cap from 100 to 500, working with Ranking Member Waters, she had a number of things that actually improved the bill that enabled us to come to this compromise today. Thus, our proposed amendment would open up angel investing to more accredited investors, allowing for early-stage companies to raise the capital they need to grow and create jobs, both in her district and my district. That's the mindset here, is to help both her district and my district, and the rest of the country. Although the bill is a technical fix in many, many ways, we worked hard to seek compromise and find a common-sense solution to this complicated area of securities law. While we have negotiated a good working bill, my goal is to ensure that the language and operation of this compromise will work in the real world and have an impact on real people. I look forward to continuing this work to ensure that the law is useful and is a useful tool and serves as an example of how policy can meet the needs of small and early-stage companies across this great country of ours. The bottom line is that this bill is a sensible way forward. It will allow more diversification for angel investors, more access to capital for companies, and ultimately more good-paying jobs. I want to thank the chairman, I want to thank the ranking member, and I want to thank the committee staff on both sides of the aisle for working so diligently for this bipartisan compromise today. And additionally, I'd like to thank Congressman Schweikert for joining me as a co-sponsor of this bill. I urge the support. I yield back the balance of my time.
Gentleman yields back. For what purpose does the ranking member seek recognition?
Move to strike the last word.
Gentlelady is recognized for 5 minutes.
Mr. Chairman, I'd like to thank the gentleman from North Carolina for his leadership and the way that he's worked with us and other members of this committee on both sides of the aisle to produce this legislation. And so this legislation seeks to help our nation's startups and the venture capitalists who take a chance on them by providing an exemption for qualifying venture capital funds from the definition of an investment company. As I've repeatedly said, whenever we seek to promote capital formation by providing regulatory relief to companies, we must also ensure we appropriately balance the need to protect their investors. If we don't, investors will suffer, and ultimately, the very companies we sought to help will suffer as the market demands a higher premium to take on their higher risk. With this amendment, I believe that H.R. 4854 strikes that right balance, benefiting both startup companies and their investors. It does so by providing a narrow exemption for qualifying venture capital funds that have no more than 250 investors and only $10 million in invested capital. According to Angel's List, a similar structure is currently used today in private offerings to allow accredited investors to pool their money into a special purpose fund to invest together in startup companies. It is my understanding that both the companies and, importantly, the investors benefit from this structure compared with hundreds of smaller direct investments. Rather than having to deal with multiple investors for corporate actions such as acquisitions and expanding ownership, a company can simply deal with the fund manager who acts on behalf of investors in the fund and has a fiduciary duty to the fund. Investors also like this structure because it involves less monitoring and effort on their part, which may be significant considering that investors recognizing that most early-stage companies fail typically diversify among 30 to 80 companies. While promoting this structure, H.R. 4854, as amended, is appropriately tailored to venture capital funds, which must invest at least 80% of their committed capital in the equity of small companies. Under this bill, those funds must have no more than 250 investors and no more than $10 million in invested capital, ensuring that they are small enough that investors are able to monitor and manage their investments with the funds. These limits also make sure that we aren't opening up a loophole for genuine investment companies like mutual funds to avoid regulation, nor are we providing relief to other private funds like hedge funds that have very little restrictions and investor protection. So again, I'd like to thank Mr. McHenry for working with me to appropriately narrow the bill and encourage my colleagues to join me in supporting the amendment and the amendment bill. And I'd simply like to add that this is an example of both sides working with each other and working together to do credible reform, to assist small businesses, and to promote opportunities for venture capital to be invested in small businesses. And I would hope that we could work together to do more of this kind of legislation rather than simply appearing to get in the way of SEC when it is attempting to do the job that it has been organized and legislated to do. I yield back the balance of my time.
Gentlelady yields back. For what purposes, the gentleman from Texas seek recognition?
Move to strike the last word.
Gentleman is recognized for 5 minutes.
I'll be brief. I just wanted to thank the gentleman from North Carolina for his thoughtful bill. You know, one of the things that's, particularly with venture and startup companies, capital is very difficult to raise. And in many cases, those kind of companies are not eligible for traditional bank financing. And so the easier that we can make it for those companies to access capital, you know, the better job creators we can have in the future. So I would just thank the gentleman for his thoughtful bill, and I would encourage folks to vote for it. And with that, I'd yield to the chairman.
I thank the gentleman for yielding. I, too, wish to add my voice. Thank the vice chairman for his leadership on this issue. I also want to thank the ranking member and others on the other side of the aisle working with him on this. Again, it is a modest step forward in capital formation, economic growth. It's needed. I urge all members to adopt the amendment in the nature of a substitute and the underlying bill. I thank the gentleman from Texas for yielding. Gentleman yields back, who seeks recognition. There being no further discussion or amendments to the bill, the question now occurs on adoption of the substitute amendment offered by the gentleman from North Carolina. All those in favor shall signify by saying aye. Aye. All those opposed shall signify by saying nay. In the opinion of the chair, the ayes appear to have it. The ayes have it, and the amendment is adopted. The question now occurs on ordering the bill as amended reported to the House with a favorable recommendation. Those in favor shall signify by saying aye. Aye. All those opposed shall signify by saying nay. In the opinion of the chair, gentleman from North Carolina seeks a recorded vote. A recorded vote has been requested. All those in favor of a recorded vote shall raise their hand and be counted. A sufficient number having raised their hands, a recorded vote is so ordered, and pursuant to subsection C5 of Rule 3 of the committee rules, the vote on this question is postponed. Now, pursuant to notice, I call up H.R. 4855. The clerk will report the bill which was distributed in advance.
H.R. 4855, to amend provisions of the security law regulating...
Without objection, the bill is considered read and open to amendment at any point. The chair recognizes the gentleman from North Carolina, Mr. McHenry, to offer an amendment in the nature of a substitute. Does the gentleman have an amendment at the desk? I have been informed that copies of the amendment have already been distributed and are on the dais. The clerk will report.
Amendment in the nature of a substitute offered by Mr. McHenry. Strike all after the enacting clause, insert the following. Section 1.
Without objection, the amendment is considered read and will serve as base text for purposes of amendment. The gentleman from North Carolina is recognized for 5 minutes.
Thank you, Mr. Chairman, and I thank the committee. 5 years ago, I authored the primary legislation to legalize investment-based crowdfunding. That bill became a part of the Jobs Act and is now law. Regrettably, after the SEC issued its final rules, what is now Title III of the Jobs Act, investment crowdfunding, is far different than what I originally had in mind when I wrote my bill in 2011. With the work of my colleagues on the other side of the aisle, in 2011, we passed a bipartisan bill out of this committee and off the House floor. With the additions of amendments and suggestions by Congressman Perlmutter, with the additions and suggestions by Ranking Member Waters, and with additions and suggestions and a major amendment in particular by Congresswoman Maloney, we were able to pass that bipartisan bill, a compromise out of the House. Well, lo and behold, the Senate screwed it up. But it's been law and is law. And after reviewing it in a bipartisan way, watching the SEC, watching how they write the regs, getting feedback from the investing community and small businesses, we have today a compromise to update and fix what is existent law. This is a substantial undertaking we have before us. The finalized SEC rules have some significant structural problems that I fear, if not properly addressed, will make it extremely difficult for investment crowdfunding to take hold as it needs to in the United States. To address this issue, Ranking Waters and I have worked on legislation that fixes some of the problems with the SEC's finalized rules and the law as it stands in Title III of the Jobs Act. In particular, crowdfunding is suffering from the so-called 12G problem, and by which crowdfunded companies are subject to SEC reporting requirements similar to that of public companies, but at a very low asset threshold. This is costly. Our proposed amendment fixes the 12G problem by raising the asset threshold for both small businesses that already have revenue and for those startups that do not yet have revenue. This makes it more likely that high-growth companies will consider crowdfunding as an option for raising capital. Another significant problem for crowdfunding is that under SEC rules, single-purpose funds are not permitted. We addressed this in this discussion on angel investing. Ranking Members Waters brought this up, and ensuring that these special-purpose funds can have the impact and the necessary impact on informing investors. According to one crowdfunding portal, over 80% of the companies that were interested in investment crowdfunding dropped out when they were informed that single-purpose funds are not an option. Similar to angel funds, single-purpose funds allow investors to invest along with more sophisticated lead investors who have a fiduciary duty to advocate for their interests. That means better terms and greater transparency for those investors. Moreover, a single-purpose fund improves the cap tables for companies that hope to attract venture capital in the future. This helps. Our proposed amendment ensures that the single-purpose funds are allowed to participate in investment crowdfunding. This provides everyday investors the ability to team with more sophisticated lead investors and create another way to raise capital for small businesses. Although the proposed amendment does not include everything that I'd hoped for and that I'd worked for, after 5 years of watching this, analyzing it, what we have today is a bipartisan compromise to improve investment crowdfunding and to make those necessary corrections that need to occur now. While we've negotiated a good working bill, our work is not done. This committee is always in an ongoing process of watching what the regulatory bodies do, responding and reacting to the marketplace as well, and changing laws as necessary. We must continue to work as necessary to ensure that investment crowdfunding in particular realizes its true potential and meets the demands of American small businesses that seek to raise capital. Again, I thank the chairman, I thank the ranking member, I thank the great committee staff on both sides of the aisle that have worked diligently to make this a good bill, a necessary bill, and for us to get this done in a bipartisan way. Mr. Chairman, thank you. Thank you for your leadership, and I yield back.
Gentleman yields back. For what purposes ranking members seek recognition?
Move to strike the last.
Gentlelady is recognized for 5 minutes.
I would first like to thank Mr. McHenry for all of the work that he's done on this legislation. I thank him for the cooperation that he has demonstrated working with this side of the aisle, and I'm very pleased to join with him today. Mr. Chairman, equity crowdfunding, through which startup companies sell stock to hundreds of thousands of everyday people, has always been a high-risk, high-reward venture. We know that most startups fail, and as such, Congress over the decades has carefully tried to thread the needle as to how to guard less sophisticated investors from financial ruin. When we consider the Jumpstart Our Business Startups Act, or Jobs Act, in 2012, we heard testimony that cautioned us to ensure that we protect investors. I'm pleased that the SEC followed these warnings and implemented rules that protected investors by setting reasonable investment limits based on income and provided helpful disclosures for investors to weigh the risk. Last month, those rules went live. My amendment today is aimed at further enhancing the investor and company experience in crowdfunding. The main thrust of the amendment would authorize crowdfunding portals to pool investors together in order to make a joint investment in a company together. These vehicles would only make investments in one company and would be advised by a registered investment advisor with a fiduciary duty to the fund. Importantly, the investors would have the same rights to sue the company as if they had directly invested in the company itself. The other provision of the amendment would clarify that a crowdfunding company would not need to begin reporting as a public company until it had either a $75 million value or $50 million in revenues. This is consistent with the level set under Regulation A, another exempt offering for retail investors. This condition, however, like that for Regulation A, requires that crowdfunding companies stay current in its reporting to investors. Although crowdfunding is a highly risky space for retail investors, both of these changes will help provide investors with a larger choice of high-quality crowdfunding companies and a higher degree of finance savvy. I'd like to again thank Mr. McHenry for joining me on this amendment and look forward to working together on additional legislation to improve our capital markets. Mr. Chairman, I urge adoption of the amendment.
Gentlelady yields back. Who seeks recognition? Is that a salute of the Chairman will recognize himself for far less than 5 minutes to again congratulate the gentleman from North Carolina, the Vice Chairman. Crowdfunding is an incredibly important capital formation portal. We have to get the rules right. Something did go awry. I want to thank him, and for those on the other side of the aisle, including the ranking member, for working with him on this. I urge all members to adopt the amendment in the nature of a substitute and adopt the underlying bill. Is there further discussion or amendment? If not, there being no further discussion or amendment to the bill, the question now occurs on adoption of the substitute amendment offered by the gentleman from North Carolina. All those in favor shall signify by saying aye. Aye. All those opposed shall signify by saying nay. In the opinion of the chair, the ayes appear to have it. The ayes have it. The amendment is adopted. The question now occurs on ordering the bill as amended, reported to the House with a favorable recommendation. Those in favor shall signify by saying aye. Aye. All those opposed shall signify by saying nay. In the opinion, the gentleman from North Carolina seeks a recorded vote. A recorded vote has been requested. All those in favor of a recorded vote shall raise their hand and be counted. A sufficient number having raised their hands, a recorded vote is so ordered, and pursuant to subsection C5 of Rule 3 of the committee rules, the vote on this question is postponed. Now, pursuant to notice, I call up H.R. 5461. The clerk will report the bill, which was distributed in advance.
H.R. 5461, to require the Secretary of the Treasury to submit a report to the appropriate congressional committees on the estimate total assets under direct or indirect control by certain senior Iranian leaders and for other figures and for other purposes. Section 1, short title. This act may be cited as the Iranian leadership asset.
Without objection, the bill is considered read and open to amendment at any point. The chair recognizes the gentleman from Maine, the sponsor of the legislation, for 5 minutes.
Thank you, Mr. Chair, very much. I appreciate the opportunity to offer for consideration the Iranian Leadership Asset Transparency Act. Mr. Chairman, as we saw a short time ago with the Orlando terrorist attack, the horrific attack on our homeland, that we must do everything as a country and as a people to protect ourselves. Now, one of the ways to do that, Mr. Chairman, as we all know, is to do everything we can to prevent money flows to entities, organizations, and state sponsors of terror. Now, in my work on the task force to stop terrorism financing, it's become very clear to us in other news reports that the top political and military leaders in Iran have been accumulating substantial wealth at the expense of the people of Iran. For example, Mr. Chairman, Reuters reports that the Supreme Leader Khomeini has obtained this wealth through an entity initially created to help the poor. Now, I come from a very common sense state, Mr. Chairman, where sometimes sunshine is the best way to shed light on problems. Now, this bill is a very common sense bill that requires the Department of Treasury to list on its website in English and in 3 languages that are spoken in Iran, Farsi, Arabic, and Azeri. The assets, the names, rather, the assets of these top 70 or 80 political and military leaders in Iran, how they accumulated those assets, and what those assets are used for. I think, Mr. Chairman, that the world should know that the folks that run this country, the chief sponsor of terrorism in the Middle East, what they're doing with the assets they've accumulated through possibly illicit means. Now, this will also help global financial institutions to make sure they know if they're thinking about doing business with these individuals or that country, what type of individual they're dealing with. So with that, Mr. Chairman, I appreciate very much the opportunity to offer this amendment, and I encourage everybody on both sides of the aisle to consider this. It is a common sense bill that should determine, or rather elicit, everyone's support. Thank you, Mr. Chairman.
Gentleman, yield back.
I yield back my time. Thank you, sir.
For what purpose does the ranking member seek recognition?
I move to strike the last word.
Gentlelady is recognized for 5 minutes.
Mr. Chairman and members, the Iranian Leadership Asset Transparency Act would require the Secretary of the Treasury to report to Congress on the estimated total assets under direct or indirect control of certain Iranian political, business, and military leaders, regardless of whether they are subject to U.S. sanctions. This bill is more carefully scoped than the original draft that I strongly opposed. I continue to share the significant concerns that remain from the administration about the critical resources that would be diverted from targeting sanctionable conduct and compliance over existing sanctions in order to produce this report. Resources aside, I also share the administration's concern that this bill would likely be a strategic mistake. Iran likely would view this reporting as an attempt to undermine sanctions relief and inconsistent with both the letter and spirit of the Joint Comprehensive Plan of Action. Given the direct and personal targeting of this report, the bill would also likely evoke a heated reaction from the Iranian leadership, strengthen the hand of the hardliners, and undermine continued support for the JCPOA within Iran. Finally, the bill does little to meet its stated objective of making financial institutions required compliance with remaining sanctions more easily understood. If anything, the creation of a new list that would not necessarily be tied to any prohibition to the degree that any of it would be made public would increase confusion regarding compliance obligations and deter non-U.S. banks and businesses from re-engaging in legitimate business in Iran. Given the potential negative impact of this bill on Treasury's limited resources on Iranian efforts to implement the Iran nuclear deal, its diversion of energy away from investigations related to sanctions, and the report's lack of usefulness as a compliance tool, I very much share the administration's concerns and will be opposing this bill. I yield back the balance of my time.
Gentlelady yields back. For what purpose does the gentleman from Pennsylvania seek recognition?
Seek to strike the last word.
Gentleman is recognized for 5 minutes.
Thank you, Mr. Chairman.
I wish to add my voice of support for Mr. Poliquin's bill, which would require the Treasury to submit a report to the appropriate committees on the estimated total assets under direct or indirect control by certain senior Iranian leaders. The unclassified portion of this report shall be posted to the public. Iran is characterized by high levels of official and institutional corruption. Many members of Iran's senior political and military leadership have acquired significant personal and institutional wealth by using their positions to secure control of significant portions of Iran's national economy. Mr. Poliquin's bill would show the world and the people of Iran how the leaders of the Iranian regime are allocating and utilizing their financial assets. Sanctions relief provided through the Joint Comprehensive Plan of Action has resulted in the removal of many Iranian entities that are tied to government corruption from the list of entities sanctioned by the United States. Throughout the lifetime of this committee's task force to investigate terrorism financing, expert witnesses, such as Mark Dubowitz, have testified to Iran being a continued threat to the financial system. During our hearing, which was entitled The Iran Nuclear Deal and Its Impact on Terrorism Financing, Mr. Dubowitz said, this is a quote from him, "Once they're plugged back into the formal financial system, and by the way, we have not required them to actually rehabilitate, there's no indication that they're no longer engaged in illicit financial activities. And by the way, it wasn't just nuclear. It was ballistic missiles, it was terror financing, it was money laundering, it was sanctions evasion. That is the reason the central bank got designated in the first place, designated by our Treasury in a 311 finding. It wasn't just nuclear. It was actually a range of illicit financial activities that constituted the basis for that designation in the first place." So, Mr. Chairman, this is a bill that will provide a bit of transparency to the Iranian regime's use and allocation of financial assets, while informing the Iranian people of the corrupt practices that their leaders are engaged in. I'd like to thank the bipartisan group of members on the task force for the good work they've done, and I encourage the support of the bill. Yield back.
Was the gentleman from Maine seeking time? Would the gentleman from Pennsylvania yield time to the gentleman from Maine?
Yes, sir.
The gentleman from Maine is recognized.
Thank you, Mr. Chairman. Thank you, Mr. Fitzpatrick. I did want to mention, in response, Mr. Chairman, to comments that were made a moment ago, is that I don't think that this would be a drain on Treasury resources at all. They have a substantial budget to run Treasury, and this is only dealing with up to 80 individuals. Second of all, this has nothing to do with relief of sanctions. This is individual, separate, rather, information that will shed light on the corruption that's been going on among the top echelons of that government. And also, I think it's very important that the people of Iran and the world sees that what these funds have been used for. There have been very common reports about how they abuse human rights in that country and also fund terrorism throughout that part of the world. So I think it's pretty commonly understood, Mr. Chairman, and I think more information is better for the people of Iran, the people of the world, to continue to put pressure on a government that wants to do us harm and other parts of the world harm. Thank you, Mr. Chair. You're back my time.
Gentleman yields back to the gentleman from Pennsylvania. Gentleman from Pennsylvania yield back. For what purposes does gentleman from California seek recognition? Gentleman is recognized for 5 minutes.
I rise to support the bill. I've spent 20 years in this Congress, and all 20 years have been fighting against Iran's nuclear weapons program. This bill's a good step in the right direction. The signing the JCPOA does not mean that we should have an alliance with or protect or be worried about the feelings or hurt reputation of the leaders in Iran. We would hope that it would lead to a new leadership in Iran that would be more dedicated to peace. We are told that Iran would view this as an attempt to undermine the JCPOA. This comes from a feeling that we should overperform and do things not required by the bill, by the agreement, while Iran at best barely meets the letter and never meets the spirit of the nuclear deal. There is nothing in the JCPOA that says that we should not say critical things of the Iranian government. Under this report, we'll simply be saying them with detailed financial information. This is a this bill targets some of the corrupt entities in Iran, especially the Iran Revolutionary Guard Corps, which has the blood of many hundreds of Americans on its hands and is right now responsible for propping up an Assad regime that has killed hundreds of thousands and displaced millions. We need to bring to the attention of the Iranian people that their government is not only evil in our views, but is corrupt in the views of everyone. And in fact, some of the most evil elements in the Iran regime are some of the most corrupt. We criticize Iran all the time for human rights abuses, for Assad's butchery, for their human rights violations and their missile tests. What is the matter with criticizing them for their corruption, except that is a criticism that they don't want to hear? Now, we are told that this will inflame political debate in Iran. In Iran, they do mass marches screaming death to America. How much more inflamed are they going to be? Are they going to be shouting really death to America? Painful death to America? I would say that the Iranian leadership is inflamed when it is in their interest to be inflamed and does it all the time. This is an effective bill to bring to the attention of the Iranian people, who may very well be our allies, that their government is corrupt. In fact, there is nothing we could do to bring the Iranian people to our side than to help them deal with the corruption, which is the single biggest force in hurting their economy. And I look forward to an Iran that is reasonable, an Iran that reflects the views of its people, and a people in Iran that is informed. And if we inform them about the corruption of their leaders, I think that will be more effective than just informing them of the deaths of thousands of Syrians who are dead as a result of these same corrupt Iranian leaders. So I'll be supporting this bill, and I realize that it will take some resources from the Treasury Department. The Treasury Department is anxious to have us pass legislation that requires them to use resources if it's something they want to do, and always says that they don't have the resources to do anything they don't want to do. It is up to the appropriators to provide them with the resources necessary to do all the tasks that Congress has tasked them with, and this is certainly, compiling this report is not the most difficult or expensive or complicated thing that the Treasury Department will do. So we have the resources to do it. It will show the Iranian people how corrupt their regime is. The Iranian leaders will not like it, and this bill will perhaps lead to an Iranian people that at some point no longer puts up with this evil regime, and I yield back.
Gentleman yields back. For what purpose does the chairman of the House Foreign Affairs Committee seek recognition?
Mr. Chairman, if I could move to strike the last.
Gentleman is recognized for 5 minutes.
Mr. Chairman, I would just make an observation on Congressman Brad Sherman's reflection here. It is true that on Fridays, as you pointed out, they do this Death to America rally, but I think part of the problem is they could add Thursday or maybe Wednesday to the schedule. But on the other hand, as Mr. Sherman has raised over the years, as we've looked in and dug into this issue, we do have a situation in Iran today where Iran's supreme leader controls what is a $95 billion business empire. It's called the execution of the Imam Khomeini's order, the Sitold, as they call it in Farsi. And that holds stakes in every sector, every major sector of the Iranian economy: finance, oil, telecommunications. This accumulation of wealth has come from confiscated property and assets. And I would just point out that
nearly every member of the House has voted for a similar provision to what Congressman Poliquin and Fitzpatrick have put in this effort here to shine a light on the endemic problem of corruption in Iran. We had that vote, and we passed it off the floor on a vote of 400 to 20 in July of 2013. This was developed by the Foreign Affairs Committee, myself and Mr. Sherman and other members. The human rights sanctions contained in that legislation required reporting on the conduct of specific Iranian government officials and their estimated net worth. So corruption in Iran has not improved since that time when we overwhelmingly passed that legislation. And I thank the gentleman here for, shining a light on this. I think Iran's formal and informal economy is frankly a breeding ground for corruption, for nepotism, for foreign companies that should be wary of approaches by government officials who demand bribes or fixes, as we know, who would then pay bribes on behalf of foreign companies. Many of Iran's top officials have thrived in this environment of corruption, in this environment of nepotism. So it's become the way that people in Iran, or not the people do business, is the way that those who are tied into the regime do business. It's the people that we would like to assist, but they're only going to be assisted if there is transparency in what's going on. If a U.S. or foreign company or their subsidiaries were to engage in this behavior, they'd be potentially subject, of course, to penalties under the U.K. Bribery Act or our Foreign Corrupt Practices Act, as we know. It is, frankly, why the information itself is so important. It's why it's so important for Persians, for Iranians to know this information. It provides the necessary transparency and highlights the corruption risk of doing business in Iran for foreign companies. And it publicly highlights the cost of regime-based corruption for who? For the Iranian people, so that they can understand the consequences of this. That's what manages to surface under the exposure and the sunlight of this legislation. I think it's critical to ensuring that companies that are seeking to do business there are fully aware of the risks they face, but it's even more critical for the people in the country to understand exactly what is happening in country when you have that kind of accumulation of wealth through the seizure of all those companies and assets and its transfer not only to the Ayatollah, but to his allies there that run the government. So I urge my colleagues to support the bill, and I yield back. And I thank Mr. Sherman for his comments.
Gentleman yields back. For what purpose does the gentleman from Arkansas seek recognition?
Move to strike the last word.
Gentleman is recognized for 5 minutes.
I thank the chairman. I thank Mr. Poliquin for his work. I thank Chairman Fitzpatrick for his work on the Terrorism Finance Task Force, of which I'm proud to be a participant and a member, and for Mr. Lynch's work there as ranking member on the task force, and for Mr. Sherman's comments of a few minutes ago. You know, this to me is such a common sense thing to do when you consider that this administration just 6 years ago this month turned its back on the people of Iran when they were trying to protest their notorious regime and took to the streets, but then turned right around to negotiate with the Ayatollahs on a failed, ill-conceived, misdirected, poorly designed disaster of an Iranian transaction, fueling Iran as the world's largest supporter of terrorism. Unbelievable. So Mr. Poliquin's effort is straightforward and helpful, and directly helpful to the mission of the Treasury's Office of Terrorism and Financial Intelligence, where they have some $117 million budget. And I don't believe Mr. Poliquin's direction through this legislation to that office or FinCEN is overbearing in any ways whatsoever. It echoes their mission. To ask them to complete a report 270 days from enactment of legislation and then updated annually is certainly no burden to our U.S. Treasury. As Representative Poliquin says, it only covers 80 individuals that this nation wants to know what's going on with because they're back in the system, as noted earlier by Mr. Fitzpatrick. The Revolutionary Guard and the Quds Force are two of the most dangerous entities known in the world today. And we want to make sure that what's happening there is known not only to the world, but to the Iranian people. And therefore, I think it's particularly splendid that this will be translated in local languages and posted for all to see in Iran so that they can see what we see, which is that it is the most corrupt terror regime in the world. And that the sanctions relief benefited not the people of Iran, but directly this big 80 on Mr. Poliquin's bill. So, Mr. Chairman, I yield back my time, but I want to thank Mr. Poliquin for his efforts on behalf of not only sunshine on terrorism and terror finance, but sunshine for the Iranian people, and that they are educated and see what in fact goes on behind the closed doors of their regime. I yield back.
Would you yield to the chairman?
I would yield to the chairman.
I thank the gentleman for yielding. Again, I want to thank the gentleman from Maine for all of his contributions to this committee, but particularly his leadership on this issue, and thank Chairman Fitzpatrick as well, all the members of the Terrorism Finance Task Force. I must admit that I have been struck by the irony in this debate of those who would demand greater reporting and transparency of angel investors in private equity, those who would help grow the American economy, but demand less accountability and transparency from those who support the greatest state-supported terrorist finance organization in the world and one of the most corrupt regimes in the world. I find that to be quite ironic. Again, I want to thank the gentleman from Maine for his leadership. We in America have to do everything we can to expose this regime for what it is, to show our support for the millions of the Iranian people who long for a better day in a different regime, for those who do not wake up shouting death to America and death to Israel. We need greater transparency. We need greater reporting. We need a greater revelation into the insidious insides of this state supporter of terror. And this is a modest bill that will do this, using very, very modest resources. So again, I thank the gentleman from Maine for his leadership. I thank the gentleman from Arkansas for yielding time. Who seeks recognition? For what purpose does the gentleman from North Carolina, the Vice Chairman of the Terrorism Finance Task Force, seek recognition?
I move to strike the last word.
Gentleman is recognized for 5 minutes.
Thank you, Mr. Chairman. Thank you, Mr. Poliquin, for this outstanding legislation. You know, any reticence to impose accountability on Iran is like you're dealing with your favorite great aunt, the sweet, precious lady that you don't want to offend or hurt. You want to be so thoughtful to. And here's a regime who's been responsible as the nation state far greater than any in our modern history of providing funding to their surrogate terrorist allies throughout the world. They've been able to send out tens of millions of dollars. You know, they were given $600 million a month for 17 months just as a precondition to come and to negotiate. And we saw what happened with that money. Now they'll receive $100 billion plus. They have the access through SWIFT authority, through some of their independent banks, to transfer this money around the world. This is of great concern to us on the Terrorism Task Force. We recognize the role that they played. We realize that these mullahs will do anything to affect their ascent to power and to create their own manifestation of terrorism throughout the world in contrast to what our interests are. So I would plead with the other side to recognize who we're dealing with. We have given them every opportunity to be enjoined with the United States with this joint agreement. They have used every opportunity in that regard to try to seek their own interest and advantage and been successful in doing so. And I think it's a time that we impose some accountability. So I appreciate the role that has been played by Mr. Poliquin now to support that. We cannot tolerate a country who has been replete with corruption and human rights abuses to continue and to believe that they're going to be different tomorrow than they were yesterday. Thank you, and I yield back.
Will the gentleman yield for a question?
Yes, I will.
The chairman has talked about the need for transparency, but is it true that once this information is gathered, obtained, et cetera, that it would be classified?
I'm going to yield to Mr. Poliquin.
Thank you for the question. There will be a section on the Treasury website as dictated by the bill that will remain classified and will not be made public to anybody. So there will be no problem about the disclosure of information that is unclassified.
So, if I may, does this answer or deal with the question of transparency that the chairman was referring to in his remarks?
I think it does, and thank you very much for the question. Anytime we have more information on people who are trying to kill us, such that their own citizens can see how the assets have been accumulated, what the assets are being spent on, that is a good thing for our country. It's a good thing for the world. It's a good thing for the financial institutions who may consider doing business with these corrupt individuals at the top of the political and military chain in Iran.
So I suppose
Will the gentleman from North Carolina yield to the chairman?
Yes, I will.
It is my understanding that under this bill that part of this would be public, part of a public database. Some of this information is gathered from other public sources, and so there is transparency to the public there. And in addition, parts of it will be classified, in which case it will be transparent to policy makers who have to deal with this largest state supporter, financier of terrorism. And if the gentleman from North Carolina would yield to the gentleman from Maine to confirm the chair's thoughts on the legislation.
Gentleman yields.
Thank you, Mr. Chairman. I so confirm and would also request a recorded vote, Mr. Chairman, on this bill. Thank you.
At the appropriate time, the gentleman from Maine will be recognized for that. Does the gentleman from North Carolina yield back?
Mr. Chairman, I would like to retain my time for just a moment. I would like to say that there'll be 100,000 people in Paris this July is a strong demonstration for democracy in Iran. This administration has yet to send someone there. I'll be there with other members of Parliament throughout the world. And we need to show strength and support for the people of Iran.
Time of the gentleman has expired. For who seeks recognition? For what purpose does the gentleman from Texas seek recognition?
Move to strike the last word.
The gentleman is recognized for 5 minutes.
Thank you, Mr. Chairman. As a member also of the House to investigate terrorism financing, I thought it was necessary to speak in favor of Mr. Poliquin's bill. Over the last year and a half, our task force has heard testimony from countless witnesses about the lack of transparency when it comes to terrorism financing. I don't think anyone in this room believes Iran or its senior military leaders are being 100% honest with us. They have known to sponsor a wide variety of terrorist acts and organizations, and it's important to know where the money is flowing from. Mr. Chairman, last July, the task force held a hearing on the Iran nuclear deal and its impact on terrorism financing. The members that attended that hearing heard over and over how dangerous easing restrictions on Iran would be. In addition, time and time again, we've heard how influential Iran is throughout the developing world. And just last week, the task force heard testimony about the threats we face in our own backyard, such as countries in South America where groups like Hezbollah operate with impunity. There is evidence terrorist groups receive funding, training, and financial support from Iran and its senior officials. Iran has taken advantage of weak borders in South America, weak central governments, and a local network of loyal supporters. Connections between Iran and Hezbollah are constantly reinforced by the steady stream of Iranian senior clerics who visit the region often. Congress needs to know, I repeat, Congress needs to know where this money is coming from and how best to stop it from flowing. Although we will never know how much money these senior clerics and officials actually pose, this proposal will allow for fund and assets to become more transparent and allow the Treasury Department to provide additional information to Congress. Again, Mr. Chairman, I appreciate the support this committee has given to this issue. I know for me personally, many of the topics we have discussed have been eye-opening. Although this bill makes a small change, I believe it will go a long way. Thank you, Chairman. I yield back the balance of my time, and I'm glad to support this bill.
Gentleman yields back. Who seeks recognition? There being no further discussion or amendments to the bill, the question now occurs on ordering the bill reported favorably to the House. Those in favor shall signify by saying aye. Aye. All those opposed shall signify by saying nay. In the opinion of the Chair, for what purpose the gentleman from Maine seek recognition?
Mr. Chairman, I seek a recorded vote for this bill, please.
A recorded vote has been requested. All those in favor of a recorded vote shall raise their hand and be counted. A sufficient number having raised their hands, a recorded vote is so ordered, and pursuant to subsection C5 of Rule 3 of the committee rules, the vote on this question is postponed. Now, pursuant to notice, I call up H.R. 5421. The clerk will report the bill which was distributed in advance.
H.R. 5421, to amend the Securities Act of 1933 to apply the exemption from state regulation of
Without objection, the
securities.
bill is considered read and open to amendment at any point. Chair now recognizes the gentleman from California, Mr. Royce, the sponsor of the legislation, for 5 minutes.
Chairman, I move to strike the last word.
Gentleman's recognized for 5
Thank
minutes.
you, Chairman, for recognizing me. You know, government's often pretty slow to change with the times, but the market is not. So static regulation often does not keep pace with innovation. One example of that is that a lot has changed since 1996, when Congress amended the 33 Act and exempted 3 specific stock exchanges by name from state-by-state regulation. 2 of the 3 exchanges have merged since that time, and that's how out of date these references are. The SEC's interpretation of the law has created a 2-tiered playing field by giving this blue sky exemption only to the 3 exchanges which existed in 1996. It was not the intention of Congress to create such a carve-out. This bill, the National Securities Exchange Regulatory Parity Act, rights that wrong. It provides clarity around the exemption, which will now apply to all securities listed on a national exchange regulated by the SEC with commission-approved listing standards. Why is this exemption important? You could ask anyone from Massachusetts who tried to invest in a little company called Apple during its IPO. State regulators banned the stock for being too risky. Making it clear this exemption applies to more than just 3 specific exchanges also encourages new exchanges to become listing venues and a source of capital for companies looking to go public, or companies that are going to expand, or they're looking at hiring more workers. So I urge my colleagues on both sides of the aisle to support this common sense technical fix. It's good for market competition, it's good for capital formation, and I look forward to working with the ranking member towards a unanimous floor vote, I hope. And with that, Mr. Chairman, I yield back.
Gentleman yields back. For what purpose does the ranking member seek
I
recognition?
move to strike the last word.
Gentlelady is recognized for 5 minutes.
Mr. Chairman, I move strike the last word. It is my understanding that H.R. 5421 is intended to be a technical fix, and maybe that's why the bill was only shared last Thursday. The bill is intended to address a 1996 law that explicitly listed out 3 exchanges whose robust standards for listing securities were sufficient to exempt state regulation, and that required any other exchanges to prove to the SEC that its standards were just as robust to deserve state preemption. Now, I realize that we have well more than 3 exchanges, and it may not make sense to judge them according to the 3 exchanges that we listed in the 1996 law. but H.R. 5421 does nothing to guide the SEC in how it should otherwise judge them for state preemption. Rather, the bill would remove the baseline standard, and with it, how the SEC interprets that standard to require certain core quantitative thresholds relating to, for example, revenue, market capitalization, number of shareholders, and share price. However imperfect the current framework is for state preemption, I do not believe we should simply remove it and replace it with nothing. At best, doing so will create confusion. At worst, a race to the bottom as exchanges try to compete for business by lowering their listing standards. What's more, if the SEC were to approve venture exchanges, whose very business model is based on lower listing standards for smaller companies, it would have to preempt the states, notwithstanding the fact that their oversight over these companies. For these reasons, I do not believe that the bill is a so-called technical fix and would urge my colleagues to join me in opposing it.
Gentlelady yield back. Does the gentlelady yield back?
I yield back the balance of my time.
For what purpose does the gentleman from Illinois seek recognition?
Move to strike the last word.
Gentleman is recognized for 5 minutes.
Thank you, Chairman Henserling. I want to thank the Chairman of the Foreign Affairs Committee, Mr. Royce, for introducing the National Security Exchange Regulatory Parity Act of 2016. This is a common-sense technical fix to a 20-year-old statute that didn't foresee, or at least didn't contemplate, an increase in the number of exchanges and today's competitive market structure. The Securities Act of 1933 exempts certain securities from individual state-by-state registrations, which we commonly refer to as blue sky exemption. The Act also enumerates specific securities exchanges that existed when the provision was enacted back in 1996. Currently, exchanges not enumerated by the Act must have substantially similar listings standards as those that are specifically named in the Act. This puts these exchanges at an unnecessary government-created competitive disadvantage. It functionally prevents exchanges that are not named NYSE or NASDAQ from being the first mover in adopting innovative listing standards. The unintended consequences of Congress's amendment to include specific references to just a few exchanges is a two-tiered and unfair treatment to new exchanges that have since registered with the SEC. For example, the Chicago Stock Exchange under current law cannot make changes to its listing standards before NYSE or National Market System of the NASDAQ stock market makes changes to its listing standards. Only then can the SEC deem these standards to be substantially similar. The Chicago Stock Exchange could then request SEC determine their listing standard is consistent with the Exchange Act of 1934. Without objection, Mr. Chairman, I'd like to enter a letter of support from the Chicago Stock Exchange into the record.
Without objection.
And a brief excerpt explaining the importance of this bill. And I quote them. It's, quote, is currently CHX, or the Chicago Stock Exchange, is not a primary listing exchange for any securities in part because such securities would be subject to both federal and state regulation, which is prohibitively costly and overly burdensome to potentially listing companies. This change would remove this current impediment to companies listing their securities on CHX and would help in the exchange's efforts to develop a robust primary listing market here in Illinois, end quote. I'm proud to support such a common-sense technical fix that will increase access to the capital markets in Illinois, but this is not just an issue for the Chicago Stock Exchange. For example, the last 10 years, BAT's Global Markets with headquarters in Missouri has grown because of a number of innovative approaches, including new ideas for its listing standards. This simple change proposed by this bill would put any exchange or future exchange on level playing fields that those listed in the 20-year-old statute. This bill is about improving access to capital by creating a level playing field, and nothing in the bill should be construed as weakening consumer protections or reducing the authority of the SEC. Securities listed on a national securities exchange will continue to be subject to substantial and significant oversight by the SEC and the exchange in which they are listed. It's important to emphasize that the SEC would still have to approve any changes in listing standards, just as they do now. Furthermore, securities listed and traded on national securities exchanges are generally subject to the Sarbanes-Oxley requirements, such as audited financial and corporate responsibility requirements and enhanced financial disclosures. Additionally, the 34 Act requires, among other things, that the rules on a national securities exchange be designed to promote just and equitable principles of trade, to remove impediments to and perfect the mechanism of a free and open market and a national market system, and in general to protect investors and the public interest. Securities registered with the SEC and listed on an exchange are also subject to the robust disclosure obligations, such as filing Form 10-K, quarterly reports on Form 10-Q, and current reports on Form 8-K. We want to make it easier for companies to access the capital markets. Congress made this explicitly clear when passing the Jobs Act. And while the Jobs Act makes it easier for companies to raise capital in the early stages of its growth, we should not have artificial impediments such as those addressed by H.R. 5421 when they are ready to list on a national securities exchange. I'd encourage all my colleagues to support Chairman Royce's common sense legislation, and I yield back the balance of my time.
Gentleman yields back. For what purpose does gentlelady from New York seek recognition?
I have an amendment at the desk.
We will pause and allow the amendment to be distributed. Is there any member who has not received a copy of the amendment? The clerk will report the amendment.
Amendment offered by Mrs. Maloney, page 1, line 7, straight second.
Without objection, the reading of the amendment is dispensed with, and the gentlelady is recognized on her amendment.
Thank you, Mr. Chairman. I like this bill, and I like the intent of it. My concern is that we just got the bill on Thursday, and I feel that we need to do a little more work to get everybody on board and supporting it. And my amendment, which I'm going to withdraw, would simply require the SEC to use their existing authority to establish minimum listing standards, which will replace the standards at the 3 exchanges listed in the statute that the bill removes. I think the intent of the bill is a good one, listing 3 specific exchanges in the statute and requiring every other exchange to match their listing standards, I believe is not an ideal system. The SEC already has the authority to establish rules on listing standards in order to protect investors and promote public interest. If we remove the floor on listing standards that is currently set by the 3 specific exchanges referenced in the statute, then we all hope and expect that the SEC would use its existing authority to establish a new floor. My amendment would simply ensure that the SEC does this by requiring them to write this rule. But I'm going to withdraw the amendment because I want to keep working on this before we go to the floor, because I believe with a little more work we can all get a yes on this bill, but we need more time to work on it. So I withdraw my amendment, and I yield back the balance of my time.
Would the
gentlelady's amendment is
I yield
withdrawn.
to the gentleman.
Thank you, Chairman. And let me say, I understand the gentlelady from New York's concerns on this, and I look forward to working with you and working with the ranking member toward a unanimous vote on the floor, which I believe can be achieved. And I thank you for the dialogue on that.
Thank you, and I thank the gentleman for his work on this issue. Thank you.
With that, I yield back.
I yield back.
The amendment is withdrawn. The gentlelady yields back. For what purpose does the gentleman from Arkansas seek recognition?
Move to strike the last word, Mr. Chairman.
Gentleman is recognized for 5 minutes.
I thank the chair, and I thank the chairman of the Foreign Relations Committee for this worthy bill to correct what is an anomaly in the 1996 National Securities Market Improvement Act, which really unintentionally created, in my view, classes of exchanges. You know, if the commission approves the IEX application as the newspapers report, that would become the 13th exchange operating out in the United States. And this is something this committee should stay focused on, because I don't believe our laws are keeping up with the innovation in our financial markets and that's really not a good place to be. So in my judgment, H.R. 5421 is a common sense approach to make this technical correction, and in my view, it's not going to result in a race to the bottom for listing standards. The Commission would never approve meaningless listing standards. It's too important to our capital market system. And, for example, securities registered with the SEC still must comply with Section 5 of the Securities Act of 1933. And once listed on an exchange, the ongoing disclosure obligations are set forth in Section 12 of the Exchange Act. So there are protections there for investors and for the investing public. But as noted, I have this fear of the unintended consequences that my friend from Illinois talked about, where the possible unintended consequence would find the staff, the SEC staff, interpreting that they have to compare competitors before granting state preemption, which would eliminate these newer exchanges, now soon to be 13 total exchanges, a real barrier to either innovate or to enjoy any kind of a first mover advantage if they were not the original exchanges named in the statute. So with those comments, Mr. Chairman, I support the bill, and I urge my colleagues to do likewise, and I yield back the balance of my time.
Yeah.
Gentleman yields back. Or is there any further discussion, any further amendments? If not, the question now occurs on ordering the bill reported favorably to the House. Those in favor shall signify by saying aye. Aye. All those opposed shall signify by saying nay. In the opinion of the chair, the ayes appear to have it. For what purpose, gentleman from California? A recorded vote has been requested. All those in favor of a recorded vote shall raise their hand and be counted. A sufficient number having raised their hands, a recorded vote is so ordered, and pursuant to subsection C5 of Rule 3 of the committee rules, the vote on this question is postponed. Now, pursuant to notice, I call up H.R. 5311, and the clerk will report the bill which was distributed in advance.
H.R. 5311, to improve the quality of proxy advisory firms for the protection of investors in the U.S. economy and in the public interest.
Without objection, the bill is considered read and open to amendment at any point. The chair recognizes the gentleman from Wisconsin, Mr. Duffy, the sponsor of the legislation, for 5 minutes.
Thank you, Mr. Chairman. My bill, the Corporate Governance Reform and Transparency Act, which I introduced with my good friend from Delaware, Mr. Carney, will foster accountability, transparency, responsiveness, and competition in the proxy advisory firm industry, thereby improving corporate governance and protecting investors. The role of proxy advisory firms in the U.S. economy and in shaping corporate governance is of significant national importance. These firms counsel pension plans, mutual funds, and other institutional investors about how to vote the shares of publicly traded companies that they own. Proxy advisory firms fill an especially important role for institutional investors who have increasingly relied on proxy advisory firms to help them analyze shareholder proposals and carry out their voting responsibilities on key decisions such as mergers and acquisitions, executive compensation, and approval of corporate directors. As the share of institutional investor ownership has grown from roughly 46% in 1987 to 75% today, the volume of proxy votes which investors are responsible for casting has grown into the billions. Last year, a Stanford University study of institutional investors demonstrated that for the average asset manager with $100 billion or more under management, the portfolio managers who make the investment decisions are involved in only 10% of voting decisions, which means a majority of the decisions are made by these proxy advisory firms. Those voting decisions, and in some cases the execution of those votes, have been outsourced and are often effectively controlled by proxy advisory firms like Institutional Shareholder Services, better known as ISS, and Glass Lewis. Last month, the Capital Markets Subcommittee, led by our chairman of the subcommittee, Mr. Garrett, held a hearing on proxy advisory firms, and we heard from witnesses about their history of issuing a one-size-fits-all recommendation. So, for example, Dodd-Frank included a provision which afforded shareholders an opportunity to decide if votes on compensation should occur on a 1, 2, or 3-year frequency, but proxy advisory firms have issued blanket recommendations on a once-a-year vote, which has frustrated congressional intent and shareholder rights. And by the way, has helped proxy advisory firms who now get to offer recommendations every year instead of every 3 years. We also heard about the practice of activist hedge funds offering special compensation schemes for dissident director nominees who would receive large payments if the activist goals were met. And while the SEC has held roundtables and issued staff guidance to address concerns about proxy advisory firms, we heard from former SEC Commissioner Dan Gallagher that the Commission needs specific statutory authority to oversee proxy advisory firms, which is what Mr. Carney's bill and mine offers. It's important because proxy advisory firms aren't immune to conflicts of interest. For example, in addition to providing recommendations to institutional investors about how to vote, proxy advisory firms may advise companies about corporate governance issues, rate companies on corporate governance, help companies improve those ratings, and advise proponents about how to frame proposals to get the most votes. Add to this the inaccuracies sometimes included in the underlying information proxy advisory firms use to issue recommendations. That is why our bill would require each proxy advisory firm to employ an ombudsman to receive complaints about the accuracy of voting information used in making recommendations and resolve those complaints before voting. This is in the interest of the issuers and their shareholders. Let me be clear. My bill is in no way intended to limit access to proxy advisory services. In fact, my bill recognizes the importance of these firms to corporate governance and to the economy. Specifically, my legislation will ensure that proxy advisory firms are registered with the SEC, disclose potential conflicts of interest, maintain a code of ethics, and make publicly available their methodologies for formulating proxy recommendations and analysis. Contrary to claims by opponents that this legislation will make the proxy advisory firm industry weaker, my bill recognizes the duopoly that exists today. Just 2 proxy advisory firms control 97% of the market. It's hard to imagine how you can have a less competitive industry. Now, opponents of our legislation have criticized the private right of action provision in the bill. I've heard that complaint, and after much debate and discussion about this issue, I know that an amendment is going to come from Mr. Foster. I plan on supporting that amendment that would strike that provision. And with that move and an effort to make this more bipartisan, I hope my colleagues across the aisle and on this side of the aisle will support this very common sense bill that supports transparency, accountability, and better corporate governance. With that, I yield back.
Thank you. The gentleman yields back. The gentlelady from California is why you seek recognition.
I move to strike the last word.
Gentlelady is recognized.
Mr. Chairman and members, while I appreciate the work that the gentleman from Delaware, Congressman Casey, has put into this legislation, I must oppose this legislation because I think it will be detrimental to investors. Indeed, these investors have written to the committee and said as much. The Investment Company Institute, representing mutual funds and other investment companies, has written to this committee to express concerns with the bill. And we've heard from many public pension funds, including the California State Teachers Retirement System, as well as public pension funds from Florida, Washington State, Colorado, Vermont, New York, Ohio, Oregon, and others, expressing concern that H.R. 5311, if enacted, would impede their ability to purchase unbiased and competent research to help inform their proxy voting decisions. We're talking about the votes to elect candidates to boards of directors, votes on issues like Dodd-Frank, say on pay, and numerous other measures, including shareholder proposals. This bill is premised on the belief that shareholders are too powerful and that proxy advisory firms in providing voting recommendations reflectively serve activist shareholder interests. This is simply factually incorrect. Indeed, the big proxy advisory firms, for example, only recommended no votes on say-on-pay proposals around 12% of the time. That means they side with the company management 88% of the time. And within that 12%, shareholders only vote to reject those say-on-pay proposals about 3% of the time. Moreover, when it comes to director elections to boards, One large proxy firm recommended yes, votes more than 90% of the time, and no votes less than 10% of the time. And these recommendations are supplemented by in-house researchers. BlackRock has written to 600 or more companies urging them to have personal meetings before meeting with proxy advisors. A recent Wall Street Journal article even had the title, quote, "For Proxy Advisors' Influence Wanes," quote unquote. Further, even if one thinks there is a problem with proxy advisory firms, H.R. 5311 presents the wrong solution. It forces proxy advisory firms to compromise their independence by subjecting them to mandatory lobbying from companies before they can issue voting recommendations. That is like forcing an umpire to haggle with the pitcher before they call a ball or strike. It also upends the current regulatory regime for these firms. Many proxy advisory firms, including the largest firm by market share, are already registered under the Investment Advisors Act of 1940 and have a fiduciary obligation to their subscribers. Other firms make robust disclosures of their conflicts of interest. Instead, H.R. 5311 adopts the framework used in Dodd-Frank related to credit rating agencies, which is inappropriate for this context. Unlike credit rating agencies who get paid by the companies themselves, not investors, proxy advisors, research is paid for by the subscribers' investors, meaning their interests are aligned. Also, this framework actually removes the fiduciary duty for firms registered under the Advisors Act, meaning less accountability. Finally, the SEC has already addressed legitimate issues with the advisory industry, providing guidance on how advisors can ensure that they are fulfilling their fiduciary obligations to clients when using proxy recommendations. Every investor we've spoken to, along with even the Chamber of Commerce, commended this guidance. It does not make good sense to upend this sensible regulatory framework and replace it with an untested regime. H.R. 5311 takes the wrong approach and will harm investors and force them to rely only on company management when making voting decisions across the thousands of companies they hold in their investment portfolios. I therefore must oppose this bill, and of course I would indicate that for the record, this is the opposition: Investment Company Institute, California State Teachers Retirement System, Ohio Public Employment Retirement System, the International Corporate Governance Network, Washington State Investment Board, Americans for Financial Reform, and the Consumer Federation of America, United Brotherhood of Carpenters, Council of Institutional Investors, which includes sign-ons from public pension fund managers in New York, Washington, Florida, Colorado, Vermont, Oregon, and California. This is serious opposition to this bill. So with that, I yield back the balance of my time.
Did the gentlelady want those all entered into record by unanimous consent?
Absolutely. Unanimous consent to introduce into the record.
Right, without objection. At this point, I recognize myself for 5 minutes. Mr. Duffy, I want to thank the gentleman for your work, and alongside of Mr. Carney, for your work on the underlying legislation here, which, as you ably indicated, and I agree, should shed a lot of light on the proxy advisory firms and their very influential role within our proxy system. I think it's very helpful if we consider some events of the last few decades that have led us to the point today and led the gentleman to putting this bill in, where there were two firms now that dominate some 97% of the proxy advisory industry in the United States. And so we should keep in mind that the proxy advisory industry is largely an industry that didn't just come about naturally. It came out and was born of regulation. You go back to start with the Department of Labor's Avon letters back in 1980, as well as the proxy voting rules of 2003, and subsequent no-action letters from the SEC staff. Proxy advisor firms have become so influential, largely because of regulators have allowed these institutional investors to increase their reliance on them. And this then was coupled with the fact that the vast majority of shares are now held not by individuals, but by institutional investors. This means that proxy advisory firms have become entrenched in corporate governance. And when you think about it, what is troubling is that even though these two dominant proxy firms have outside influence on the way American companies are run, they really operate with significant conflicts of interest, and they engage in practices that would never be allowed for someone that actually had a fiduciary responsibility to the investors. So the Capital Markets Subcommittee explored these issues with a hearing back in 2013, and that was good because that led to the SEC holding a roundtable later that year, and ultimately the SEC issued guidance related to the 2003 proxy voting rule that took a number of positive steps. For example, it clarified that an institutional investor's fiduciary duties do not obligate it to vote every share, and also clarified the responsibility that investment advisors have to ensure that they are acting in the best interest of their clients. But that guidance was just a step, a crawl in the right direction, and one proxy season later it's clear that the proxy advisory system won't be improved without congressional involvement. So I fully support the Corporate Governance Reform and Transparency Act, which we have before us now, which would withdraw the no-action letters issued by the SEC last decade and would require proxy advisory firms to register with the SEC. Now, it is true our side of the aisle is typically loath to mandate registration since proxy advisory firms have such influence largely due to the actions of regulators. It is appropriate, we think, for them to be overseen by the SEC and to be required to implement simply modest levels of transparency and also to manage or reduce their conflicts of interest. You see, an industry in which two firms make up 90% of the market is not a healthy or competitive industry. And so we urgently need to bring reforms to the proxy advisory industry, and this bill would do that in reality. And so I urge my colleagues from both sides of the aisle to support this legislation. And with that, I yield back my time. Who else seeks to be recognized? Moving down the aisle, the gentlelady from New York is recognized for 5 minutes. You're recognized.
Okay. I thank you, Mr. Chairman. Proxy advisors provide recommendations to institutional investors on how to vote on board of director elections and shareholder resolutions. Big institutional investors are shareholders at thousands of public companies, and they simply don't have the time to carefully review every single 100-page proxy statement, especially because most public companies hold their shareholder meetings in the same 3-month period. So institutional investors rely on proxy advisors for vote recommendations, which are often tailored to the investor's particular corporate governance preferences. They also rely on proxy firms for their data management on shareholder votes and corporate government and governance. And this is beneficial and healthy. Proxy advisors do have the time to carefully read all of the proxy statements and proposals because they have professionals who simply spend all their time all day doing this. However, this means that proxy advisors could, in theory, be influential in the outcomes of shareholders' vote, although the evidence on the influence of proxy advisors is mixed. It's probably fair to say that the current regulatory regime for proxy advisors is not perfect. As the chairman pointed out, two firms account for 97% of the market, ISS and Glass Lewis. But for some reason, they are regulated differently. ISS is a registered investment advisor, while Glass Lewis is not. Surely this is not an ideal setup. So I am certainly open to the idea of a better and more consistent regulatory regime for proxy advisors. But there are several things in this bill that concern me. I don't see why companies should have a statutory right to receive and comment on proxy advisors' draft recommendations before they're sent to the investors for whom they're working. Proxy advisors aren't federal agencies, and a notice and comment period for private companies that are providing a valuable service, I do not believe is appropriate. Also, this could undermine the objectivity of firms' recommendations. More practically, this would delay the fund's advisors' receipt of reports and recommendations. Big asset managers that use proxy advisors also tell me that they would find proxy advisors a lot less useful and reliable if the proxy firm had to give the company an opportunity to comment on their recommendations before sending them to the asset manager. ICI, which represents the mutual fund industry, opposes this bill, and I'd like unanimous consent to put their letter in the record.
Without objection.
So while I'm sympathetic to the idea that a better, more consistent regulatory regime, I cannot support this particular bill. I do think we should give serious consideration to using a different regulatory model for proxy firms. Instead of using the rating agency model, I think we should consider using the bank service company as a model. The Bank Service Company Act has been successful in the banking world, and I think it could offer a narrow, targeted solution for proxy firms as well. That model would say that if an asset manager has arranged for a proxy firm to do something on its behalf, then the SEC would have regulatory examination authority over the proxy firms for those purposes. So this is an idea that I believe merits consideration. I thank very much Mr. Duffy and Mr. Carney for bringing this issue before us and all their hard work on this bill, and I yield back.
Generally yields back. Who else seeks recognition on the underlying bill before we go to amendments?
I will strike the last word.
I'm sorry? Gentleman from Texas.
Thank you. I have a question for the sponsor of the legislation. It is my understanding that the legislation would accord the issuers time to have meaningful commentary. My question is, does it provide shareholders a similar opportunity for their proposals? Is this balanced such that shareholders will now have the same opportunity to review before, as is the case with the issuers?
So is my good friend asking if we're going to allow issuers to see the analysis and information upon which the recommendation relies upon?
The question is, will the shareholders have a meaningful opportunity to comment, as is the case with this legislation now with the issuers? You see, the issuers will have an opportunity to comment on what the proxy advisory opinion is before action is taken on it.
Right.
Shareholders have proposals as well. And the question is, will the shareholders have a similar opportunity for their proposals to be commented on?
Well, the shareholders are going to vote their shares. This is to make sure that the companies can comment and make sure the information upon which the recommendation relies is accurate, which breeds open, transparency, and good government. But in the end, the investors are going to vote the shares, whether it's with that which is in line with the advice of the proxy advisor or not.
Well, let's take the case where the shareholder has a proposal and the issuer, the corporation, differs with the shareholder's proposal and will have comments. Will the shareholder have an opportunity to receive those comments and review them so as to be prepared to respond before there is a vote on the proposal?
If the shareholder disagrees with the recommendation, they will vote the shares inconsistent with the recommendation.
I know, but there will be comments that will be made. What we're doing now is giving the issuer the opportunity to comment on recommendations from the proxy advisor.
Right.
And they're commenting on proposals made by the issuer.
Right.
Proposals are also made by shareholders. And the question is, when the issuer challenges a proposal made by the shareholder and has comments on it, will the shareholder get those comments and have an opportunity to perfect a retort before those comments are acted on?
In this draft, no, but I would ask my good friend if he wanted to make an amendment to that effect and support the legislation. I would entertain that.
Well, I do accept the opportunity, but are you saying that we would do that right now?
Are you saying that you would vote for this legislation if you were to successfully pass that amendment?
I'm saying that if it becomes an amendment that you and I can agree on, then I would give it consideration. But it would have to be one that I would have to have some veto authority with, as would you. I wouldn't want this to become a one-way opportunity.
I'd be happy to work with you on that issue and hopefully gain your support on the underlying bill.
Well, until we have that perfected, I don't believe I can find favor with what's being offered.
Yeah, so would the gentleman, whose time? It's your time.
Yes, it's my time.
Yeah, would the gentleman yield?
I will.
Yeah. So on the face of it, if the two gentlemen, you're opposed to it right now, and you agree to take a look at this later on after committee. But I think the one concern is that we have is that you create a ripple effect or a continuation of the process. The idea here is you have a proposal. Mr. Duffy's language of his bill is to say that the company, the issuer, should be able to say, here, we want to take a look at this and give an analysis of what the impact is and what our view is. That's what your bill ultimately does. But we don't want to continue on down the cycle then to have the investor who is proposing that proposal to then have a kickback and say, well, now this is what our assessment is on it. Because at that point in time, you just continue, you'll just have a continuum of back and forths on it. The proxy advisor gets the proposal from the investor, from the shareholder who says, here's my idea. The company under your bill basically is understanding is to say, we want to have an opportunity to say, this is our 2 cents on it, this is our analysis on it, and then the proxy advisor is able to weigh that into their consideration. To continue on that dialogue, I think, is not where the gentleman wishes to go, but I think the gentleman says after this gets through the committee, he's willing to sit down with the gentleman and just weigh out how this all may work. And with that, the gentleman's time has expired. Who else seeks recognition on the underlying bill before we get to the amendments? Actually, Mr. Sherman was up here first, and I didn't call him before because he didn't quickly enough raise your hand. Now you raised your hand quick enough. Thanks.
Thank you. I rise in opposition to the bill. I've seen the majority party stand up for free market capitalism. They've always been against just about any proposal that would add SEC regulation, impose government restrictions, requirements, and burdens. But in this one case, they propose that we take a new group of folks and subject them to government oversight and government control and government regulation. This bill is a support not for free market capitalism, but for crony capitalism. It is the crony capitalists that will say that a board of directors should be free to do whatever they want, and no shareholder dare voice an opinion otherwise. If the board wants high pay, there's no say on pay. If the board wants blood diamonds, they should buy blood diamonds. If the board wants to do business with Iran, they should do business with Iran. It's the shareholders' company. It's the shareholders' money. The gentleman from Texas's questions were very well on point. If those who want to adopt a resolution saying don't do business with Iran, they don't get to comment on a proxy advisor who says vote that measure down. But if the proxy advisor says support the measure, then there's this delay and this process by which the company, because we want the bill protects the power of the board, gets a comment. This is, why is it that for the first time in my memory, we see the advocates of doing away with government regulation, proposed government regulation, and that is because this bill is designed to protect companies from activist shareholders, and to make it tough for activist shareholders, and to make sure the proxy advising process it puts the activist shareholders at a disadvantage. In addition, I think the bill is overbroad in that it tries to it's aimed at just two companies, but it defines proxy advice as a lawyer talking to their investor client about how to vote. It is a circular definition in which you're defined as a proxy advisor if you register under 15H, and 15H says you have to register if you're a proxy advisor. And I know that there are only two companies that are major forces in what this bill tries to focus on, which is official proxy advisors, but every CPA, every attorney, every political activist may on one occasion or another advise a client on how to vote on any proxy matter of a corporation they control, that they invest in. Now, I know CalPERS and CalSTRS vote is opposed to this bill. I would say that I would vote against the bill just because it uses the credit rating agency model, which is a model that has dramatically failed us, but I don't think it really uses the credit agency model, because the credit agencies, you have a issuer pays model. So the folks that are trying to inform or bilk the investor pays and selects the speaker. Whereas in this case, it is the investor who selects, not those who are trying to control the investor or persuade the investor. So I would say that we want more firms doing this, that we have lots of people advising clients on how to vote in corporate matters, and that this issue has come up only because corporate boards don't want their shareholders to, quote, interfere with the corporation.
Will the gentleman yield?
I just want to end it, then I'll yield. If you believe that there's such a thing as shareholder interference in the corporation, that it is wrongful for shareholders to tell the corporate board what to do, then I think this bill deserves your support. I view it the other way around. The investors should control the corporation. I yield to the ranking member.
I think you just revealed something that I had missed in this bill that's extremely important. I think what you just said was that an individual advisor who could be a lawyer or someone else who is registered would be considered in the same way that the bill identifies those who give the advice to the shareholders.
The gentleman's time
and this would prohibit them from being able to do that.
Right. Gentleman's time is expired, but without objection, we grant an additional 30 seconds so you can finish your thought.
No, my thought is finished. I just wanted to clarify, because that's striking, what he just said.
Okay.
This is not directed at two companies. This is directed at any advisor who's registered, rather than the two companies that were identified.
I think the intent of the bill may be the two companies, but I fear that its literal wording would affect not only would affect everyone who advises a shareholder on how to vote.
Okay, and since we gave you additional 30 seconds, without objection, I'll grant myself 30 seconds just to address that one point, because I thought it could be a valid point, but it goes to Section 2, page 281. What are we talking about here? We're talking about firms that are in the business. Term proxy advisor firms, any registered, first of all, have to be registered, first of all, under 15H, who is engaged in the business, not the general business, in the business of proxy, providing proxy voting research, analysis, or recommendations lines which constitutes a solicitation with the meaning of Section 14, so on and so forth. So it's not for, there's only two companies out there that are in the business of doing all those things. But as opposed
when I was a lawyer, I was in the business of advising my clients on corporate matters, including how to vote.
Okay. So, yeah, gentleman's point is taken, and I would suggest to the sponsor, who is over here now, after the committee, as far as any clarifying language, that to say solely in that business. And with that, anyone else who would seek recognition? What does gentlemen seek recognition?
Move to strike the last word.
It's now recognized.
Thank you, Mr. Chairman. I want to begin by thanking Mr. Duffy and all the folks who've worked with us on this legislation, particularly to improve the legislation and address concerns that have been raised. I especially want to thank the SEC for their assistance on the bill. And again, Mr. Duffy, for his willingness to make changes and improvements in the legislation. Corporate law and corporate governance is a center of excellence in the state, my home state of Delaware, where thousands of U.S. companies are domiciled. They seek corporate status in Delaware because of the soundness of our corporate statute and because of the access to the Delaware Chantry Court, which is renowned around the world as a venue for resolving various corporate disputes. So putting in place a legal structure that leads to responsible corporate decision-making is an important goal of mine. I would like, Mr. Chairman, you as the Chair of Capital Markets have received letters of support, as has Mr. Duffy and I'd like to enter them into the record.
Without objection.
I'm sorry I didn't see the change in the chair. Thank you.
We move faster.
Proxy advisory firms play an important role in advising investors. However, these firms are vulnerable to conflicts of interest and undue activist influence or influence from activist shareholders. We believe that the SEC has an important role to play in monitoring the information the firms provide to ensure our investors are receiving sound and unbiased advice. I would like to strongly reject Mr. Sherman's characterization of this legislation. The goal of the bill is really simple. It's one of transparency. The legislation will give the SEC additional tools to provide better oversight of proxy advisors who play a significant role in corporate decision-making. This transparency will benefit investors and improve the corporate governance system in our country. You should know that the version we are considering, and Mr. Duffy, as I speak, is trying to resolve or adopt additional suggestions for this legislation, is significantly different from our discussion draft. Again, this is the result of careful consideration and input from both stakeholders and our colleagues on the committee. In addition, my friend from Illinois, Congressman Foster, has an amendment that will further improve upon these changes. Again, I appreciate the opportunity to work with Mr. Duffy and the SEC to ensure shareholders have access to reliable information and recommendation. And I urge my colleagues to support this common sense legislation to improve transparency in corporate decision-making in the U.S. I yield back the balance of my time.
Gentleman yields back. Who seeks recognition? For what purposes, gentleman from Illinois, seek recognition?
Mr. Chairman, I have an amendment at the desk.
We'll pause a moment, allow the amendment to be distributed. If any member has not received a copy of the amendment, the clerk will report the amendment.
Amendment offered by Mr. Foster, page 13, line 18, strike each and insert the following. 1, in
Without
general.
objection, the reading of the amendment is dispensed with, and the gentleman is recognized on his amendment for 5 minutes.
Thank you, Mr. Chairman. And I would also like to thank Mr. Duffy and Mr. Carney for working with me on the changes embodied in this proposed amendment that will strike provisions that have given me and other members concerns. I believe that as a general matter, the more information that can be provided to investors about a proxy vote, the better. I also recognize the need for that information to be accurate and understand the role that occasionally adversarial dynamics can provide in arriving at the best, most accurate information. As such, I was supportive of the effort to provide additional mechanisms for vetting of proxy recommendations, but sensitive to the risk that independence could be undermined and concerned about the difficulties in mandating that proprietary information be provided for free. My amendment would limit the information that must be disclosed to the issuer by the proxy advisory firm. I believe that a firm owns its work product and that we should not compel it to turn over its entire analysis to non-paying customers, but recognize that sometimes issuers have insights that can aid the proxy advisors in making their recommendations and shareholders in their voting. Working with my colleagues on both sides of the aisle, we were able to agree on language that limits these disclosures. We also agreed on language providing the SEC with explicit authority to define the specifics of disclosures that were or were not required, although I was advised by legislative counsel that additional language was probably unnecessary because it is already inherent in the authority of the SEC. In summary, I believe that some increase in transmission of information is in the investor interest, and I think it's important that the SEC be engaged to delineate between proprietary analysis of the proxy advisory firm and as to what information transfer is necessary to the public interest to promote capital formation and for investor protection. The second part of my amendment would strike the section creating a private right of action of an issuer against a proxy advisory firm. It struck many of us members that opened a very large bag of snakes. We've made other changes that I believe will result in the furnishing of more information to investors, and I believe that this process should be implemented before determining that additional litigation pathways are necessary. I believe that there's a general consensus that the incidence of material factual errors is quite low, and sorting out those accurately and without litigation is preferable. I believe that we have a framework for doing so and encourage my colleagues to support my amendment and urge support for the underlying bill. Thank you, and I yield back the balance of my time.
Gentleman yields back. Who seeks recognition? For what purpose does the gentleman from Wisconsin seek recognition?
Move to strike the last word.
Gentleman is recognized for 5 minutes.
I just want to thank Mr. Foster for his thoughtful amendment and engagement in a good dialogue and conversation, trying to strike a bipartisan balance. I understand the points that he makes, and in a hope of bringing both sides together, I'm willing to accept the amendment, and I appreciate him working with our two teams to find something that is agreeable for both of us. So thank you for that, Mr. Foster.
Will the gentleman yield?
I will.
I'd just like to add my thanks as well to Mr. Foster for his thoughtful approach to the legislation that and the discussions that we've had, and appreciate his work on this amendment. Yield back.
And I think this is one of these situations where we see an issue and we're trying to resolve it on the side of openness and transparency, and making sure that decisions are made with good and correct information. Now, I know that some information was put out there that anyone who gives advice in regard to votes could be ensnared in this bill. Just to clarify, in Section 2, just to read here, starting at line 6, proxy advisory firm. The term proxy advisory firm means any person registered under Section 15H who is engaged in the business of providing proxy voting research, analysis, or recommendations to clients. You have to be in the business of being a proxy advisory firm. So we're pretty clear in the bill with that definition. Other comments have been made that this is giving the keys to management, not shareholders. That couldn't be further from the truth. Shareholders own and control companies and are still going to be voting, but they're going to be voting with better information, with accurate information, and they're going to be voting potentially on advice that isn't subject to a conflict of interest, making sure that the advice they get is in their best interest, that meet their priorities and their objectives, not the priorities or objectives of somebody else, somewhere else. So it's important that when you get advice, it is specifically tailored towards you. Just want to make one last point. We have, tens of thousands of issues that come up for a vote. Some of them are 100 pages in length, very complicated, and this happens in a relatively short period of time. These proxy advisory firms have a couple hundred employees. There's no way that you can go through every one of these issues and tailor a recommendation to each and every one of your clients. No doubt you get a one-size-fits-all recommendation that comes from proxy advisory firms because they don't have the staff, they don't have the depth to go through every single one of these issues. So I do think that both sides of the aisle have identified an issue. I think we've worked together to craft a good response that will provide for better government, more transparency in the way this process works with less conflicts of interest, and I would encourage both sides of the aisle to support Mr. Carney and my bill, but also Mr. Foster's amendment. I yield back.
Yield? Behind you?
Yeah, yes, I yield to.
So I appreciate what you said with regard to the clarifying language. I would just throw it over to the gentleman from California. Hey. When I was in the chair, we were talking about that one piece, and I know what you just said, but if we were able to come up with language that even clarifies it even more, that we're talking about just those two couple firms that are principally involved in that, would that, if the members would agree to that, that they would work on making that really narrow, would you be on support of the legislation at this point?
If the gentleman would yield, I have other problems with the legislation, but if you were to limit it to those companies whose exclusive business was proxy advice.
Well, the gentleman's, then it's not exclusive. That's the problem. Their business is not exclusive.
Right. So I don't know how you would possibly say we only mean these two firms and we don't mean a lawyer or a political activist talking to a shareholder.
Okay. So the answer is no. Okay. I yield.
Yes.
Gentleman's back.
Yield back.
Gentleman yields back. Who seeks recognition on the amendment? If there's no further, for what purposes, ranking members?
Like the last word.
Gentlelady is recognized for 5 minutes.
I appreciate this amendment from the gentleman from Illinois, which seeks to make improvements to this bill. In particular, it is appropriate that this amendment would strike the provision in the bill that allows companies to sue research firms in court when they don't believe they've had adequate time to meaningfully comment on their research before it goes to clients. However, the amendment does not solve other fundamental problems with the bill. The bill, even if amended, would require companies to provide their data, analyses, and recommendations to companies before giving them to clients. Again, like I said before, it's like letting the pitcher debate with the umpire before they call a ball or a strike. This provision in the bill allows a company to stand in between the contractual relationship between research firm and client and would undermine advisors' ability to fulfill their fiduciary duty to their investors. How can they rely on research when they know its independence has been compromised? Indeed, this may even run afoul of advisors' obligations under the new Department of Labor fiduciary duty rule. It also runs contrary to FINRA research rules, which seeks to limit conflicts of interest and prohibit pre-publication sharing of information between researchers and companies. This level of back and forth with companies is also impractical and would impede investors' ability to receive timely information during a compressed proxy season. After all, the vast majority of proxy meetings take place across just a few months every spring. Finally, this amendment is fundamentally unfair. Why should a company have the ability, basically, to debate a proxy firm recommendation before it's published and not a shareholder with a proxy on the ballot? Many shareholders propose measures related to corporate governance, climate change, or social welfare issues like pay equity or human rights practices. Under this bill, they would not receive the same opportunity to lobby the researchers as the management of the companies subject to the reports. You know, it's very interesting that at a time when we have growing support for transparency and for the involvement of shareholders in the business of the company, where we have been moving in that direction for a number of years now, supporting the idea that shareholders have a right to have a say on pay and all these other issues that we're identifying here, that this is taking us backwards to shutting out the shareholders from having the kind of advice that would give them good information about how to do this. It's just amazing to me that we would attempt to go backwards rather than an attempt to give support.
Would the gentleman yield?
Yes, I'd be happy to yield. Who's requesting?
I am.
Yes, please.
So there's nothing in this bill that attempts to roll any of that back. In fact, what this bill is intended to do is to create greater transparency around decisions and advice that is provided by a significant player in the corporate governance process that you just described. So I would reject the notion that in some ways this is to roll back some of the advances that you've just talked
reclaiming
about.
my time, let me just say what I think this bill does. I mean, it's been stated over and over again, but here you have shareholders, and they want to know more about this company. They want to know not only about pay, but as it was alluded to by the gentleman from California, whether or not they're involved with blood diamonds, whether or not they're involved in investments in companies that somehow disregard the work that we're doing to try and protect the environment, on and on and on. And they say, let's get some good research. And let's find out about these issues, because we want to be able to vote what we think are our best interests. And you're saying in this bill that no matter the ability to get this research, that somehow all of this research that has been done must be given to the company first, so that they can not only comment on it, but they could work and organize against it and basically oppose it and have access to the research information that's been paid for by the shareholders. I don't get it.
Time of the gentlelady has...
I yield back the balance of
time of the gentlelady has expired. Who seeks recognition? The chair will recognize himself. To say number one, I want to thank the gentleman from Wisconsin for his underlying amendment. Again, it appeared to be a rather modest amendment to me that is, in some respects, becoming even a more modest amendment with the amendment from the gentleman from Illinois. Again, I'm not following the ranking member's logic. This underlying bill simply ensures that proxy firms are registered with the SEC and they disclose potential conflicts of interest. Codes of ethics make available their methodologies, more information to the shareholders. If anything, this empowers shareholders even more. And we might not be in this position were it not for the actions that the SEC has taken, specifically to no action letters by staff, not even voted on by the commission, that effectively blesses the practice of investment advisors simply voting the recommendations provided by a proxy advisor. So no wonder that these firms, this functional duopoly, has been granted such power because of essentially a staff-created safe harbor. And shareholders have a right to know exactly what these proxy firms are doing, how are they influenced, what are their methodologies. And so I want to thank people from both sides of the aisle who've worked on this matter. Clearly the gentleman from Illinois, the gentleman from Delaware, working with the gentleman from Wisconsin. Again, a very modest proposal, made even more modest by the amendment offered by the gentleman from Illinois. It seems to me to be very common sense. I would urge all members.
Mr. Chairman,
to add
yield.
in I'll yield to the gentleman from Texas.
Well, I want to echo what the chairman was saying, and I was just thinking back on we were having this discussion about Dodd-Frank, and a lot of people said that the reason that we had the problems in 2008, there wasn't any transparency in the marketplace, and supposedly, all of the actions that we took in Dodd-Frank were to bring more transparency to the marketplace. And I think it's a little odd now that we have people now that are opposed to bringing some transparency to a very important part of the market system. So I would just encourage my colleagues to support the underlying bill.
The chair yields back his time. Is there any further debate on the amendment? If not, the question occurs on the amendment offered by the gentleman from Illinois, Mr. Foster. All those in favor shall signify by saying aye. Aye. All those opposed shall signify by saying nay. In the opinion of the chair, the ayes have it, and the amendment is adopted. Is there any further discussion or amendments? If not, the question now occurs on ordering the bill as amended reported to the House with a favorable recommendation. Those in favor shall signify by saying aye. Aye. All those opposed shall signify by saying nay. In the opinion of the chair, the ayes appear to have it. For what purpose does the gentleman from Wisconsin seek recognition?
I'd ask for a recorded vote.
Recorded vote has been requested. All those in favor of a recorded vote shall raise their hand and be counted. A sufficient number having raised their hands, a recorded vote is so ordered, and pursuant to subsection C5 of Rule 3 of the committee rules, the vote on this question is postponed. Now, pursuant to notice, I call up H.R. 5143. The clerk will report the bill which was distributed in advance.
H.R. 5143, to provide greater transparency and congressional oversight of international insurance standards.
Without objection, the bill is considered read and open to amendment at any point. The chair recognizes the gentleman from Missouri, Mr. Lukemeyer, to offer an amendment in the nature of a substitute. Does the gentleman have an amendment at the desk?
Yes, we do.
The chair has been informed that copies of the amendment have been distributed or on the dais, so the clerk will report.
Amendment in the nature of a substitute offered by Mr. Lukemeyer. Strike all after the enacting clauses.
Without objection, the amendment is considered read and will serve as base text for purposes of amendment. The gentleman is recognized for 5 minutes.
Thank you, Mr. Chairman. The Subcommittee on Housing and Insurance has spent a great deal of time focusing on factors affecting our domestic insurance markets. Our hearings have provided opportunities to hear from regulators and industry leaders on the implications, both positive and negative, of international insurance standards and agreements. H.R. 5143, the Transparent Insurance Standards Act, would create a more formalized role for congressional monitoring of agreements impacting U.S. policyholders and insurance markets. The bill would establish a series of reasonable requirements to be met before Treasury's Federal Insurance Office, the Federal Reserve, or any other party to the international conversations could consent to the adoption of a final insurance standard. With regard to conversations at the International Association of Insurance Supervisors, or IAIS, H.R. 5143 would require Team USA, made up of the Fed, FIO, and state insurance commissioners, to publish a proposed final insurance standard for congressional review and public comment. The legislation would also require the Federal Reserve to complete its work on a domestic capital standard prior to consenting to the adoption of an international capital rule, ensuring that the United States is in a position to export domestic standards rather than import European-centric ones. Additionally, H.R. 5143 would institute a 90-day layover and submission period, allowing Congress the ability to block any international agreement. The legislation would make slight changes to the covered agreement negotiating process. The covered agreement process, when done correctly and within the boundaries of congressional intent, stands to benefit U.S. industry and consumers. That being said, increased oversight is important. For that reason, H.R. 5143 would afford an opportunity for public comment during the covered agreement process. It would also ensure state insurance commissioners a limited role in negotiations, thereby protecting the state-based insurance regulatory system that has served policyholders well. Legislation also outlines a more robust role for the Financial Stability Oversight Council's independent member with insurance expertise, strengthening Team USA and its ability to advocate for the policies that suit our markets and our consumers. U.S. insurers have diverse interests, issues, and concerns. When we embarked on this journey, the intent was to draft a thoughtful bill that respected the process but provided this body and the public with more opportunity. As such, H.R. 5143 has been drafted with the input of a wide variety of stakeholders and has been able to successfully generate broad support. This bill is not intended to bring the international process to a grinding halt. Team USA has experienced victories and has kept this body informed of its negotiations on the first of what could be many covered agreements. However, we shouldn't underestimate the importance of these conversations or the implications they can have on insurers. The Higher Loss Observancy draft rule that in any lingering questions around temporary equivalency for U.S. insurers have demonstrated that we've not always ended up with the best deal. It's imperative that the United States, that is, the states, the executive branch, and Congress, work cooperatively to signal to the IAIS, the Financial Stability Board, and foreign governments that we will only lend our name to standards and agreements that benefit U.S. consumers and allow us to maintain a robust insurance marketplace. H.R. 5143 helps to serve this objective. It will provide for greater transparency, allow for a stronger Team USA, and indicate to foreign bodies that the United States will lead and not be led. This shouldn't be a partisan effort. I know many of my friends across the aisle and their constituents would like to see a more transparent process. The legislation we consider today won't derail the nation's efforts to secure good deals internationally, but it will make sure that many parties impacted have a stronger voice, be it through the representatives in Congress or directly to the negotiators. Several of my colleagues on both sides of the aisle have worked tirelessly on issues surrounding international supervision, and I thank them for all their meaningful input and support. I ask my colleagues to join us in supporting H.R. 5143. And with that, Mr. Chairman, I yield back the balance of my time.
Gentleman yields back. For what purposes, gentleman from, for what purposes the ranking member seek recognition?
I move to strike the last word.
Gentlelady is recognized for 5 minutes.
Thank you, Mr. Chairman. H.R. 5143, the Transparent Insurance Standards Act, I believe takes us in steps, several steps in the wrong direction. Ever since the 2008 financial crisis, Democrats have been vigilant about making sure that our regulators have the tools to prevent the possibility of a future collapse of large globally active insurance companies like AIG. To that end, Dodd-Frank instituted critical changes to the federal government's role in the oversight and supervision of insurance. Namely, Dodd-Frank created the Financial Stability Oversight Council, known as FSOC, an entity that for the first time is responsible for examining risk facing our entire financial system. The FSOC now has the authority to designate non-bank financial companies, including but not limited to insurance companies, for enhanced supervision. Congress likewise gave regulators the authority to require enhanced standards for these non-bank firms, providing flexibility to account for the fact that the business model of insurance companies may demand a different regulatory response. Dodd-Frank also contains a number of provisions specific to international issues, and specifically the Federal Insurance Office's role in coordinating federal efforts and developing federal policy on prudential aspects of international insurance matters. These authorities were all enacted with one goal in mind: protect financial stability and prevent the next financial crisis. So, here we have H.R. 5143, which proposes to kind of forget all of that, and it, I think, would tie the hands of our regulators as they try and advocate for a strong U.S. position in the international arena. Recently, the Federal Reserve demonstrated just how diligently they have been studying the business and potential risks of insurance. In its advance notice of proposed rulemaking, the Federal Reserve took pains to limit the variances between state-based capital supervision and the consolidated supervision some firms will be subject to. This bill would not consider all of that work, and it would basically go in the direction that would be in opposition to what the federal regulations regulators have been doing with our insurance industry. So it makes it difficult for me to support the bill's call for a singular focus on legal entity supervision for internationally active insurers, which we already know was wholly inefficient to prevent the collapse of AIG. And I think we should be clear about what is happening here. Nothing will be adopted domestically unless each individual state insurance commissioner or the Federal Reserve for the companies it is now supervising chooses to go through the notice and comment rulemaking process. And now that Federal Reserve has put out the first draft of its proposal, we know that they have no interest in supplanting U.S. interests with that of Europe. This bill is at best a solution that's in search of a problem and perhaps a step backwards in time to before the Dodd-Frank and the improvements it made to our financial system. So I'm not willing to support this bill at this time, but let me just say this. I know that Mr. Heck and some others have worked on this legislation with very good intentions, and I understand the concern that our state insurance commissioners want the ability to have some control and to not simply be in the position of adopting international standards that they don't believe serve in the best interests of this country or their state. And so I think that he certainly has been working in good faith. But what I'm concerned about is that if we have a situation where every state has to sign off on or approve something that is being proposed in the international community that should include us in the deliberations, that this would simply bog down the ability to come to conclusions about what is in the best interest of everybody. So I would simply want to hear even more from Mr. Heck and others about how they propose to deal with this, given they know the history of what was taking place prior to Dodd-Frank. And I thank the chairman for your indulgence, and I yield back the balance of my time.
Time of the gentlelady has expired. For what purpose the gentleman from Texas seek
Move to strike the
recognition?
last word.
Gentleman's recognized for 5 minutes.
Thank you, Mr. Chairman. I want to commend Chairman Lukemeyer for offering a great piece of legislation. I think many of us that have been very close to this issue have been very concerned about the government trying to import a regulatory system that is different from the U.S., and I don't believe any better than what we have in the U.S. What we've seen time and time again over the years is that the current regulatory structure for the insurance industry has been very robust and very successful. Now, some people want to point to one particular company that failed during the 2008 period, but that was a company that was involved in a much different businesses. The AIG business model was much different than the traditional insurance industry. And the industry really went through the crisis in better shape than just about any other aspect of the financial marketplace. And so this is a good piece of legislation. It brings transparency to it, and what it does is it makes sure is that the ultimate regulators of these insurance companies actually have a say-so in some of the discussions and some of the things that are being agreed to and discussed on an international basis, and it prohibits them from being, I think, imposed without any feedback in this process. So I commend Mr. Lukemeyer for his piece of legislation, and I encourage everyone to support H.R. 5143. And I would yield to the chairman if he so desires.
Certainly, I would just, again, thank our chairman of the Housing and Insurance Subcommittee for bringing this legislation forward. Again, I see nothing in this that is going to prohibit the United States from entering into international insurance agreements. And those who probably would have the greatest concern about that seem to all favor the bill in the first place. The Property Casualty Insurers Association of America, the Independent Insurance Agents, Brokers of America, National Association of Mutual Insurance Companies, American Council of Life Insurers, and the list goes on. They favor this approach. And this is essentially an oversight bill to make sure that Congress has its voice heard as well, the elected representatives of we the people. Again, in many respects, a very modest piece of legislation, but to ensure that U.S. insurance interests are represented properly. I know this has been the subject of a lot of negotiation and discussion. Again, I salute the gentleman from Missouri for his leadership. I would urge all members to support the legislation. I thank the gentleman from Texas for yielding. Yields back for what I'm sorry?
Yeah, thanks. Just to move along here, I too wanted to thank the sponsor of the bill, Chairman Lukemeyer, and his staff for all the hard work they've put into the legislation. And as everybody on the committee knows, I did not support the passage of Dodd-Frank. However, I do support Chairman Frank's decision and the consensus to leave the insurance industry regulated at the state level. And I believe the states have done a tremendous job in that for over 150 years, and I believe they should continue. And that's why I was troubled by the international standard-setting agenda being led. As we have seen, it is clear to me that this international standard is a backdoor attempt by some to federalize the regulation of insurance without congressional authorization, and that's why we have trouble on this from both sides of the aisle. It appears there are several companies and several federal government employees, specifically at Federal Insurance Office, that are disappointed that Dodd-Frank did not give the federal government more legal authority over insurance and are trying to use the limited hooks they have to double down on this. And so just like any other government entity created with limited powers and authority, FIO has thought to expand its reach. And if this continues, which I'm afraid it will, I believe the committee must re-examine an ultimate need for FIO and strongly consider eliminating it, which I think is where we like to go. The state insurance commissioners are more than able to be the voice for us overseas, and many of our state insurance markets are by themselves bigger than most of the other countries in the world. And so with that said, I agree with the sponsor. We should work together to ensure these misguided, unauthorized, and stealth-like attempts to federalize the regulation of insurance through these international processes do not succeed, and let us then therefore stand up and protect the long, straight states-based regulation insurance, which, as I said before, has served this country and the consumers very, very well for over 150 years. I yield back to the gentleman from Texas.
Gentleman yields back. For what purpose does the gentleman from California seek recognition?
Just strike the last word.
Gentleman is recognized for 5 minutes.
I rise in support of this bill. I like the bill. I like Mr. Heck's amendment in the nature of a substitute even more, and look forward to his proposal of it. If you study the history of this country, the political history for the last 70, 80 years, you'll see a diminution in the power of Congress and an increasingly powerful executive branch. This has been particularly true in anything that is international, and as the world globalizes, more and more things become international. And while 50 years ago we would not have thought of insurance standards as being an international matter, lo and behold, they are being negotiated in Switzerland. Now, one of the devices that's used by the executive branch to gain more power is they go sign an agreement that has less than overwhelming support in Congress, and then they come back and tell Congress, the pride of America, the standing of America is at stake. We signed this agreement. We gave America's word. Don't hurt America. Vote with us. The method, what this bill does is it interrupts that. And it says, here are the standards to be met. Here's the procedure to be met. Bring us a deal that meets this. We'll vote on it. And then you can sign it. That way, Congress and the President work together toward a good international agreement that reflects the interests of and the viewpoints of both branches of government. Now, it is a general thinking in Congress that we should preserve the state's role in the regulatory system for insurance. I would like to protect that role. I don't want to see Treasury use an international agreement to undermine that role. We're told that state regulation of insurance was proven to be ineffective with AIG. I think AIG proves that state regulation of insurance was effective. AIG was a combination of companies. Most were regulated insurance companies, regulated by the states, and those companies were all sound. They were sound in spite of the fact that they were controlled by AIG management. Then there were a couple of entities that should have been insurance companies and should have been state regulated, but weren't. Those companies lost tens of billions of dollars. How? By issuing credit default swaps. What is a credit default swap? It is basically an insurance policy ensuring that a value of a portfolio will not decline. But because Congress has failed to act, it is not defined as an insurance company. So AIG managed to bankrupt itself to some degree by being an unregulated insurance company. This proves that the state regulatory system of insurance is good, works well, and needs to be extended to credit default swaps. It does not mean that we need to sit by and have Treasury feel free to sign an international agreement that will change how we regulate insurance companies in this country and then bring it to Congress and say you have to pass legislation to implement it because the standing and word of the United States is at stake. I would point out that the National Association of Insurance Commissioners, the people we rely upon at the state level to regulate insurance, the insurance industry, supports this draft, and I believe, and also supports the Heck Amendment. So I look forward to passing legislation that will outline for Treasury what is the viewpoint of Congress, what are the objectives they should meet, and have a process for approving the agreement before it is signed, before the word of the United States is given. And I yield back.
The gentleman yields back. Does Mr. Holtgren? He does. Why do you seek to be recognized?
Move to strike the last word.
Gentleman is recognized.
Thank you, Mr. Chairman. I want to thank my friend Chairman Luchtmeyer for his work on H.R. 5143. I'm glad to be a co-sponsor of this legislation, and I know he's worked hard to strike a balance of proper congressional oversight as well, and providing those negotiating on behalf of the U.S. the tools they need to be effective in setting international standards. We are in some uncharted waters following the passage of the Dodd-Frank Act and how to balance solvency with access to capital and responsible consumer protection for insurers. Republicans, myself included, are frustrated by how much authority has been ceded and arguably seized by this administration. That being said, what we are really discussing here today is Congress's authority and desire, and that of the American people, to be heard in international negotiations. Members of this committee have heard plenty about the unintended consequences, especially for smaller institutions, that decisions at Basel have meant for our nation's banks. The state of Illinois is home to a number of insurance companies that have expressed concerns. We have an opportunity to ensure, through appropriate congressional oversight, that insurance companies based here in the United States are not impacted by misinformed or unintended decisions in Basel that lead to a misaligned regulatory structure in the U.S. I think the state-based approach to regulation for insurance in the U.S. is working. Illinois is the gold standard for insurance regulation, and that's one of the primary reasons we're fortunate enough to be home to a number of important insurance providers offering a broad spectrum of coverage, providing jobs, and supporting our communities. The Transparent Insurance Standards Act of 2016 does not betray its name. There are important discussions happening at the international level, and Congress would benefit from some insight. Some of this insight may also help demonstrate the value of internationally active insurers. As the global economy becomes more interconnected, U.S. businesses are more exposed to global disasters, supply chain risks, political risks, and more. The reach of global insurers can increase risk diversification and enable the better risk mitigation products. As we address legislation regarding activities being undertaken by the International Association of Insurance Supervisors, it's important to remember the vital role that global insurers play in the U.S. market. Zurich Insurance, with its North American headquarters in Schaumburg, Illinois, employs tens of thousands of Americans and brings much-needed insurance capacity to the U.S. market to cover some of the largest, most complex risks. Chairman Luchtemeyer's legislation strikes an important balance of ensuring transparency, proper congressional oversight, recognizing the importance of our state-based insurance regulation in the U.S. without overlooking the value of global insurers. I support the Transparent Insurance Standards Act of 2016 and encourage my colleagues to do the same, and I will yield back the balance of my time to the chairman.
Would the gentleman yield?
Mr. Slaver?
Move to strike the last word.
Right, you're recognized for 5 minutes.
Thank you, Mr. Chairman. Let me first foremost say that I appreciate Chairman Luchtemeyer's attempt to deal with this issue that I think all of us are concerned about, and that is international standards with regard to insurance. I probably would rarely have disagreements with him on many matters that we deal with in this committee. On this issue, I do have some disagreement, and I've met with, like everybody else, I've met with tens, 20s, maybe 30s of international regulation concerned entities from here in Washington, and I've dealt with industry stakeholders in meeting after meeting after meeting. And I think the one thing we need to all acknowledge, I think everybody realizes this, although we're talking as if we don't, the Supreme Court has already ruled that state-based regulation for insurance is the law of the land. I mean, that's the Supreme Court has already ruled. And then McCarran-Ferguson in 1940-something, 45, I think, also passed legislation that essentially said that not only is it the law of the land, but that Congress should not do anything to change that, essentially. And so the one thing that we forget to talk about, or just choose not to, is that we are under no obligation as a nation to accept international standards that we deem damaging to our state-based system and the industries in our country. Recently, the Federal Reserve issued an advance notice proposed rulemaking for capital framework work for companies under its supervision. And I think the Federal Reserve has taken steps in reaching out to insurance bodies. However, I think we ought to more formalize the relationship that the National Association of Insurance Commissioners will have with the negotiating team. My only disagreement with the chairman's legislation is that I don't think we ought to do anything to tie the hands. It was it the rapping guy, Lil Wayne, talked about not tying the hands, keep me from being who I am. I think if we tie the hands of our negotiators, we're going to prevent them from being who they are, which is the body that will do everything it can to make sure that we don't import, as someone said, something that's more favorable to Europe. I don't think that's going to happen. And if it happens, it is very clear, as a non-lawyer, it's even clear to me, we don't have to accept it. We don't. And so I'm not going to argue with people a lot today about it because we don't have to accept it. It's clear. And so sometimes I get frustrated in arguments that don't matter. And this one may not matter as much as we'd like to present it. And so my issue is that let's not do anything to hamstring our abilities at the international level. As I said earlier, the most powerful arrow in our quiver is the one that says, at the end of all of the negotiations, if international standards are trespassing on what we deem important and necessary for our industry, we don't accept it. I yield back.
Gentleman yields back. Gentleman from New Mexico, why do you seek recognition?
Move to strike the last word.
Gentleman is recognized.
Thank you, Mr. Chairman. Before I talk about the bill, I would talk about my past history, and I suspect I've challenged the insurance markets as much as anyone in Congress. My previous job was that we did fishing and rental tool work in oil wells. In other words, you would take the cap off the oil well, you would pull all of the equipment out and put your tool at the end of the string of pipe, run it back in, and do whatever repairs are required. So we found every reason to challenge the insurance market. And then, just if that's not extreme enough, then on Easter Sunday of this year, I flew a single-engine airplane solo around the world and did that 15 different countries in 15 different days, 12 hours a day. No insurance companies, it was a challenging insurance product, and yet we're able to find that. We're able to find that because the U.S. market is the best, most well-established insurance market in the entire world. And so why we would even open the discussions to an inferior set of standards, one that does not have nearly the corporate knowledge or the historical knowledge of what we have here, tends to alarm me, because I believe that Mr. Sherman, with all respect to my friend from Missouri, I think Mr. Sherman's explanation was correct, that both administrations, Republican or Democrat, are going to go over and they're going to sign stuff, and then they're going to come back and say, you all in Congress really need to back us up on this deal. We have signed away so many of our rights and our abilities to compete in the world that I am alarmed that we would even be having the discussion. And so I'm strongly in favor of the chairman's bill, because I believe that we need to be exporting our system of insurance to them, our standards. The states have done dramatic work on unifying coming up with uniform standards with relate to solvency. They've got intricate mechanisms for investment limitations to reduce exposures to single issues. Derivatives restrictions have been applied, minimum capital requirements. And so we have plumbed the depths. And yet when we look at the system that has been they're trying to institute in Europe, the Solvency II program, 75% of the firms could not even qualify the firms. I'm sorry, you're talking to me? Oh, okay. So 75% of the firms felt like they couldn't compete internationally, and it limited their ability to write business. Now, at the end of the discussion, where my real concern lies is that Europe does not have a well-established oil and gas industry, and many states don't. And our states don't have to worry about it if they don't have that industry. But 40% of our tax revenues in New Mexico come from the oil and gas business. If you're going to pay your teachers what we pay them today, then 40% of that money comes from oil and gas. And if we get inferior standards or standards that do not understand the business well enough from our European cooperation and a vote of whoever it is at FIO that would have the vote, or whoever that is, then I can see where it would be very difficult to do the business that we do in the oil field to make energy available, to make it the most abundant energy source in the world. And so I worry about long-term competitiveness, not in the insurance market, but in those markets where we specialize as a country, where we specialize as a people. I think we should serve up the strength of our nation rather than looking at other people to send their requirements in. And so I listen to the gentleman, and we'd yield. I see you've got the question, so.
If the gentleman would yield. Look, I don't disagree with a lot you said. I too believe that the executive branch does encroach, and it's going to continue. That's why I oppose giving the ability to designate special projects to the White House, and we give up earmarks. But the difference here is, on this issue, is that the law is on our side. We have a Supreme Court ruling, 1869, Paul versus...
I understand. If I could take back my last 19 seconds, I I worry because I've seen the law on our side before, and we have capitulated for whatever reasons. So the idea that we don't have to accept it is, and that was your term, is one that I have not seen play out, because I see us, for whatever reason of accommodation, accept things which are punishing to American jobs, and I think right now that would be a mistake. So yield back, Mr. Chairman, support the bill wholeheartedly.
Time of the gentleman has expired. For what purpose does the gentleman from Wisconsin seek recognition?
Strike the last word.
Gentleman is recognized for 5 minutes.
I think this is a great debate, and I'm heartened to see that many of us are on the same page about wanting to make sure we protect our U.S. state-based system. I agree with Mr. Sherman as well. I thought he was articulate, shares some of the concerns that I have with the administration. And this isn't just the Obama administration. This is, I think, with all administrations, executives, whether they're Republicans or Democrats, like to consolidate power in the executive. And it's incumbent upon this institution to start to reassert ourselves and take control back. My good friend from Missouri, the fact that we might not have to accept what is negotiated if we don't like it, I would agree that always doesn't bear itself out. Oftentimes, international agreements are reached and they're forced upon us. And if the law, you say, is on our side, okay, well then maybe this is a belt and suspenders approach to make sure that we're going to give strict guidelines to those who go out and negotiate on our behalf, to empower Congress to actually have an up or down vote to say yes or no, whether we agree with the guidelines and recommendations which we gave our negotiators. I think that's all, really important stuff. I want to just thank Chairman Luetkemeyer. This was not an easy process. There are a lot of different opinions and views and interests that have come into play. I thought he'd have even more gray hair than he has right now, what he's gone through over the past couple of months, trying to strike the right balance. And I think we have a balance that the American insurance industry can buy into. I think we have bipartisan buy-in for the most part, just not on every point, but we all are, for the most part, on the same page on what we're trying to do here. And I think that is a really good thing. Our American state-based insurance model has worked incredibly well. We're here to solely protect our policyholders. It's worked for 150 years. It was effective in the 2008 financial crisis. This system works. It works well. We want to protect it, and we want to make sure that those who go negotiate on our behalf don't get duped, don't get hoodwinked, don't get worked over, but actually fight hard and make sure this system is protected. I'll just note in my state, I have a lot of small insurers, and this is really important stuff for them. They couldn't be more supportive of Chairman Luetkemeier's bill because, frankly, it's an issue of survival for not just in the state of Wisconsin, but I think in all of our districts, for small insurers to still be able to compete and thrive and serve our communities. So with a full heart, I am supporting Chairman Luetkemeier's bill, and I hope we get a good bipartisan vote that sends a message to the Senate that this is something that should be picked up, passed, and go to the President's desk. With that, I would yield back.
Gentleman yields back. For what purpose does the gentleman from California seek recognition?
I have an amendment at the desk, and this is the Royce 127 amendment.
We will pause while the amendment is distributed. Members wishing to speak on the underlying bill will be recognized after disposition of this amendment.
And Mr. Chairman, just to clarify for my colleagues, this is the study amendment, not the definition amendment. This is Amendment 127.
Has every member received a copy of the amendment? The clerk will report the amendment.
Amendment offered by Mr. Royce, page 12, after line 24, insert the following new subsection, D, GAO report on transparency of outside organizations.
Without objection, the reading of the amendment is dispensed with, and the gentleman from California is recognized on his amendment.
Thank you, Mr. Chairman. As I said at the hearing that we had back in February, I share the stated goals of increasing transparency and accountability in international regulatory discussions and applaud the work of this committee, that the work the committee has done to shine a light on the activities of the Federal Reserve and the Treasury Department at the IAIS and the Financial Stability Board. And in that vein, this amendment seeks to add even more transparency by asking the GAO to report on the activities of outside groups involved in international insurance discussions on behalf of state insurance regulators. It will not surprise you that with an annual budget of $100 million, the National Association of Insurance Commissioners sends more staff to these international meetings than Treasury and the Federal Reserve combined. In fact, staff members of the NAIC chair subcommittees. They chair subcommittees at the IAIS. So this amendment simply asks the GAO to report on the level of involvement of those outside groups, their budgeting process, and the extent to which any of their work product has the effect of establishing national standards. When the Treasury Secretary and Treasury employees are involved in international insurance discussions, we know they must and will be transparent and be accountable due to the nature of their jobs. And if and when the state insurance commissioners act in the manner contemplated by Mr. Luchtemeyer's bill, we know that they must and will be transparent and accountable due to the nature of their jobs. We should be concerned, however, when actors that are not transparent and accountable to the political process are involved, and hence the transparency requirements in the underlying bill will make sure they are transparent. And this is equally true of the non-governmental, private, outside groups that would be covered. They're covered by this amendment. Therefore, I think this amendment aligns with the intention of the bill to bring accountability and transparency to all actors involved in international insurance discussions on behalf of the U.S. consumers that we represent. And I yield back, Mr. Chairman.
Gentleman yields back, who seeks recognition. If there's no, for what purposes, gentleman from Missouri seek recognition?
Move strike last word.
Gentleman is recognized for 5 minutes.
Thank you, Mr. Chairman. I'd like to thank the gentleman for offering his amendment. I think, you know, if you look at the name of what the bill we're discussing here, it's a Transparent Insurance Standards Act. You know, we're trying to find a way to add transparency to the process of the Federal Insurance Office and the Fed, who represent us in international negotiations. And the NAIC is a regulatory body, association, I should say, represents the regulatory body. And I think it's important to understand the relationship between all these three, because at the end of the day, FIO is not a regulator. The statement was made a while ago by the ranking member that sort of have left the inference that FIO is a regulator. It's not. There are no regulators at the federal level unless you count the Fed, talking about regulating the insurance industry through the banks that are a part of a holding company of an insurance company. So they are regulated at the state level. And so as a result, those 50 commissioners around the country have a representation at this, at the IAS, because they are the real supervisors of regulation in this country. And so I think it's important to maintain that, and I certainly don't have a problem with, again, providing oversight over those folks, which is what the gentleman's amendment is trying to do. I have no problem with that. I think it's probably a good idea from the standpoint that we always, you know, sunshine is certainly not a bad thing, and I appreciate the gentleman's amendment. So I think, you know, having that sort of sunshine and that transparency on what they're doing, that supervisory body is doing, is also good for us to be able to see. So with that, I certainly support the gentleman's amendment, and I urge its adoption. I'll yield back.
Gentleman yields back. Is there any further discussion on the amendment? If not, the question now occurs on the amendment offered by the gentleman from California. All those in favor shall signify by saying aye. Aye. All those opposed shall signify by saying nay. In the opinion of the chair, the ayes appear to have it. The ayes have it, and the amendment is adopted. Is there further discussion on the underlying bill? Okay. There being no further discussion or amendments on the bill, the question now occurs on adoption of the substitute amendment offered by the gentleman from Missouri as amended. All those in favor shall signify by saying aye. Aye. All those opposed shall signify by saying nay. In the opinion of the chair, the ayes appear to have it. For what purpose does the gentleman from Missouri seek recognition?
Request a recorded vote, Mr. Chairman.
Oh, I'm sorry. This is on adoption of the substitute.
Oh, okay.
Gentleman withdraw.
I'm
Okay.
sorry.
So all those in favor shall signify by saying aye.
Aye.
All those opposed shall signify by saying nay. In the opinion of the chair, the ayes appear to have it. The ayes have it, and the amendment as amended is adopted. The question now occurs on ordering the bill as amended reported to the House with a favorable recommendation. For what purpose does the gentleman from Washington seek recognition?
Have an amendment to the substitute.
Okay, there we go.
We'll pause for a moment and allow the amendment to be distributed.
Thank you.
Have all members received copies of the amendment? In order to accommodate the Heck Amendment, without objection, the vote on the adoption of the Lukemeyer Amendment as amended will be set aside, and we'll proceed to consider the Heck substitute to the Lukemeyer Amendment. The clerk will report the amendment.
Amendment offered by Mr. Heck, strike all and replace with.
Without objection, the reading of the amendment is dispensed with, and the gentleman from Washington is recognized on his amendment.
Thank you, Mr. Chairman. Thank you for your flexibility too, sir. This amendment seeks to substitute for the Lukemeyer Amendment, frankly, a simpler approach, which would guide the international insurance standards negotiations by two very simple, and I dare say elegant principles. Number one, that those negotiations be consistent with and reflective of existing U.S. laws and policy. And number two, that the team shall consult with and seek to include state insurance commissioners or their delegates, the people who actually regulate the insurance industry in this country. Simple and elegant. I offered as a substitute because while appreciating very much the chair of the subcommittee's approach in the form of 5143, I find it overly complex, and indeed at times I'm struggling to determine what the simple policy objective is. And also because there are elements of it which are outside these two principles, which are all I think are really required. I support international negotiations in this regard, but if and only if they are predicated on these principles. And I dare say I don't think they are about safety and soundness as has been suggested. You know, I'm reminded of that old parable about the blindfolded people that felt a different part of the elephant and concluded it was something different. And I feel like that's what's happened here, because the example of AIG has been invoked, the poster child, as it were, of lax regulation. I thought Mr. Sherman from California did an outstanding job of reminding people that the business autopsy performed by AIG revealed that the portions of AIG's business that were regulated by state entities, in fact, were sound. But he left a pretty interesting, crucial piece out, namely that the parts that were regulated by the federal government are what collapsed. The same federal government we're now asking to go to London or Basel or wherever. So I don't think this is about safety or soundness or consumer protection at all as it relates to what occurs in this country. Indeed, we have 150 years, as has been suggested, of excellent regulation at the state level, first by Supreme Court decision, then by adoption of the McCarran-Ferguson Act in 1945. I want to make sure that we have no possibility for an end run on the principle of McCarran-Ferguson, because if it ain't broke, don't fix it. And nobody has suggested that state-based regulation is broken here. Nobody's offered evidence as to why it needs to be done. Let me remind everybody as well about the carefully crafted bargain struck in 1945. In public policy terms, this is the equivalent of a sacred covenant. We will allow states to regulate the insurance industry, which had already been case law for 90 years, and in exchange for that, we will grant insurance companies large exemption from antitrust laws. We are upending, we're opening the door, we're unlocking the door to upending that sacred covenant on one side, but not on the other. It stands, it works, we should proceed. I don't want to upend. I don't want to turn back the clock on state-based regulation that has worked so well for consumers and for safety and soundness. And I think if we just set forth these simple principles, it has to be consistent with state law and federal policy. It's been asked, well, how would that be possible to implement? Well, I've got a question in response to that. Not to embrace that it be consistent with federal law and state law and our case law is to suggest that it might not be, in which case we, in fact, have thrown out McCarran-Ferguson. Again, I don't want to do that. I don't think that serves the consumer's best interest, and I know it doesn't serve investors' best interest who are concerned about safety and soundness. Now, later on, if I am granted the permission of this committee, I will withdraw this amendment, reluctantly, very reluctantly. I hope first, however, that we have some discussion about this basic approach, principle-based. I'm not giving up, and I'm going to craft a letter to send to Treasury asking them to submit to written confirmation what it is that they would agree to, consistent and reflective of these two principles. And I'm not optimistic about that, because I didn't start this effort yesterday. We've been at this for months. My staff was in negotiations until 3 a.m. They were resumed by other parties this morning. And every approach we took, any permutation on these two principles met with resistance. But I think it's worth one more effort. Should that letter, if I may just finish, please, Mr. Chair, should that letter not meet with success in a fairly short period of time, I will introduce as a standalone bill the provisions of this amendment, because I believe that strongly in state-based regulations.
The time of the gentleman has expired. I'm sorry, did the gentleman withdraw or not withdraw?
I did not.
The gentleman did not withdraw. Is there any other discussion on the amendment? There is further discussion on the amendment. However, House votes have been called. This is expected to be roughly a 30-minute vote series. The committee will reconvene immediately after votes on the floor. There are 9 minutes and 19 seconds remaining in this vote. The committee stands in recess.
Okay.
Discussion of the amendment. For what purpose does the gentleman from Missouri seek recognition?
Move strike last word.
Gentleman is recognized for 5 minutes.
Thank you, Mr. Chairman. And I want to thank Mr. Heck for his amendment. I think that it shows that there is bipartisan concern for the situation we have that has developed over the last couple of years here with international insurance standards being discussed in an international body, and where are we as a country? And I think, before we started working on my bill, whenever the issue was brought up, what I did is sit down with industry representatives and said, look, we have FIO, as a result of Dodd-Frank, representing us at the table in Basel on these negotiations. Do you want representation or do you not? Is it something that you think is important or do you think it's not important? And the resounding answer was yes, it is important. We need to be there to be able to be represented, to have advocates for us, to be mediators for us. So I said, okay, if that's the case, how do you want to structure this? Because at the end of the day, I believe that it's important for Congress to have a say in this. We've got the other regulators. We have FIO, who is an executive branch representative. But where are the people's representatives in this? Where is Congress in this? Where do the people's best interests get protected? I think that's with the representation of Congress, and that's why we want to be in the middle of this, I think. And this is the way we've structured this bill. And the gentleman takes a couple of steps in the right direction, but I think I would like to go a step further. I believe that he leaves the bureaucrats in charge of the standards and agreements that are developed at the table internationally, while I believe that my bill actually puts the people's representatives in charge. And I think that's where we need to be. I think we need to have a say in this. I think it's vitally important because at the end of the day, we represent those interests. And quite frankly, as I've talked to the representative from the Fed, Mr. Sullivan, and I've talked to the Director McGrath of FIO, they are thankful that we're here. They are thankful that we're providing oversight. They are thankful because it gives them the leverage to negotiate with the folks at IAIS. And myself and some of my colleagues actually met with, this last fall, the executive director and some other folks at IAIS. And we imported on them that, hey, whenever our guys are here and they make commitments, we in Congress are going to have the last say on this, and they have to understand that. And so that also adds to the leverage that our representatives have, and they're appreciative of that. So what we're trying to do in the bill is not necessarily curtail their abilities, but really enhance them to give them the leverage they need to put guardrails on to make sure that they are within the boundaries that we want to have done here. I don't think there's anything wrong with that. But at the end of the day, I think Mr. Sherman pointed out some things that I think were important as well with regards to the representation and the oversight. We in Congress don't just legislate, we also provide oversight. I think that's an important thing that the insurance, the Housing and Insurance Committee has to do, is provide oversight, especially in this situation. And I think we try to structure a bill along those lines. Not everything that's come out of this IAIS has been to the betterment of the industry. In other words, higher loss observancy draft rule and the temporary equivalency rule are not necessarily slam dunk wonderful things that have come out of there. Those things have not been perfect, and I think we need to provide ourselves a way to do this. And I think at the end of the day, we have tried to form the bill that we've got to thread the needle between the biggest insurance companies and the smallest insurance companies in Congress. And Chairman Duffy made that point that there's a wide variety of folks that we're trying to work with here that have varied amounts of interests. So I think that what we've done is try to find that fine line, and I think we've done a good job. But I'm fearful that Mr. Heck's amendment, while it's well-intentioned and I like the direction he goes, I don't think he goes far enough, because at the end of the day, I think the people's representatives need to be at the table and also approving what goes on. So with that, Mr. Chairman, I yield back the balance of my time.
Gentleman yields back the balance of his time. Who seeks recognition? For what purpose does the gentleman from Missouri seek recognition?
We'll strike the last word.
Gentleman's recognized for 5 minutes.
Mr. Chairman, I only heard the end of my colleague from the great, miraculous state of Missouri, which produced both the World Series champs, Kansas City Royals, and then 3 years earlier tonight, St. Louis Cardinals. However, the Heck Amendment actually is more in line with your legislation than any of the comments, including Mr. Sherman's earlier today. So I think that what he was trying to do is streamline, frankly, what he's saying in one page, what your legislation says, and whatever number, significant number of pages. So I would just ask that you look at the areas of agreement in the Heck Amendment. And because frankly, I don't think there's a lot of disagreement on this side of the aisle from what your original legislation is. I think we have some different levels of concern. Mine were expressed. I've said it over and again. The law is on our side. We've got a Supreme Court decision. We've got a 1945 Congressional Act that actually says we can do nothing that would negate what they had in their legislation of 1945. So I appreciate the dialogue and exchange, but this is one of those issues where I don't think we're that far apart. I'll yield back.
Gentleman yields back. For what purpose? The gentleman from New Jersey. Gentleman is recognized for 5 minutes.
Yeah, thanks, Mr. Chairman. And I also want to congratulate or support the gentleman from Washington for his idea here and his commitment to state-based regulatory regime. And you're right, I think you said it during your comments about the history of state-based regulations, and it's worked well for this country for over century, over 150 years. And what you're trying to do, and I think what we're saying we're all trying to do, is to advance the inclusion of the states and advance the inclusion of the lead regulators, the lead prudential regulators in the negotiations, and so that these decisions are made in a proper manner. But I also want to commend the chairman, Lukemeyer, and also your staff as well for your work here, and also for working with our staff as you work to strengthen protections for the state-based regulatory regime. The underlying bill, the transparent insurance standard, does do what you're trying to do here: provide comprehensive and robust oversight of the international standard setting for insurance companies. And I look forward for it coming out of committee strongly and then coming off of the floor strongly as well in a bipartisan manner. And with that, I yield back.
Gentleman yields back. For what purposes? The ranking member seek recognition.
I move to strike the last word.
Gentlelady is recognized for 5 minutes.
Mr. Chairman and members, I would like to thank the gentleman from Washington, Mr. Heck, for his work and for opening up this dialogue on international insurance issues. I have an appreciation for the work and the time that he's put into this and for his passion on this issue. And so while there's a disagreement, and I and some feel the bill goes a little bit too far, we think that perhaps it may be a little bit overly prescriptive in its limitations on federal representatives and overly broad on the scope. We need some international insurance standards that make sense for the United States, and I know that's what you're interested in. And it's also important that we really understand the legal framework that basically assures international agreements should be adopted through domestic regulatory procedures. So what I'm looking forward to is continuing to learn more about the various ways that our federal representatives are engaging with the state insurance commissioners and are advancing their issues and concerns. I think this discussion that you have opened up, particularly on this side of the aisle, is instructive, it is meaningful, and you have made a commitment to continue to work on this. This is not an end to your work, and I look forward to working with you and I thank you for the patience and the time that you've put into it. So I yield back the balance of my time.
Gentlelady yields back. Who seeks recognition? Is there any further debate on the amendment? If not,
Mr. Speaker.
What purpose does the gentleman from Washington seek recognition?
Ask unanimous consent to withdraw my amendment at this time.
Without objection, the amendment is withdrawn. Is there further debate on the bill? For what purpose does the gentleman from Kentucky seek recognition?
Move to strike the last word.
Gentleman is recognized for 5 minutes.
Thank you, Mr. Chairman. And at the risk of repeating some of the arguments that have already been made, I did want to offer my support and words of support in favor of this legislation. I want to commend Chairman Luchtmeyer and his staff for the significant work that went into crafting this legislation, balancing the diverse interests of several industry stakeholders and members, including myself. And I want to also thank Congressman Duffy, Congressman Huizenga, and the chairman of the full committee for their involvement, active involvement as well. For about 150 years, more than 150 years, the American insurance industry has been regulated at the state level. And this has enabled the tailoring of regulations and business models to local circumstances for insurance companies of all types, structures, and sizes. This system has provided our domestic insurance industry a competitive advantage in terms of consumer choice and decentralization of risk in our financial system, contrasted with the centralized national champion insurance models of Europe. Dodd-Frank affected several policies that over time threatened to upend this existing regulatory infrastructure by interjecting the federal government and ultimately international regulators into the oversight of American insurance. Regardless of one's views on the appropriateness of federal oversight of insurance, I think we can all agree that Congress should have a stake in this process and engage in robust oversight of the development and implementation of any federal or international standards. And the Transparent Insurance Standards Act achieves just that. By now, we have all heard from constituents in the insurance industry concerned that the negotiations at the IAIS are opaque and that it is unclear exactly what interests Team USA represents. Those of just the federal regulators themselves, industry, or preserving the existing state-led regulatory structure. This has left our constituents wary of potential regulatory upheaval in their industry that may tilt the playing field in favor of European competitors, chill investment, and reduce competition. H.R. 5143 sets clear objectives, rules of the road for FIO and the Federal Reserve that must be met during the negotiations and ultimately adoption of any international insurance standards or covered agreements. It ensures that state insurance commissioners are directly involved in the negotiation process. Before adoption of such an international standard, the public and Congress must have access to the final text and the opportunity to provide comments. FIO and the Fed would be required to come before this committee and Senate banking twice a year to brief us on progress and implementation, as well as filing substantive reports. And if the standards include capital requirements, the Fed must have promulgated a domestic standard first. This will prevent the tail wagging the dog that we have seen with the implementation of other FSB capital and liquidity standards drafted abroad and then implemented or made even stricter at home. These reforms and several other provisions ensure that if the United States is going down the road of federal and international insurance standards, the process is transparent, and Congress, the states, and the American people have a say. And so for these reasons, I'm a proud co-sponsor of this legislation, and I urge its approval by the committee. And once again, I congratulate Chairman Luchtmeyer and his staff on their great work. And with that, I yield back, Mr. Chairman.
Gentleman yields back. Is there any further discussion or amendments to the bill? If not, the question now occurs on adoption of the substitute amendment offered by the gentleman from Missouri as amended. All those in favor shall signify by saying aye. Aye. All those opposed shall signify by saying nay. In the opinion of the chair, the ayes appear to have it. The ayes have it, and the amendment as amended is adopted. The question now occurs on ordering the bill as amended, reported to the House with a favorable recommendation. Those in favor shall signify by saying aye. Aye. All those opposed shall signify by saying nay. In the opinion of the chair, the ayes appear to, for what purpose does the gentleman from Missouri seek recognition?
I'd like to request a recorded vote, please.
Recorded vote has been requested. All those in favor of a recorded vote shall raise their hand and be counted. A sufficient number having raised their hands, a recorded vote is so ordered, and pursuant to subsection C5 of Rule 3 of the committee rules, vote on this question is postponed. Now, pursuant to notice, I call up H.R. 4850. The clerk will report the bill which was distributed in advance.
H.R. 4850 to amend the Securities Act of 1933 to exempt certain micro-offerings from the registration requirements of such act and for other purposes.
Without objection, the bill is considered read and open to amendment at any point. The chair recognizes the gentleman from Minnesota, Mr. Emmer, to offer an amendment in the nature of a substitute. Does the gentleman have an amendment at the desk?
Yes.
Gentleman has an amendment at the desk. Copies of the amendment have already been distributed and are on the dais. The clerk will report.
Amendment in the nature of a substitute offered by Mr. Emmer. Strike all after the enacting clause and insert the following. Section 1, short
Without
title.
objection, the amendment is considered read and will serve as base text for purpose of amendment. The gentleman is recognized for 5 minutes.
Thank you, Mr. Chairman. While government doesn't create jobs, with the help of the President, Congress can set federal policies that establish a pro-worker and pro-business environment that lifts people out of poverty, helps families, and allows Americans to realize their dreams. One problem we're experiencing today, one problem that is impeding job growth in this country, is access to capital for small business. Often, American businessmen and women can't get the loans they need to start a new enterprise or grow an existing one. Additionally, if a firm would like to publicly sell stock to raise money, it must register with the Securities and Exchange Commission, which costs $2.5 million on average, an amount most small business simply can't afford. Small business creates roughly 70% of the new jobs on an annual basis in this country. Today's small businesses are tomorrow's success stories. Just think of all the great businesses in this country that started with a dream in a garage. Amazon, Apple, Microsoft, Disney, Harley-Davidson, and Minnesota's own Medtronic, just to name a few. We want to empower the entrepreneurs in this country to dream, innovate, and create jobs that grow our economy. That's why we introduced the Micro-Lending Safe Harbor Act with a number of my colleagues on this committee, to make it easier for the entrepreneur and small businesses to raise money from family, friends, and their personal networks without running afoul of the vague and undefined, quote, private offering safe harbor provisions in the Securities Act of 1933. The Micro Offering Safe Harbor Act clarifies and enhances existing law so that job creators, entrepreneurs, can easily raise capital within the confines of an easy-to-understand provision without the help of an expert. In other words, without the need for extreme and excessive attorney's fees that the law requires now. I thought our original bill, as offered, was good. But after listening to Congresswoman Carolyn Maloney's comments on the bill during our legislative hearing, I decided to incorporate her suggestions. Now, with this amendment, incorporating Ms. Maloney's suggested modification, the Micro-Lending Safe Harbor Act requires all three of the following criteria be met simultaneously in order to trigger a safe harbor exemption for a security offering. Number one, each purchaser must have a substantive pre-existing relationship with an owner. Number two, there are no more than 35 purchasers of securities from the issuer that are sold in reliance on the exemption during the 12-month period. 3, the aggregate amount of all securities sold by the issuers does not exceed $500,000 during the 12-month period preceding. The bill also exempts any of the aforementioned security offerings from blue sky laws while maintaining anti-fraud provisions at the federal and state level. These provisions protect Americans from criminals trying to swindle them out of their hard-earned money and making capital more accessible to businesses by investors from around the country. Again, we are not changing the law as the safe harbor provision already exists. We are simply clarifying and enhancing the language. The Micro Offering Safe Harbor Act will enable businesses to raise much-needed capital because, unfortunately, there are 3 million fewer small business loans made on an annual basis today than there were before the 2008 crisis. This proposal, this bill, exempts small businesses so they would be able to confidently go about raising capital without having to pay for costly securities experts and without the fear of lawsuits if they operate within these easy-to-understand parameters. The Micro Offering Safe Harbor Act, which is endorsed by the National Small Business Association, the Small Business and Entrepreneurship Council, and Engine, quote, the voice of startups in government, is a next-generation vehicle for capital formation. The time has come for Congress to come together and help small business help themselves by making this important update and improvement to the Securities Act of 1933. I want to thank the chairman for calling this markup today, and just note that Democrats and Republicans agree that we need to help our small businesses grow and prosper, and I hope that the Micro Lending Safe Harbor Act is one of the many bills considered today that leaders in both parties can support to show their support for more opportunities and better lives for all Americans, and I yield back.
Gentleman yields back. For what purpose does the ranking member seek recognition?
Strike the last one.
Gentlelady is recognized for 5 minutes.
Mr. Chairman and members, this bill would create yet another exemption from the public offering requirements of our federal and state securities laws, an exemption which I do not believe is warranted and may actually harm investors and the integrity of our markets. Specifically, the bill would provide an exemption for offerings where each investor has a substantial pre-existing relationship with the company, and there are 35 or fewer purchases, and the aggregate amount sold in a year is not more than $500,000. The bill also contains a bad actor disqualification provision to prevent criminals and fraudsters from using the exemption. While I applaud the inclusion of this provision, it is not enough to save this bill. First, the bill does not go far enough to protect investors, which could easily be scammed out of their money without the SEC even knowing. Unlike the protections in other securities offering exemptions, the bill contains no notification requirement to the SEC, preventing it and the state securities regulators from overseeing this new market. The bill has no restriction on resale, making the initial purchaser limit illusory, as they would quickly sell the securities on to hundreds of others in an effectively public offering. It allows companies to use general solicitation to find and develop their pre-existing relationships prior to selling their securities. And history tells us that these and other investor protections are important. For example, in 1999, the SEC revised its Rule 504 exemption to prohibit general solicitation and restrict the sale of securities after examination, and enforcement reports found that, quote, the freely tradable nature of these securities may have facilitated some later fraudulent secondary transactions in the over-the-counter markets for securities of micro-cap companies, end quote. In particular, Rule 504 has been used in fraudulent pump and dump schemes. Second, the bill fails to take into account the numerous other exemptions we have for small dollar offerings, one of which we're addressing today in Mr. McHenry's crowdfunding bill. Other small dollar exemptions include Rule 504, Regulation D, and Regulation A, which we just changed in the Jobs Act to facilitate small company offerings, as well as the newly implemented crowdfunding exemption. Given these existing exemptions, which provide ample opportunity for companies to raise capital while protecting for investors, I fail to see the need for H.R. 4850. The bill would simply create a loophole in the law for companies to secretly conduct public offerings and even scams. For this reason, I urge my colleagues to join me in opposing H.R. 4850. I yield back the balance of my time.
Gentlelady yields back. For what purpose does the gentleman from Texas seek recognition?
Strike the last word.
The gentleman is recognized for 5 minutes.
Thank you, Mr. Chairman. I'm proud to speak in support today of Congressman Emmer's bill, H.R. 4850, that will help clarify rules for investors and small business owners just starting out. Mr. Chairman, raising capital in today's regulatory environment is really hard. In the case of startups, scarce resources spent on lawyers, paperwork, and understanding outdated laws stifles innovation and growth and frankly reduces the ability to be successful. I want to take a minute to stress the importance of giving small, new businesses the added flexibility to not only comply with the Securities Act of 1933, but provide a safe harbor in the case they meet certain requirements. And the numbers support us taking action. Over half of the 120 million American workforce is employed by small business. In addition, about 70% of new net jobs created today are from small businesses. Taking action just makes sense. As my colleagues have already noted, having pre-existing relationships with your investor is key. As someone who has personally raised capital and has been asked to be an investor, having strong relationships is vital and very important. I think it's important to remember that those who seek investor funding from their friends and family should not be subject to the same rules that larger corporations face under federal security laws. Small companies often are on the forefront of technological innovation and job creation. One-size-fits-all security regulations often written for larger public companies create significant obstacles for those seeking to go public. By simply clarifying what constitutes a non-public offering of securities, this committee can send a strong message that we understand the challenges most startups and entrepreneurs face. Mr. Chairman, as we have often heard, everything comes down to cost. If we can remove just one burden for new small business owners, and there's certainly more that we can do, then I'm all for it. Again, I think this bill is simple, straight to the point. I'm proud to be an original co-sponsor. I urge all my members to support its passage. I thank my colleague for bringing it up. Thank you, and I yield back the balance of my time.
Would you yield to the chairman?
Yes, sir.
I thank the gentleman for yielding. I suppose in listening to some of the debate on the other side of the aisle, the best way to prevent securities fraud is to prevent securities. Don't ever have a security offering.
Okay.
I should note that in the legislation from the gentleman from Minnesota, in no way, shape, or form does H.R. 4850 amend or lessen the SEC's authority to prosecute fraud and abuse. But I would ask the question, how many more people in America have to remain unemployed? How many more people in America are simply going to give up and leave the workforce because they can't find work? How many more people have to remain underemployed in jobs that are beneath their skill levels or hours that won't give them a wage that can help sustain their families? When are we going to get the SEC to focus on the core mission of capital formation? So what the gentleman from Minnesota is doing, again, it is a modest bill, but colleagues, small business lending is at almost a 20-year low. Entrepreneurship, launching new business ventures, almost at a generational low. With the exception of our national defense, is there anything more important we can do than to get this economy working for working people? And so the gentleman from Minnesota, again, has offered a modest bill to once again, completely in our jobs bill lane, to help jumpstart, get capital to help capitalize these small businesses and get America back to work. And so to me, it is such a simple, such a common sense piece of legislation. I would hope that every member would support it and prioritize the interest of the unemployed, of the underemployed, for all the millions of working Americans who know this economy continues not to work for them, whose paychecks are stagnant, whose savings continue to be decimated. And so this is a wonderful opportunity for this committee to once again come down on the side of those who are hurting in this economy and to get these small businesses and these new entrepreneurial ventures launched. And I could not be more proud of the gentleman from Minnesota for his leadership in this regard. I thank the gentleman from Texas for yielding time to the chairman, and I believe the gentleman yields back who seeks recognition. Does the gentleman from Texas seek recognition? Mr. Hinojosa, did you seek recognition? Could you hit your microphone, please?
I have an amendment at the desk.
I tell you what, we have, I think, 2 members left in the queue for general debate. If we could go to them first, we'll come back to the gentleman from Texas from his amendment. The gentleman from New Jersey seeks recognition. I'm sorry, the gentleman from Kentucky. For what purpose does the gentleman from Kentucky seek recognition?
Move to strike the last word.
The gentleman is recognized for 5 minutes.
Thank you, Mr. Chairman. By most any measure, our now 7-year-old economic recovery has been disappointing. The labor participation rate remains mired at levels not seen since the late 1970s. Business creation is at a 35-year low. More American businesses are dying than are being created. Let me repeat that.
More American businesses today are dying than are being created. That is a sustained trend that is unprecedented in the post-World War II era. And we all know wages have been stagnant as well. The result has been a sense among our constituents that the American dream is dimming. Many of our countrymen still feel like we are in a recession. What job creation has become is highly concentrated in a few major cities, which means that metrics such as national unemployment can mask the fact that in mid-sized cities, in smaller communities, in rural America, in many places in Kentucky's 6th Congressional District, we're getting left behind. And that animus has been reflected in the rhetoric of this year's presidential campaign, both on the Democratic side and the Republican side. According to the Small Business Administration, small businesses employ a majority of Americans and account for 66% of all net new jobs since the 1970s. So Congress must do everything in its power to facilitate the incubation of startups and mom and pops to put the American people back to work and drive wage growth. The Congress, led by this committee, made a first effort in supporting startups with the Bipartisan Jobs Act, but much more remains to be done. And that's why I support strongly, as an original co-sponsor, Mr. Emmer's legislation, the Micro Offering Safe Harbor Act. This legislation provides regulatory relief to facilitate the creation of small businesses. And that is important because the bill is meant to empower the sorts of small businesses that a group of friends might have started in a garage, some work colleagues who decided to go out on their own, the person with a great recipe or an invention that their neighbors as early adopters love. One business in my district comes to mind. In central Kentucky, we're known for our distilled spirits industry, the bourbon industry. And there's 3 young entrepreneurs, all under the age of 40, who had a dream to build a great new bourbon distillery. But guess what? To do that, you need a lot of capital because you have to age that product over time. And so you have to have a lot of capital to start a business like that. And they're very innovative, and they've got great ideas, and they're reconnecting to our distilling heritage in Kentucky. But we don't have, and these entrepreneurs don't have access to capital that they need to really drive their dream. And so any one of these businesses, whether it's the one I just described or another one where it could be the next big thing, and it could be a meaningful source of local employment or investment, we know that there are obstacles to finding financing, and that means some of these ideas never get off the ground. Mr. Emmer's bill addresses an oversight in the Securities Act that exempts transactions by an issuer not involving any public offering without defining a non-public offering. The bill creates a narrow safe harbor for qualifying entrepreneurs to protect them from inadvertently violating state and federal securities laws, leading to an enforcement action or a lawsuit potentially years down the line. This safe harbor would only apply to an offering in which all of these criteria are met by an issuer. Each purchaser staking a share in the company must have a substantive pre-existing relationship with the issuer, director of the issuer, or a shareholder owning 10% or more of all shares. There are no more than 35 purchasers under the exemption, and the aggregate amount of all securities sold by the issuer in the 12 months before the transaction is not more than $500,000. These criteria keep the universe of potential offerings within the safe harbor small, and they ensure that they could not be considered public offerings for purposes of the Securities Act, protecting entrepreneurs from red tape and potential pitfalls that may arise due to a lack of familiarity with securities laws. So I think of these young entrepreneurs in my district who are starting the Castle and Key Distillery. I think of their desperate need for more access to capital to realize their dream, to create jobs, to provide a product in our international marketplace. And I think of President Coolidge, who once said that the chief business of the American people is business. H.R. 4850 empowers entrepreneurs to focus on just that, business, rather than legalese. This legislation will help spur the sort of small startups which we need more of, especially in the communities across America that don't have access to Wall Street investment or Silicon Valley venture capital, but instead rely on local investments. So I urge my colleagues on both sides of the aisle to stand up in support of small businesses and supporting the Micro Offering Safe Harbor Act. Yield back.
Time of the gentleman has expired. For what purpose the gentleman from New Jersey seek recognition?
To briefly strike the last word.
Gentleman is recognized for 5 minutes.
So thank you, Mr. Chairman, and I commend the sponsor, Mr. Emmer, for putting forward what I think is a pretty innovative bill. You know, originally we had passed the Jobs Act, and in that we took great strides, I guess you would say, to modernizing statute and specifically Reg D with regard to general solicitation, and that was a good step forward. That was a good step forward as far as helping small businesses, as the chairman here can elucidate better than anyone here as far as the problem we have in the economy and the necessity for small businesses and job growth. And it's pretty neat what the gentleman from Kentucky was talking about as far as a distillery needing money. So I was thinking about the other example of that, of who uses the stuff from a distillery, restaurants and that sort of thing. So that's sort of like the next step from that. So you have someone who owns one restaurant, and then suddenly, not suddenly, but after a lot of hard work, he is able to expand that to a second restaurant, both of which will be going to your state to get the distilled products for them. But now he wants to take the next step and go from 2 to 3 to 4 restaurants. How does he do that? Well, he has 2 options really right now. One, he can go to his existing investors, right? He can go to his family and his friends and basically beg them, will you give me some more money so I can buy more product and expand my business? But that's really time consuming, and that could really keep him from actually working in those businesses and expand it so he can buy more distilled products. The other way to do it is Reg D, and what we've already done in the Jobs Act. But that's really one step above that level of investor, right? Reg D was for someone who is looking for a larger capital infusion into their business, maybe just a step above where your distillery will be in a few years, perhaps. So he's put in a quandary in that situation. Either he goes to all the expense of going through hiring outside lawyers and what have you to do the Reg D approach, the existing approach, or he goes to wasting time and spending time from his business. So you came in the happy middle ground, and that's what the safe harbor provision does. It allows him to go out, maybe go to something akin to the chamber or something of that sort, and say, here's my operation, you're all familiar with me in town, here's the 2 restaurants I own on Main Street and Maple Street, and now I just want to have one on Elm Street and I'm thinking of another tree, I'm missing it right here, street, and what we need that to do so, and I want to do so in a way that I know that I will not run afoul of the exemptions delineations that's in existing Reg D. So that's really all this bill does, but that all is significant for that distiller or for that small business guy who wants to add a new restaurant or something to his chain. So I salute the gentleman and encourage all members on a bipartisan support, which this bill is, to support the bill here and on the floor as well. With that, the gentleman from Texas was looking for me to yield, but I guess the gentleman from Texas has...
Gentleman yields back. For what purpose does the gentleman from Colorado seek recognition?
Move to strike the last word.
Gentleman is recognized for 5 minutes.
Thank you, Mr. Chairman. Listening to this debate, I think that it is worth underscoring that when we look at the labor participation rate, when we're talking about economic recovery in this country, the lowest labor participation rate in about 4 decades. For the first time since we've been keeping records, more small businesses shutting down than new business startups. And as the chairman has often noted, it's tough to be able to have capitalism without capital. We need to make sure that we're having that access to real dollars to be able to start up those small businesses, be it a distillery in Kentucky to a small business in Colorado. And as I travel through my district, it's dismaying to be able to see many storefronts right now that have for sale, for lease signs that were once thriving businesses. And for that, I'd like to be able to applaud Mr. Emmer for the bill that he's putting forward today. And thank you, Mr. Chairman, for allowing this piece of legislation to be considered in the markup. The Small Micro Offering Safe Harbor Act that is included in today's markup, H.R. 4850, will exempt certain micro offerings from registration requirements under the Securities Act of 1933, thereby removing obstacles to be able to obtain funding in the capital markets for Main Street businesses. With over 28 small businesses in the U.S. and nearly 50% of the private sector workforce employed by small businesses, this is a serious dilemma for a key part of our economy. Under current conditions, credit availability has shrunk significantly, often eliminating access to capital for small businesses looking to expand, hire new employees, or purchase needed equipment. Growth is often contingent on capital, and without investment, it is easy for businesses to falter. The small businesses that would be helped by this bill are currently mired in burdensome regulations and compliance requirements that leave them vulnerable and on an uneven playing field with larger businesses. Fortunately, the non-public offerings exemption defined in this legislation will allow startups and small businesses struggling to raise capital ensure that they are not violating the law. By clearly defining what constitutes a non-public offering, businesses can be confident that they are not violating the securities laws and will be able to avoid costly compliance requirements unnecessary for micro-offerings. Removing the confusion here allows Main Street businesses to focus their resources on growth rather than on compliance. For this reason, I'm happy to support this legislation and encourage my colleagues to support this common sense measure as well. Again, I'd like to thank the gentleman from Minnesota for his hard work and his efforts on this legislation and urge my colleagues to support this bill. With that, I yield back.
Gentleman yields back. Is there any further discussion on general debate? If not, for what purpose does the gentleman from Texas seek recognition?
Mr. Chairman, I have an amendment at the desk.
We will pause and allow the amendment to be distributed. Have all members received a copy of the amendment? If so, the clerk will report.
Amendment offered by Mr. Hinojosa on page 2, strike lines 6 through 12 and insert the following. B, limitations on non-accredited.
Without objection, the reading of the amendment is dispensed with. The gentleman from Texas is recognized on his amendment.
Thank you, Mr. Chairman. I have been working closely with the author, Mr. Emmer of Minnesota, and I believe that my amendment will improve H.R. 4850 as shown the Micro Offering Safe Harbor Act as amended already by adding some key investor protections to the legislation. So before I proceed with this amendment, I wish to thank Mr. Emmer of Minnesota and his staff for working with me on the bill. Although we did not reach an agreement on all of the provisions of the bill, I appreciate Representative Emmer's willingness to work with me in the spirit of compromise and bipartisanship. His amendment, in nature of a substitute, is a substantial improvement on the original bill. Mr. Chairman, my amendment provides additional investor protections to the underlying legislation. Without some additional investor protections, I fear the safe harbor being created under this legislation will have the unintended consequence of increasing the incidence of fraud. To address some of these concerns, my amendment adds the following 5 investor protections. My amendment allows unlimited accredited investors and limits unaccredited investors to 35. Number 2, my amendment limits the amount of unaccredited investors can invest up to $5,000. Number 3, it requires the filing of just one form with the section Form D as in David. This will, at minimum, provide notice of the offerings taking advantage of this exemption. Number 4, my bill requires issuers to disclose the material elements of the offering to investors. And finally, number 5, it makes the securities issued under this exemption restricted and subject to holding periods under Rule 144. These additions, I believe, strike the right balance between providing micro issuers with a simple and safe way to issue securities and ensuring investors are protected. In exchange, micro issuers will be exempt from both federal and state securities registration requirements. To be clear, I offer this amendment today because I support the aims of the legislation. In fact, I strongly support the goals of this micro offering bill and believe we should provide our nation's small businesses with a safe and simple way to raise the needed capital to grow and prosper. Let us not forget the lessons we learned from the 1990s. Back in 1992, the SEC relaxed Rule 504 to permit general solicitation for micro-cap companies with freely tradable securities. due to a slew of fraudulent activity in that secondary market, the SEC revised the regulations in 1999 to prohibit general solicitation and establish a holding period for the securities as restricted. We would do well to remember these lessons before attempting to make similar legislative changes without protections that I've mentioned. I look forward to continue working with my colleagues on both sides of the aisle on this legislation, and I urge all the members of this committee to support and vote for my amendment. Thank you, Mr. Chairman, and I yield back the balance of my time.
Gentleman yields back. Who seeks recognition? For what purposes? Gentleman from Minnesota seek recognition.
Move to strike the last word.
Gentleman is recognized for 5 minutes.
I thank my colleague from Texas for supporting the concept, but I think there's a bit of a misunderstanding. I do not support the amendment. In fact, I oppose it. The amendment, despite its, I believe, well-intentioned, its good intention, effectively undermines the purpose and the goal of the bill. My colleague suggests this will improve it. In fact, it would layer duplicative and unnecessary regulatory requirements and costs on many small businesses that are seeking to engage in micro offerings. The reality is many of these things that this amendment would provide are already required for Reg D offerings. But the purpose of the micro offering bill today, the Micro Offering Safe Harbor Act, is not to expand Reg D, but to provide small businesses in our communities with access to early stage capital from those who know them best in order for them to expand and grow, their family, their friends, their personal network. I also want to make it clear, because I've heard it a couple times, we are not creating anything. In fact, this has been the law since 1933. The actual language in 1933, Section 4, Sub A2, exempts, quote, transactions by an issuer not involving any public offering, close quote. So the problem was the language, the safe harbor was put in place, but the non-public offering definition was not defined. So it creates a big problem. I don't come from New York. I don't come from Massachusetts. We don't come from LA. We come from a little state called Minnesota, which is kind of a suburb of Canada, right in the middle of the country, right up on the northern border. And we don't necessarily have access to these big funding sources. A lot of people in our small communities who want to take a restaurant or start a restaurant or a machine shop, some small business. You heard my colleague from Kentucky and my colleague from New Jersey talk about this. They want to go to their family and friends and raise a small amount of money, $500,000 or less. We are simply trying to make this provision that was put in the law in 1933 workable for those people. Why? Because we want to help the little guy. Why are we always helping the big guy around here? We want to help the little people who have a great idea, a big dream, be able to raise that startup capital that they so desperately need to get it off the ground without having to pay $2.5 million, which is what it costs now to get one of these public offerings off the ground, without having to pay an annual $1 million that it takes to fund this ongoing. It just doesn't make any sense. Let's make this thing work the way it was originally intended. And this idea that it's going to create fraud, the bad guys are always going to be the bad guys. They're always going to look for ways to do things, but we did not take away any of the fraud enforcement language. In fact, we maintain the anti-fraud provisions at both the federal and state level, and these provisions should protect people if the folks are doing their job. So again, I appreciate my colleague from Texas who has really made an effort to work with us. It's been nice to get to know your office and understand where you're coming from. But
will the gentleman yield?
Yes.
I respect what you just said. I come from a small business that grew to 300 employees and sales of $50 million a year, so I know the difficulties that have been described about accessing capital. But in my earlier comments, I said that in 1992, the SEC relaxed the rule, and they wound up having to revise the regulations that they'd made so much easier in 1999, so that they could prohibit the solicitation and some of the fraud that was occurring. And we saw that again happening in 2007 and 2008.
And if I can reclaim my time quickly, because
Yes.
you reminded me of something, I appreciate where you're coming from. That's the very reason that this is necessary. Because we shouldn't have the mom and pop operation that wants to expand having to go dig through SEC rulings and letters to try and figure out where they fall in. That's where all the cost is coming in. Again, this is a very small, $500,000 or less in this world today. That is a very small offering that you can, I think the 35 investors too, the average is somewhere between 10 and 14. Again, I respect my colleague from Texas, and I would oppose the amendment and yield the balance of my time.
Time of the gentleman has expired. For what purpose does the ranking member seek recognition?
Move to strike the last.
Gentlelady is recognized for 5 minutes.
Mr. Chairman, I'd like to thank Mr. Hinojosa for offering this amendment. This amendment strikes a more appropriate balance to provide investors in these exempt offerings with important protections. Let me remind you all that today we're also considering a bill to address the need for financial institutions to report elder financial abuse. Seniors are being ripped off, and in far too many cases, it's by those closest to them, those, you might say, with a pre-existing relationship. Investors, including our nation's seniors, cannot be asked to just rely on the good word of someone who works at the company and may have a so-called pre-existing relationship with them. Rather, they need basic information like financial disclosures so that these investors aren't left in the dark while, for example, the company is tanking and that the company's officers are dumping their shares. The amendment helps to address this concern by requiring relatively simple investor disclosures. Mr. Hinojosa's amendment would also significantly reduce the likelihood of pump and dump schemes by making the securities restricted. And most importantly, with the Reg D notice filing, state securities regulators who remain the frontline defense against fraud in these smaller offerings will be able to quickly respond to investors' concerns regarding suspicious activity. Although I support this amendment and will vote for it, I continue to oppose the underlying bill, as at best it is unnecessary and at worst harmful to investors and market integrity. Mr. Chairman and members, I was very pleased today to continue our work on and support the Jobs Act and crowdfunding, because those people who think somehow they know better about how to provide access to capital and provide opportunities for joint venture operations and support for small businesses should understand and know that we have demonstrated and we continue to demonstrate our concern for small businesses. And when there are bills that have credible ways by which to support small businesses, we're supportive of them and we initiate those kind of bills. So I don't want anyone to leave here thinking that somehow we don't know, we don't understand, we don't care. We do all of that, but we don't jeopardize in the name of creating access to capital and forget about all the rules to this game and put people at risk when they have limited amount of funds to invest. And they need some kind of protections from those they elect to provide some kind of protection for them. And so I support the amendment. I still have problems with the bill, and I will.
Gentlelady yields back. For what purpose does the gentleman from Texas seek recognition?
Move to strike the last word.
Gentleman is recognized for 5 minutes.
Well, first of all, I want to say I appreciate the gentleman from Texas, but I have to disagree with his amendment. But I also want to commend Mr. Helmer for a very good piece of legislation. You know what I was sitting here thinking is that the reason I'm opposing the gentleman from Texas's amendment is he's trying to reduce the amount of investment that non-accredited investors can make. And one of the things that I wanted people to think about if you'd had an opportunity to invest, say $10,000 with Michael Dell or $10,000 in Facebook. In other words, some of these companies started with a dream and a very small amount of capital, and they were able to go out and sell a business principle to people. Those people were able to invest in that and created a huge amount of wealth, but which some people are against creation of wealth. I happen to think that's a great thing about America, but the other thing is created a huge number of jobs across America. And so I think the thing about Mr. Emmer's bill is that, it's a job creator. And what it does, it lets the little guy get in on the deal. And what we've done now is, through all of these regulations that we've passed, is we're squeezing the little investor out, and we're leaving them the choices that the government thinks that that's appropriate for them. Now, you know what? The role of government is not to determine whether you make money or not. The role of government is to make sure that the playing field is as level as possible. And so one of the things that we have done with a lot of this regulation is we have basically got the government in the investment advisor business. And I don't think that anybody thinks the government's doing a real good job of generating a very good rate of return in a lot of different areas. And so I support the underlying bill, but I'm opposed to the amendment. Now, with that, I yield back.
Danielle's back, who seeks recognition. For what purpose does the gentleman from New Jersey seek recognition?
Like last word.
Gentleman is recognized for 5 minutes.
Just a question to the sponsor of the bill. You heard the allegation that if this happens, that there'll be rampant fraud and the like. Is there anything, did I miss it? Is there anything in your legislation that rolls back fraud language, fraud prevention, and all the other powers that the regulators have in this area?
No.
Okay, that was a detailed answer. Good. So, thank you. But that's all that was necessary. Thank you. So that's on the merits as far as the fraud aspect of it. The other portion, to the gentleman from Texas, I guess as you were rolling it out, I was reading it and thinking, well, there might be certain pieces to it that I agree with, and I do agree with the section BI. Line 4, but it's the other section right under it, line item 12, which is the double I, which limits it down to the $5 grand. The problem there is the examples that we were just discussing here. The distillery, the gentleman from Kentucky has gone, I have no idea what that's going to cost to build a distillery. It's probably more than $150,000, $160,000, I would think. I know what it costs. Having a running mate used to be in the restaurant business. You can't buy a piece of property, let alone a restaurant, let alone all the fixtures and everything you need for starting a new restaurant for $175,000. And why do I say $175,000? If I'm reading this right, the maximum non-accredited investor could contribute is $5 grand, and the maximum of those would be, if I'm reading it right, 35, correct? So that's 175 grand right there. So if I'm in a small town, which I have a lot of small towns, and I'm in a chamber, I'm going out to folks who would like to make a informed but a productive investment. Maybe they're not going to get in on the ground floor of the next Dell or what have you. They would like to invest. They may have more than $5 grand and would like to make a $10,000, a $20,000, or a $30,000, or whatever, to be able to get in and actually facilitate that restaurant or distillery. They're not going to be able to do it, unfortunately. And I know the gentleman has the best intentions here. And the third point is this. Who are we looking out for? We're looking out for three people. We're looking out for the business owner, the entrepreneur, the guy that has that great idea that wants to build the third restaurant. He should have the opportunity to do this. We're secondly looking out for the small time, in dollars, not in value of it, certainly, investor, the guy who is a member of the chamber or is a member of the Rotary. He wants to be able to make an investment as well, do better than the 0.02% that he's getting by putting it in his Main Street bank today. And thirdly, we're looking for the guy who is out of a job right now on Main Street and is hoping that that restaurant will open up so he can get a job, a good paying job there or in distillery or someplace else. So yeah, we're looking out for the investor, the entrepreneur, and the person who is out of work right now. And I think your bill hits each one appropriately. With that, I yield back.
For what person, gentleman? Okay, yield back. Okay.
Mr. Chairman?
Discussion on the gentleman's amendment?
Mr. Chairman, I request a recorded vote.
At the appropriate time, we'll offer. Is there further discussion? Is there any further discussion on the amendment? The question now occurs on the amendment offered by the gentleman from Texas. All in favor, say aye.
Aye.
All opposed, nay. No. Nay. In the opinion of the chair, the nays have it. The amendment is not agreed.
Let's vote again. All those in favor?
All those in favor signify by saying aye. Aye. All those opposed saying nay. Nay. In opinion of the chair, the nays have it. The nays have it, and the amendment is not adopted. Is there any further discussion? A recorded vote has been requested. All of those in favor of recorded vote shall raise their hand and be counted. A sufficient number have risen their hands. A recorded vote is ordered, and pursuant to Section C5 of Rule 3 of the committee rules, further proceedings on the amendment are postponed. Is there any further amendment or discussion? There being no further amendments, a recorded vote on the pending amendments have been postponed. Once those votes are taken, the committee will immediately consider the motions to adopt the amendment in the nature of a substitute as amended, if amended, to report to the measure. And now I call up, now pursuant to notice, I call up H.R. 5322. The clerk will report the bill, which was distributed in advance.
H.R. 5322, to amend the Investment Company Act of 1940.
Without objection, the bill is considered read and open to amendment at any point. The chair now recognizes the gentlelady from New York, Ms. Velasquez, the sponsor of this legislation, for 5 minutes.
Thank you, Mr. Chairman. The Investment Company Act of 1940 governs investment companies, including those that offer mutual funds, exchange-traded funds, as well as hedge funds. Its purpose is to protect investors and provide impartial oversight of these companies. It specifies the types of activities that such companies can undertake and establishes standards for their conduct. In doing so, it described investment companies' function and their structure, regulate various transactions among affiliated persons, outlines accounting, record-keeping, and auditing requirements of funds, and described how securities may be redeemed and repurchased. These matters sound technical, but they are the bedrock foundation of investor protection in the United States. Due to a historical artifact, however, all U.S. territories are exempted from the 1940 Act. The reason for such an exemption was that at the time the Act was being considered in 1940, the U.S. territories were too distant from Washington, D.C., thus making travel to them cost-prohibitive. Since then, Hawaii and Alaska have since become states and are located further from Washington, D.C. Obviously, the cost of air travel is no longer cost-prohibitive and not a reason to exempt territories from the 1940 Act. As a result of this exemption, investment companies located in U.S. territories can sell products to their residents and not be subject to the oversight, disclosure, and conflict of interest requirements that such companies located in the mainland U.S. are subject to. The outcome is that those located in the U.S. territories have been subject to investment losses, some resulting from behavior that would have been prohibited if the Act applied to the island's investment companies. To address this matter, I have authored H.R. 5322, the U.S. Territories Investor Protect Act. I want to especially thank Chairman Hersenling and his staff, as well as Ranking Member Waters and her staff, especially Chris Erickson and Amanda Fisher and Lisa Pito, for their assistance throughout the last 9 months in a productive manner. Such cooperation was critical to developing an approach that would apply the Act in a manner sensitive to investors and investment companies. This legislation would apply the 1940 Act to the U.S. territories, including Puerto Rico, Guam, the U.S. Virgin Islands, the Northern Mariana Islands, and American Samoa. In order to permit investment companies to comply with the legislation. The legislation provides for a 3-year compliance period with an option at the approval of the SEC for an additional 3 years. I think that this time period balances the need to bring these investor protections to the territories with the attendant compliance requirements. In particular, investors in Puerto Rico will benefit dramatically from this additional coverage. Not only have there been instances where the 1940 Act could have protected investors from losses, but the current fiscal crisis on the island is creating budgetary challenges for the local government. Having additional federal oversight of investment activities is now especially critical for the island's residents. In closing, I want to thank Chairman Herselin again for his cooperation and bringing this important bill forward. I ask members to support this bill, and I yield back the balance of my time.
Gentlewoman yields back. Who else seeks recognition? What purpose is the ranking member?
Move to strike the last word.
Recognized for 5 minutes.
I'd like to congratulate Ms. Velasquez on her bill today. H.R. 5322 closes a loophole that should have been shut decades ago. Americans who happen to live in Puerto Rico and other U.S. territories deserve the same protections enjoyed by each of us, and yet today they do not. Like Ms. Velasquez, I have been alarmed by reports about how UBS was legally able to underwrite municipal debt, package that debt into mutual funds, and then recommend those funds to Puerto Ricans. Such conflicts of interest are expressly prohibited under the Investment Company Act and should never have been allowed. All told, investors are seeking damages for billions of dollars. I also understand that Ms. Velasquez includes a transition period of perhaps up to 6 years to ensure that investors are not harmed. This bill is a common-sense fix to afford all Americans with equal protection under our security laws. I urge my colleagues to support H.R. 5322, and if Ms. Velasquez would like, I would yield the additional time to her.
Thank you, Mr. Chairman. Yield back.
Is any gentlewoman yields back? Anybody else seek recognition? There being no further discussion or amendments to the bill, the question now occurs on ordering the bill reported favorably to the House. Those in favor shall signify by saying aye.
Aye.
All those opposed shall signify by saying nay. In the opinion of the chair, the ayes have it, and ayes have it. This bill is ordered reported to the House with favorable recommendation. What purpose is the gentleman from New Jersey? Recorded vote is requested. A recorded vote has been requested. All those in favor of a recorded vote shall raise their hand and be counted. A sufficient number of having raised their hands and a recorded vote is ordered, and pursuant to subsection C5 of Rule 3 of the committee rules, the vote on this question is postponed. Now pursuant to notice, I call up H.R. 4852. The clerk will report the bill, which has been distributed in advance.
H.R. 4852, direct the Securities and Exchange Commission to revise Regulation D relating to exemptions.
Without objection, the bill is considered read and open to amendment at any point. The chair now recognizes the gentleman from New Jersey, Mr. Garrett, to sponsor the legislation for 5 minutes.
I thank the chairman. So we talked a little bit about this earlier during the day. When Congress passed the Jobs Act back in 2012, 4 years ago, one of the most important provisions in the legislation was Title II. What did that do? It allowed companies for the first time ever to use general solicitation in order to gather interest from a private offering of stock under Regulation D. Importantly, while companies are allowed under Title II to solicit the general public, the ultimate investors in these offerings must be something that's called accredited. So the pool of investors is therefore limited by that definition. So Congress mandated that the SEC implement Title II of the Jobs Act, and they did so and said SEC had 90 days, 3 months to do it. And naturally, 90 days came and went, and finally it took the SEC nearly a year and a half before they finally finished their rulemaking process, which is par for the course. But even more troubling than that, when the SEC finally lifted the ban on general solicitation in July of 2013, so it started in 2012 and was a year and a half later, it proposed a series of new restrictions on Reg D issuers that were not called for at all in the Bipartisan Jobs Act. And those proposals would ultimately make it more difficult and more costly for private companies to complete the offerings. These proposals came at the behest of, well, not Congress, but rather some well-funded special interest groups that have tried both, you might say, tooth and nail to delay and then water down the important provisions that this bipartisan Jobs Act legislation accomplished, and who unfortunately have all too often found a friendly ear, this group does, over at the SEC. But what these special interests need to realize is that their actions are having an impact on the real world, and we saw that in the committee hearings that we had here a few weeks ago. For example, while issuers using general solicitation have raised some $50 billion under the new rules, that number represents only 3%, about 3% of the entire Reg D market. At one of those hearings I just mentioned, Paul Atkins was here. He was a former SEC commissioner, and he noted in our hearing back in April, so last month, many critics, he said, quote, have pointed to the uncertainty of the proposed rules as a wet blanket deterring many small businesses from raising capital, urging general solicitation, contrary to the very spirit, intent of Title II of the Jobs Act, unquote. Or as Troy Parity said, he was then a SEC commissioner, he put it when the new rules was first proposed back in 2013, he said, quote, it seems undeniable that the proposal, if it ultimately were adopted, would thwart private offerings as an efficient means of raising capital. Moreover, even if the SEC had acknowledged that there has not been a, quote, measured increase in the incidence of fraud in the general solicitation market. Maybe I should repeat that one since we just heard the fear from the other side of the aisle that there would be an increase in fraud. The SEC acknowledged that there has not been a, quote, measured increase in the incidence of fraud in general solicitation. So, there is no identifiable problem that the proposed rules would address. In fact, they're only serving to stifle capital formation. And so we have H.R. 4852 would prohibit the SEC from moving forward on many of the ideas in their proposals and would allow for the strong private offering market envisioned by Congress in a bipartisan manner in the Jobs Act. And so I therefore urge my colleagues to support this bill, just like they did when they supported the Jobs Act initially. And with that, I yield back.
Gentleman yields back. Who seeks recognition? For what?
If none, I have, is there?
Does any member seek recognition? If not?
Yes,
for,
I'll seek recognition.
Okay, for what purposes the ranking member seek recognition?
I move to strike the last word.
The gentlelady is recognized for 5 minutes.
Mr. Chairman, here we go again. This bill, H.R. 4852, is again an example of a concerted effort to undermine the Securities and Exchange Commission, one of our cops on the beat for Wall Street. Like the endless attempts to impose onerous cost-benefit requirements on the Commission and repeated efforts to undermine the SEC, this bill would tie the hands of an agency we expect to protect savers and retirees. In fact, this bill is an excellent example of how Republicans seek to tie the SEC's hands and prevent them from putting forward modest investor protections even after Democrats cooperate with members on the opposite side of the aisle to provide regulatory relief. Indeed, Democrats worked with Republicans to lift the ban on general solicitation and advertising under the Jobs Act of 2012. I worked hard on that title of the bill, and when the SEC implemented this provision in 2013, they proposed alongside that regulatory relief some very simple investor protections. After all, if we're going to end a decades-long prohibition on advertising, adding some sensible guardrails made good sense. Now the SEC never finalized that proposal, and H.R. 4852 would come in and prevent them from ever doing so. This bill would impede the Commission from taking simple steps like requiring companies to file a simple notification form before using general solicitation to advertise their unregistered securities, or requiring companies to file their advertising materials with the SEC, or applying the same rules that apply to mutual funds, to hedge funds, and private equity funds in terms of how they report performance on their fund to investors. The Democratic witness at the hearing in which this bill was considered, William Beatty, Washington State Securities Division Director, testified that the North American Securities Administration Association opposes this bill and, quote, any action by Congress to diminish the ability of the SEC to undertake prudent steps to limit the risk to investors resulting from the lifting of the ban on general solicitation. Further, It would be a mistake for Congress to weaken the few existing investor protections in Rule 506, as this bill would in important ways," unquote. Mr. Beatty further testified that NASAA's concern is informed by the fact that Rule 506 fraud was the second most common type of fraud reported by their state members. This bill is likewise opposed by the Consumer Federation of America, as well as Americans for Financial Reform. Mr. Chairman, this bill is yet another attempt to undermine investors and the SEC, so I would urge Democrats to vote no. And I yield back the balance of my time.
Gentlelady yields back. Who seeks recognition? For what purpose does the gentleman from Minnesota seek recognition?
Strike the last word.
Gentleman is recognized for 5 minutes.
Thank you, Mr. Chairman. As I mentioned earlier, access to capital is a great concern for many businesses across America. Fortunately, members of both parties acknowledge this problem. That's why Congress took major steps to address it by passing the Jobs Act in 2012. One of the key provisions contained in that law was Title II, which helps businesses by exempting certain regulatory burdens. Title II did this by expanding what is known in the financial services industry as Regulation D, Rule 506. Now, thanks to Title II, securities that are marketed through general solicitation or advertisements and then bought by accredited investors are exempt from many requirements in the Securities Act of 1933. Unfortunately, when the Securities and Exchange Commission finalized the new rule in July of 2013, the SEC simultaneously proposed a new rule that undermines the purpose and application of Title II. The proposed rule would place new regulatory burdens on small companies that previously would have used Rule 506, but now would be required to clear new and significant hurdles, such as additional Form D filings before offerings and after they have closed. The Private Placement Improvement Act would ensure Title II works as Congress intended by prohibiting the SEC from proceeding with many of these new requirements. In fact, you could suggest that the Private Placement Improvement Act will protect the original intent of the Jobs Act. I want to thank Mr. Garrett, Mr. McHenry for their leadership on this important legislation, and I urge all my colleagues to support this pro-worker and pro-job growth legislation, and I yield back.
Gentleman yields back. Who seeks recognition? What purpose does the gentleman from Virginia seek recognition?
Move to strike the last word.
Gentleman is recognized.
Thank you, Mr.
5
Chairman.
minutes.
I commend Chairman Garrett for offering this thoughtful proposal here today, and I'm pleased to support it. The 2012 Jobs Act eliminated the ban on general solicitations and a private offering of securities so long as the issuer takes reasonable steps to verify that all the investors are accredited and all the investors are in fact accredited investors. In 2013, the SEC proposed new regulations under the Jobs Act that are contrary to congressional intent and impede issuers from performing Reg D offerings. This sensible legislation offered by Mr. Garrett, H.R. 4852, would confirm that the SEC cannot adopt new regulations that make Reg D offerings more costly or burdensome. Moreover, this measure will allow the Jobs Act to reach its full potential by prohibiting the SEC from pursuing these onerous regulations by stipulating that the SEC may not require issuers to file a Form D as a prerequisite to gaining Rule 506, the Rule 506 safe harbor. In addition, this legislation would exempt private funds from requirements of Rule 156. Everyone in this committee supports smart regulation and regulation that protects investors. Protecting investors and facilitating capital formation are not incongruent notions. In fact, I would posit that the facilitation of capital is a necessary condition to having robust investor protection. Excessive and costly regulation hinders capital formation and is a drag on the efficient and orderly markets. Preventing it will bolster our markets and allow for robust competition. It is for those reasons that I am pleased to support H.R. 4852, and I would ask my colleagues to do the same. Thank you, Mr. Chairman. I yield back the balance of my time.
Gentleman yields back. Who seeks recognition? For our purposes, gentleman from New Jersey seek recognition.
So I have an amendment at the desk.
We will pause and allow the amendment to be distributed. Clerk will report the amendment.
Amendment offered by Mr. Garrett, page 2, line 9, strike the date of first sale and insert 15 days after the date of first sale.
Well, no. The gentleman is recognized on his amendment.
Appreciate the chairman's laugh at the amendment. So just to be clear, based upon the ranking member's comment, our amendment and the underlying legislation, it undermines absolutely nothing, but it undergirds a stronger economy. It diminishes absolutely nothing, but it determines to make sure that we have a job growth economy going forward. The amendment that we had before, 2 lines in particular, are very technical amendments that would ensure that the current requirements for filing a Form D remain in place. All it does is ensure that issuers must file a Form D with the SEC no later than 15 days after the first sale of securities. And why do we pick that? Because this is a requirement that's worked okay already. It's worked well in the practice and has not led to any kind of investor protection or other type of issues. As I mentioned before, the SEC came out with some proposals. The SEC proposed back in 2013 requiring that Form D be filed 15 days after and also prior to the sale, meaning that the issuers would have to file it twice, which made no sense to issuers or myself or others as well. So this is just a technical amendment to keep this in line with the previous practice. And with that, I yield back to the chairman.
I thank the gentleman for yielding. I urge all members to adopt the amendment and the underlying bill. Once again, the critical need of our nation is jobs. It's capital formation. Reg D needs to be improved. We need to ensure that the SEC is enacting the intent of Congress in the Jobs Act. It's time to get America back to work again. I urge all members to adopt the gentleman's amendment and his underlying bill. I yield back to the gentleman from New Jersey, who I guess yields back, who seeks recognition. If no one seeks recognition, the question now occurs on the amendment offered by the gentleman from New Jersey. All those in favor shall signify by saying aye. Aye. All those opposed shall signify by saying nay. In the opinion of the chair, the ayes appear to have it. The ayes have it, and the amendment is adopted.
Would the chairman indicate that that was unanimous, since I heard no no nays?
Chairman heard no nays. The amendment is adopted. Is there any further discussion? If not, there being no further discussion or amendments to the bill, the question now occurs on ordering the bill as amended reported to the House with a favorable recommendation. Those in favor shall signify by saying aye. Aye. All those opposed shall signify by saying nay. In the opinion of the chair, the ayes appear to have it, and the ayes have it. For what purpose does the gentleman from New Jersey seek recognition?
I assume the chairman did not find that that was a unanimous vote with no nays. If not, then I will seek a recorded vote.
Recorded vote has been requested. All those in favor of a recorded vote shall raise their hand and be counted. Sufficient number having raised their hands, a recorded vote is so ordered, and pursuant to subsection C5, Rule 3, other committee rules, the vote on this question is postponed. Now, pursuant to notice, I call up H.R. 5429. The clerk will report the bill which was distributed in advance.
H.R. 5429, to improve the consideration by the Securities and Exchange Commission.
Without objection, the bill is considered read and open to amendment at any point. The chair recognizes the gentleman from New Jersey, Mr. Garrett, the sponsor of the legislation, for 5 minutes.
Thanks, Mr. Chairman. You know, our former chairman of the committee, Barney Frank, was fond of saying that redundancy is preferable to ambiguity when it came to legislation. Despite the fact that the SEC is subject to certain requirements under the Administrative Procedures Act and a host of federal securities laws, there does remain somewhat of a legal dispute as to whether the agency is actually required to quantify the cost and the benefits of the rules they want to promulgate. Well, for the last several years, in particular, since the SEC was embarrassed a while back when its proxy access rule was just about laughed out of court, we've been assured from both the previous chair, Chairwoman Shapiro, and the current chair, Chair White, that the SEC would comply with the President's executive order and that the agency would prioritize economic analysis in all of its rulemaking. And to the SEC's credit, some incremental steps have been taken to ensure the agency actually considers the impact of its rules could have on economic growth and job creation. But it's important to keep two things in mind. First, The SEC has in some ways had nowhere to go on this matter but up after the agency lost a string of court cases over its lack of attention to this economic analysis. And secondly, the assurances we've heard in the past and currently from the SEC and the internal policies that the agencies have adopted, all of them could be done away with a future SEC chair. So for that reason, it's past time that we ended any ambiguity over the SEC's responsibility to conduct a cost-benefit analysis for its rulemaking and simply to codify into law what President Obama himself has said federal agencies all should be doing. And so, despite some of the hysterical criticisms we've heard about this legislation, the requirement included in the SEC Regulatory Accountability Act are really straightforward. Here's three. All the bill does is require that the SEC first clearly identify the nature of a problem that it's looking into before they do a rule. Second, the legislation says that the SEC can only move forward with a rule upon a reasoned determination that the benefits of the rule justify the cost. And finally, the third one, the bill would require that the SEC to conduct a post-implementation analysis, basically to ensure that the rules are not actually harming investors or harming the broader economy afterwards. And so a sober review of this legislation shows that these requirements would in no way overburden or hinder the ability of the SEC to fulfill its mission. These are all common sense provisions that, as again, President Obama himself has said, should be best practices for federal agencies. See, cost-benefit analysis is more important than ever, given that the federal government is churning out more rules than at any point in history. And so this bill will protect the American public from the unaccountable regulators who often do not have the best interest of our economy in mind. Identical legislation passed the House of Representatives last Congress with the support of 17 Democrats, showing that this is not a Republican or Democrat issue alone. It's good government, it's a good government issue, and so I urge my colleagues, again from both sides of the aisle, just like last time, to support this legislation. With that, I yield back to the chairman.
Would you yield to the chairman?
I would happily yield to the chairman.
I thank the gentleman for yielding, and this is, I guess, a somewhat rare occasion that I would urge all members to adopt the Obama administration policy here, as will soon be codified in the gentleman from New Jersey's act. Again, all this bill does is ensure that the SEC indeed abides by the President's Executive Order 13570, which outlines cost-benefit analysis, also known as common sense, in an economy that is still limping along, in an economy where the real unemployment rate of those who have left the workforce, those who are underemployed, is far closer to 10% than what we read in the headlines. Wouldn't we want to know how the SEC's actions ultimately impact capital formation, how it impacts small business, how it impacts job creation? We know that historically the SEC, frankly, has done a rather poor job in this regard. We can certainly see language from the GAO. We have seen language from the D.C. Circuit Court of Appeals. It said, quote, "The Commission acted arbitrarily and capriciously for having failed once again to adequately assess the economic effects of a new rule," and, quote, "inconsistently and opportunistically framed cost and benefits of the rule." It is time to hold Washington accountable at a time when too many Americans are still suffering in this economy that limps along. So I thank the gentleman from New Jersey for his bill and urge all members to vote for it. The time of the gentleman from New Jersey has expired. Who seeks recognition? For what purpose does the ranking member seek recognition?
Thank you, Mr. Chairman.
Gentleman is recognized for 5 minutes.
This is probably not a surprise, but just as I opposed this bill in the previous two Congresses, I continue to do so now. Nothing has changed to persuade me that this bill, under the guise of, quote, cost-benefit analysis, end quote, is anything but an attempt to undermine investor protection and the Securities and Exchange Commission by subjecting the agency to countless industry lawsuits. In any other reality, the SEC should be the Republicans' poster child of how economic analysis can effectively guide rulemaking. For the last 4 years, the SEC has closely adhered to its own internal guidance, which parallels Executive Order 12866. But don't take my word for it. Listen to the SEC's Inspector General's review of SEC's efforts. Quote, all of the rules that we, that is, the IG, evaluated, specified the justification for the rule, considered alternatives, and integrated the economic analysis into the rulemaking process. We determined that the SEC's use of the current guidance has been effective in incorporating economic analysis into the rulemaking process. Further, we found no notable differences in economic methodologies in support of rulemakings across rulemaking divisions. End of quote. The IG, as IGs often do, also identified ways to improve upon the economic analysis, and the SEC made those changes. But H.R. 5429 goes much, much further. Although the sponsor claims that the bill is merely applying the president's executive orders to the SEC, he noticeably forgot one important provision of the bill, of the order, that prohibits private rights of action. As a result, Mr. Garrett's bill opens up several new and ongoing revenues for industry to sue the SEC when they do not get the rule they want. Worse, the bill provides no new funding for the SEC to address the additional analytic and litigation workload. Mr. Chairman, are you aware that your counterparts on the Appropriations Committee would see the SEC's budget cut by $75 million next year? It is ironic that as Republicans push this bill forward, the sponsor has also blasted the SEC for not meeting deadlines imposed on it by the FAST Act. This bill makes it impossible for the SEC to meet those very deadlines Congress imposed. Mr. Chairman, not only does the bill before us today require the SEC to impose the least burden on industry, it also allows industry lawyers to mount a number of attacks against the agency. Again, this bill is nothing more than a thinly veiled attempt to tie up the SEC's modest resources and slow down, if not thwart, its ability to protect investors. So I would urge my colleagues to oppose H.R. 5429, and I yield back the balance of my time.
Gentlelady yields back. For what purpose does the gentleman from Wisconsin seek recognition?
Move to strike the last word.
The gentleman is recognized for 5 minutes.
As I was walking back over here, I thought the sun was shining a bit brighter and the clouds were clearing. We were going to have a great bipartisan moment that we were all buying into the president's executive order. But my hope was dashed. The ranking member is not supporting it. Made a few good points, but I guess I don't know that the president in his executive order was trying to undermine investor protections or trying to tie up resources within the SEC. I think he's made a proposal by way of executive order that is about good government. And I find myself in a unique position actually advocating for one of the president's executive orders by way now of legislation. Doesn't happen very frequently, but it does today, and we're in now a unique spot where Republicans are advocating for the president and Democrats are actually in opposition. This bill by Mr. Garrett, which I commend him for his hard work and which I hope all my colleagues will support, places reasonable, if not modest, requirements on independent regulatory agencies like the SEC. The problem is that the executive order is really more of a suggestion. It lays out reasonable standards that independent regulatory agencies like the SEC meet before finalizing new rules, but it gives the agencies the discretion to follow them, doesn't mandate that they follow them. This is legislation that will mandate that they follow, for the most part, that which was set out by the president's executive order. The bill before us is modeled after that executive order and would mandate by statute that it's followed. For example, this bill would require the SEC prior to rulemaking to conduct a cost-benefit analysis, identify regulatory alternatives, clearly articulate the problem that a proposed regulation seeks to address, and ensures that regulations are written in plain language. This is common sense, simple stuff that's just good government. And it's hard to understand objecting to these basic requirements. Despite some improvements at the SEC, this legislation remains necessary because the Commission's inadequate rulemaking process hasn't really changed. For example, the D.C. Circuit Court of Appeals vacated the SEC's proxy access rule, finding that, quote, the Commission acted arbitrarily and capriciously, having failed once again to adequately assess the economic effects of a new rule. And they said inconsistently and opportunistically frame costs and benefits of the rule. That's a problem, and it should be addressed. To safeguard against this pattern of behavior and create a firewall between politics and economics, this bill also puts the chief economist of the agency in charge of conducting cost-benefit analysis on rulemakings as opposed to the commission. The impact of this proposal could mean better rules that facilitate capital formation and investor protection, accomplishing two of the SEC's three mandates. A bipartisan vote in favor of this bill would go a long way in demonstrating to the American people that Republicans and Democrats can agree on common sense regulatory reform that puts the interests of America's economy and consumers ahead of politics. And again, that Chairman Garrett, not known as one of the more liberal members of the House, he's known as one of the conservatives, has taken an idea from the president and said, you know what, this is a point that we can agree on. Let's try to take the president's ideas and actually codify them in law. And I hope that maybe the ranking member might have a change of heart and look at potentially supporting this legislation. I think it is a great opportunity for bipartisanship, better government, and better regulatory rules. With that, I yield back.
Will the gentleman yield?
Yes, I'll yield to the gentleman from New Jersey.
I know you're asking that the ranking member would have a change of heart. Unfortunately, it looks as though she was not paying all that attention to you during that part, but
I'll reclaim my time.
well, before you do that, you've made a point 7 times I counted that this is the president's executive order that we're basically trying to implement, and I'm thinking that maybe I could, your comment and my comment could persuade the ranking member to sign on to the bill. I'm thinking of making an amendment to the bill on line 4, first page, and basically under the short title section, this act will be cited as the President's executive order regarding SEC Regulatory Accountability Act to drive home the point that all we're doing here is implementing President Obama's executive order, as Mr. Duffy has pointed out repeatedly.
Are you yielding time to me?
Well,
I'll reclaim my time and yield it to the ranking member.
Well, thank you very much.
On bended knee.
To Mr. Garrett, who has demonstrated more than once, more than twice, more than 3 times, but consistently, his efforts to undermine the SEC.
My time has expired.
And everything that he, I will not support anything that you do relative to the SEC.
Time of the gentleman has expired. Who seeks recognition? There being no further discussion or amendments to the bill, the question now occurs on ordering the bill reported favorably to the House. Those in favor shall signify by saying aye. Aye. All those opposed shall signify by saying nay. In the opinion of the chair, the ayes appear to have it, and the ayes have it. For what purposes a recorded vote has been requested? All those in favor of a recorded vote shall raise their hand and be counted. A sufficient number having raised their hands, a recorded vote is so ordered, and pursuant to subsection C5 of Rule 3 of the committee rules, the vote on this question is postponed. Debate having concluded, the committee will reconvene at 10 a.m. sharp tomorrow morning to dispose of all postponed votes. The committee stands in recess.